Garden Reach. I mean, that whole bucket of stocks are just doing remarkably well. So that is one. Second, some NBFCs selectively are doing okay. I want to pull up Bajaj Finance. That stock deserves a mention this afternoon. This is not a tiny tune. This is one of the largest market caps on the NBFC space, arguably the largest market cap in the NBFC space, making a move, trending at the high point of the day and being up 3%. So a remarkable show of strength by select names in the session today. And then a clutch of small caps, Harsh, which have done superbly well this afternoon.
Yes, absolutely. Let's pull up the Nifty mid cap and small cap indices, and let's see how those are playing out on a day like this. Of course, the large cap index doing fairly well, but you're seeing a slightly more subdued mid cap index in comparison to the large cap, and the small cap index too, trailing. It's a range-bound market though, and that's been the case for now a couple of days. It's the second straight day where we're seeing that. So that's the other piece. Talking about some specific stocks which are absolutely abuzz. Those are some names. JBM Auto is up 15%. Hind Copper, and both Neeraj and me let out a bit of an exclamation when we saw that 11% on Hind Copper earlier today. But that's a very, very strong move. Gujarat Pipavav is the other one, 7% higher. BDL, of course, then you have all of those defense counters, Cochin, Shape, Data Patterns, BDL, and that's where a large part of the buzz today also seems like. Mastech on the other side, but again, there are no big losers per se. It's just down about 3.5%, and this is the BSE 500 we're talking about. So no big movers on that side of the fence. But that's broadly it. Let's bring on board Kunal Shah of Mire Asset Sher Khan and Nirav Ashar of Latin Manharlal Securities to talk to us and give us their views. Kunal, let me start off with you with regard to the Nifty 50 and the Nifty Bank. Good afternoon, both of you first, gentlemen. Kunal, let me allow you the opportunity to give us a lowdown on what's your sense on this move that we've seen today, 25,100 being held.
Yeah, firstly, good afternoon, everyone.
Good afternoon.
See, what we have seen in the markets in the last 3 trading sessions, where the FIs have been back in the FNO front. So whether it's the futures, whether it's the option front, they have been buying options on the call side as well, and they have been also buying the futures. On the cash market, yes, we still need a little bit of buying interest to come back. But overall, Nifty has been sustaining above the mark of 25,000, which is a very positive trigger in the last 3 trading sessions. So now what we expect, 25,150, which is the immediate hurdle for the market on the upside. Once that is taken out, then we are heading toward 25,600, 25,700 levels on the higher end. So that's positive. Nifty till the time 24,700, 800 zone is not taken out on the downside decisively. The view continues to remain on the positive side. Coming to Bank Nifty here, Bank Nifty, the underperformer has now started to outperform. And that's the best part, that the underperformance is now turning into an outperformance. And if Nifty has to go on the higher end, Bank Nifty has to start participating. And that is where we are seeing Bank Nifty trading higher. The immediate resistance, yes, definitely is at 55,000, 55,200 zone. And once that is taken out, then you see the real short covering move coming in Bank Nifty index towards the mark of 56,000 on the higher end. So I think it's just a matter of time. Probably by next week, we'll see that momentum coming back into the stock. And that is where we'll see your banks started to performing on the higher end, and that will push the Nifty index higher as well. So our view is positive on the market from a short-term perspective. For Nifty, 24,800, 700 is the demand zone, and for Bank Nifty on the downside, it is 54,400. So till the time we are holding 54,400, the view remains bullish. Short-term target should be 55,200, 300. A close above it will lead the index higher towards 56,000.
Okay, and Kunal, your picks for this afternoon?
So coming to the picks over here, firstly on the both the calls are on the buy side. First is Titagar. Railway stocks have been buzzing off lately, and I think here the momentum is pretty strong. So Titagar is a buy for me at the current levels. Already the stock had given us a breakout, and now we are seeing a follow-up move in the stock. So this is a buy from the current levels, looking for a target of 960, 980 on the higher end. One can keep a stop loss of 890 on the lower perspective. Second one is MCX. Again, MCX has formed a bottom formation on the lower end. Already the stock had corrected from the higher levels around the mark of 9,000 towards the levels of 7,200. Now we see the next leg of rally starting again in MCX, so that is a buy for me. On the downside, your stop loss should be 7,500, and on the higher end, I'm expecting target of 8,000 to 8,100 on the higher end.
Okay. Nirav Asher from Latin Manalal is here, and Nirav cannot not talk about defense to start off with, at least from my end to you, right? Blistering rally today, blistering rally. And global geopolitics don't show any signs of easing off. If anything, that's moving higher, inching higher. What are your thoughts here?
Well, good afternoon and thank you for the invite. I think defense was quiet for quite some time, and I think some of the main reasons attributed to this could be that we tend to have the nature of contracts is quite lumpy in nature, and you have the quarterly results where it becomes very difficult to predict what kind of revenues are likely to get booked, what kind of expenses are going to get booked, what kind of profitability is going to come. Unpredictable nature in terms of execution, in terms of the nature of contracts which are being awarded. But I think hopefully that is set to change now, because we have the government which is working on a very aggressive investments in defense over a period of time. And I think there's going to be a vision statement where there's going to be focus on indigenization. Atmanirbhar Bharat is going to be effective in a very much more positive way. And I think of late we've seen a lot of companies becoming very proactive in terms of land acquisition also, in the sense they've been buying big land parcels to plan for the future. Case in point is Bharat Forge, which recently bought around 950 acres of land in Andhra Pradesh. We've also been hearing that HFCL is going to buy around 1,000 acres of land for defense establishment, again in Andhra Pradesh. And of course, we've been seeing advertisements that how Uttar Pradesh is very, very aggressive and it is playing a leadership role as far as the defense sector investments are concerned. So already around 61 units have been allotted land, and 9 are already operational. So I think there's a lot of action which is slated to happen as far as the defense sector is concerned. And another important aspect is the exports. There's been a lot of demand which we are seeing for the Indian arms, and I think a lot of countries have expressed interest. Already exports have picked up in a very, very meaningful way. Right. So I think all this augurs extremely well for the sector as a whole.
Right. So Nirav, but that's a long answer. Give me a short answer. What do you like? What do you guys as a brokerage house like within defense?
Yeah, so as we've already stated earlier also that we like companies like Solar Industries, Bharat Forge, Bharat Electronics, Data Patterns. These have been some of our preferred picks. Of late, we have started looking at Apollo Microsystems also. We've bought some quantity. And I think the numbers were quite impressive. The first quarter results have been quite good. There's been a sharp improvement in the margins. And yesterday, the announcement where they have done an MOU for rocket motors and propulsion technologies, that also should work very well as far as this company is concerned.
Okay, let's put the spotlight on the stock of the day. Actually, sorry, just before we go to the stock of the day, it will be wrong to not get in Kunal's view on some of these defense names. Excuse me for that. Before we go to Hindustan Copper, Kunal, defense names, which chart looks the best?
I think from the current levels, EL is well placed. I think already there was a breakout which was there in the chart, and I'm expecting this to go towards 415, 420 in the short term. So that is looking very good. One more stock which I would like to highlight over here is GRSC. GRSC on the technical charts has formed a double bottom in today's trading session. So I think now the worst for the stock is over, and probably you can see a good move on the upside. So GRSC also remains a buy. On the lower end, the support is placed at 2400. I am expecting here the first target to be close to 2700, 2720, and above that the stock can even go toward 2900, 3000 zone. So these two are looking very strong on the technical charts from a short-term perspective.
Okay. Now let's put the spotlight on the stock of the day. Hind Copper is in focus on the back of a huge 2,000 crore capex boost expected in the next 5 or 6 years. Anushi Johnson with more details. Anushi, 11% for Hindustan Copper. What did they say in the presentation for the stock to be so excited?
Well, as you just mentioned about the capex, well, that's where the story lies. In fact, if you are looking at the capex at 12.2 million tons of expansion is what we are looking at, and this is by FY 30 to 31 that the company has planned. If you just look at the current capacity, that stands at 3.4 million tons. So it's about a 4 times of a jump that we are looking from the current levels itself in the next 5 years. But for the same, for this capacity increase that we are seeing, 5,000 crore has been outlined by the company in terms of what's happening. This is against a 350 crore of capex that the company did in FY25. They're also seeking a collaboration with Chile for more capacity building plans also going forward. Now, this brings us to the portfolio expansion as well. For the same, they'll be acquiring a new copper deposit in India and abroad as well. In fact, they're seeking MOU with multiple Indian PSU players as well. This includes the likes of Coal India as well as GAIL in focus, and this is to expand their mining portfolio as well. There are also, a couple of mines also of the company will be restarted. In fact, if you look at Rakha mine, that is expected to restart by 4th quarter of this financial year. So this brings in about 3 million tons of capacity back on board for the company. Along with that, even if you look at the Candida mine, that is expected to restart by December 2025. So that roughly adds up to about 0.225 million tons per annum as well. In fact, there had been a recent update as well in terms of what's happening with the industry, in which the company stands to be an indirect beneficiary of fast tracking of some of these mining projects that we are looking at. This is, with the environment clearance for these mining projects for specific minerals which were there. If we just look at what the company has essentially done, it has signed a MOU with rights as well. And this is as of June 25, that data that we are looking at, to develop critical minerals as well for supply chain and end-to-end supply chain solutions that we are seeing. Surging copper prices is something that we should be looking out for as well. This could benefit the company. And in terms of demand outlook also, now the company currently fulfills only about 5% of the overall demand that is there for India's copper needs. So there's a growth opportunity on that front as well. So, well, that's what, the overall story is about Hindustan Copper, the main peg being about the capex plan forward in the next 5 years.
What a move today, though. Anushi, thanks a lot for that. Thanks for detailing out everything. Is this enthusing enough, Nirav, for you to go out and buy the stock 11% higher today?
Well, we already have coverage on the stock.
I knew that. Which is why I was saying that I know you have bought it earlier. My question is, will you buy it now, Nirav?
Yes, we'll continue to buy it now also, because the target price is around 347. And I think this presentation has come earlier also. So we've heard a lot of things earlier too, as far as Hindustan Copper is concerned. But now it gets magnified at this point of time. And to put things really frankly, I think 2,000 crore is just too less over a period of next 5 to 6 years, considering the fact that this is the only copper miner in the nation. And I think most of the players, they have been importing the copper concentrate, and they have been treating it and converting it into refined copper. So we really don't have any entity which has copper reserves. This company controls around 45% of the country's reserves, but still a lot of work to be done. And I think this is also less, considering the fact that copper is so important as a metal, as we also call it as Dr. Copper. So I think this is just the beginning, and I think a lot of this work should have been done much earlier.
On the metal side, Kunal, any stock which kind of fits the bill for you, including, of course, if you have a view on Hindustan Copper?
See, I think for me, metal as an index had already given us a breakout. So we have positional targets of 11,000 on the metal index. Out here, the top preferred pick would be Hindalco. Absolutely near to its 52-week high. There is a lot of strength in the stock from the lower level. So there has been buying interest. And we expect the stock to go towards 780, 790 in the very short term. So Hindalco could be a buy for me for a short term perspective. 740 should be a stop loss. 780, 790 is what I'm looking on the higher.
All right. So that's, of course, with regard to Hindalco, but also most importantly, Hind Copper. That move by that stock is stupendous for a single day move. Let me go across. We also have our bull versus bear segment today, and it's on JBM Auto, a stock which is up more than 14% in intraday trade. And this is on the back of a big investment which comes through, but also it's an e-bus order win. Puneet, talk to us about what the bull versus bear case is, and before that, just briefly, give us an outline of what's happened.
Well, thank you for that. So it's definitely a $100 million investments that the company has gotten from IFC. Now it's a funding arm, a financing arm essentially of the World Bank, and previously this was also received by ADB a few years ago from JBM Auto. So that's also another key positive, that these companies continue to help the company in its mobility in the EV space. This capital investment likely is only in the mobility arm, and that's what the company mentioned to us in their interview as well today, and that's largely been the case. It's not an equity investment directly into JBM Auto, but in the mobility arm, and the purpose of that arm is to invest and procure more orders from the government of India. So they have to participate in tenders, maintain those orders for 12 years, and essentially the money is going to that aspect. So that's very key to note. Apart from that, when you look at the second bull and bear case, the company's capacity is at 20,000 e-buses, but the utilization stands at a very minuscule 10 to 15%, and that number pans out with the Vahan data, which is the retail sales for the e-buses segment as well. For JBM Auto, they sell roughly around 1,000, maybe around 800 buses, annually as well. So the capacity is just a very weak at 15%, and hence the return ratios are also depressed. So that'll be one that the company is focusing on to improve substantially going forward. But as of now, that seems to be the case. When you look at the third key one, they are deploying roughly 1,455 electric buses with this funding of $100 million, which they've got from IFC, and that will help the company in the orders that the company has procured to deliver it on the schedule that they have mentioned. But it's also important that players like Ashok Leyland have started to look at the e-bus capacity as well as the industry very closely. Why do I mention Ashok Leyland here? Because they have roughly about 950 buses a month in terms of manufacturing. They're looking to increase that to 1,650 within the next year or two. And what that would do is essentially make Ashok Leyland with the highest capacity, because the utilization is also quite higher, and a very straight strategy that they do not want to participate in in tenders where they have to maintain the buses for 10 to 12 years, something that JBM has still not clarified on. So it seems to be that the industry is looking to change, and with that the legacy players are now entering the space substantially with a higher focus. Finally, in terms of valuation, there's no analyst coverage on JBM Auto. The trailing price to earnings multiple is at 80 times, and hence that's one of the key other things to watch. It's not cheap by any means, but the revenue has grown by almost 1.5 times since FY19 levels at 5,500 crores for FY25. Profitability has not kept pace with the growth in terms of revenue, but with the utilization increasing, that'll be one to watch out for. So overall, that seems to be a positive up move with this new funding, because that will help the company in its order book deployment. But valuations need to be something that to watch out for both players like JBM as well as something like Electro as well. So for retail investors, it's key to do your due diligence before entering a stock like this, because the valuations are high with no to very limited analyst coverage.
Okay, thank you so much for that, Puneet, for breaking that down for us in great detail. We also had a conversation with the Vice Chairman and Managing Director of JBM Auto on how he is planning to use the amount. Listen in to a slice of that conversation.
we will be using this $100 million investment to deploy vehicles in Maharashtra, Assam and Gujarat, and which will be almost 1,500 buses which will be deployed over the next few months. And clearly we are seeing that this will help to fuel the growth of the organization, and we are very happy to partner with a prestigious institution like International Finance Corporation, which is one of the key members of the World Bank Group, and being their largest investment in Asia, we are quite proud to have them as our partners with us.
Okay, staying with the auto space, the Automotive Component Manufacturers Association of India calls the GST 2.0 a welcome move and said it will generate demand in the entire value chain. They've also spoken about the India-China trade relations, calling it an advantage for the country. Listen in.
We're seeing that the Indian companies have to pay nearly 25% plus another 25% tariff to US exports. How is our component industry affected by it, and what is the backup plan for this?
Sure. I think first let's get this into context that this is 6.6 billion to the US out of a total export of 22 billion. So this is only a part of the whole export agenda. Number two, within the 6.6 billion, 50% of it is on 25% or 27.5% effectively, and 50% of it is on the 50%, which really means about 3 odd billion out of 22 billion is exposed to this excessive tariff. Why I keep using the other 25% is because we look at it from a global competitiveness perspective. Other countries also are facing tariffs. So some are 19, some are 20, some are 25%. So the differential tariff on that 25% is not that much. It is equal to other countries. So there should be no impact on that agenda. It's the other 50% that currently seems to be impacted. And I have full faith on both our governments, I mean especially our governments, that they will do what is right for the country and what is in the best interest of the country. As you all know, in the last few days, you all have reported that lots of conversations have been on, and we are certainly hopeful that that will get sorted out. But the backup plan, of course, is continue to be cost competitive, look at alternate markets. There are a few member companies that have production plants beyond India. They're supplying from other countries into the US. Global FTAs that the Indian government is doing will aid the global risk mitigation agenda. So all in all, some of these bumps will come, and I'm sure some of these bumps will go. Some of these, the rest of what I said are no regrets. And the Indian auto component industry has been resilient, will stay resilient. We'll find new ways to continue to build.
Yeah, I mean, everybody banking on that for sure, that both parties, yes, talking it out, hopefully happening soon. And frankly, I mean, until it is essentially the two parties who know when it'll get resolved. So let's not try and overthink this piece for sure. Okay, maybe about time that we try and get in what dealing rooms are recommending or saying in the session today in our special segment, the chatter from the dealing room being told on heard on the street, and Sumit Sarkar Johnson for that. Sumit, good afternoon. It's Friday. What are you learning?
Well, multiple stocks remain in focus. Firstly, it's Ambuja Cement, and dealers are indicating that the large part of the selling when it comes to Ambuja Cement is over. So that stock is one thing that you should keep an eye out for. It has been an underperformer of late. For DLF and PI Industries, multiple dealing rooms are recommending buy call on the technical charts, and again both the stocks have been an underperformer of late. So there could be a strong bounce back on both the counters is what dealing rooms are indicating. For Brainbees, that is First Cry. It is a beneficiary of the GST rate cut that we have seen for multiple products, but dealers are today indicating that a prominent large HNI is a buyer in trade. For Hindustan Zinc, there are buy flows on large HNI desk. Delivery volumes are picking up is what dealers are indicating, and a domestic broking firm has written a note and is guiding for an upside of closer on 20 to 25% from the current levels. And they also believe that higher silver prices will be one of the key beneficiaries for Hindustan Zinc. And lastly, it's Cipla. That stock has been buzzing in trade again. Earlier also we had highlighted this counter, and there are expectations of a new drug announcement that is expected to come in for Cipla. So, and that could be a big trigger for the counter. And that stock has also been buzzing in trade today in the dealing rooms.
Okay, all right. So those are some names for you. Thank you so much, Somit, for that. Kunal, any of those names cropping up on your list or looking good on charts? I'll just quickly repeat some of those names. And Ambuja, DLF, PI, Brainbees, Hindustan Zinc, and Cipla, if you missed any of them.
I think Cipla looks the best at the current levels. I think already the stock has witnessed a breakout and now it has been forming a double bottom formation on the technical charts on the lower time frame. So we expect this momentum to continue on the higher end, and Cipla could go towards the mark of 1620, 1640 in the very short term. So Cipla could be a good buy at the current levels. 1540 should be a stop loss on the downside.
Okay. Well, Cipla on the pharma side, by the way, I think at some point of time, we might talk about this. If the Biosecure Act were to come back, then it's a move for some of those pharma names as well. By the way, just wondering, Kunal, you gave this call on Titagarh, right? And I think it's inching up and trading probably at the high point of the day. If you can just pull up Titagarh Rail at 929, as per our indicator, it's gone above the 200-day moving average. So smart call at the right time, Kunal. Still good to initiate a long?
Yes, 100%. So I think definitely it's a buy. I think it's a kind of a positional bet also what you can take. So for me, the first resistance is at 965 is what I'm expecting on the higher end. So even from current levels, 35 points upside. And probably a close above that would again trigger a further rally towards the mark of 1100, 1000 on the upside. So good positional bet as well. It has been underperforming since quite a long time. And now we finally see the outperformance coming in the stock.
And Nirav Asher, any thoughts on some of the rail companies?
Well, I think most of these stocks have been hovering at the same levels which we saw some time back, and not much movement. So I think we would stay away from railway stocks for the time being.
Okay. Well, let's try and talk about IT now. By the way, just the clutch of those stocks are doing well. Now let's talk about IT. And the reason I bring up IT is because Infosys is, at least when we started off, and we should pull up the stock again, but when we started off the day, was leading the pack of Nifty gainers higher. Clearly, Bajaj Finance has eclipsed most, and this one too has come down. And Nifty IT per se is in the green because of heavyweights, but the larger portion of companies are in the red. But Infy is in news for specific, very, very specific regions. The buyback, which was known, but the nature, the extent, and relative to the past, what does it mean? That piece. I think that's what we are trying to now get Somit in to talk about. Somit, you brought this up a week back, so kudos for pointing it out. But now that the announcements have come in, tell us a bit about it.
Well, yes, firstly on the Infosys buyback details, they are looking to buy back shares at 1800 rupees per share, which suggests an upside or a premium of around 19% compared to the current market price. The buyback size is 18,000 crore, the biggest ever that the company has announced, and double of what the last couple of buybacks were in the range of around 9,200 to 9,300 crore rupees. Now the record date is yet to be announced, but given the past references that we have seen, it will take at least 3 to 4 months for the company to complete the entire buyback process. Now if you look at the buyback size, that is 2.4% of the equity, not the highest, because in 2017 the company had bought back nearly 4.9% of the equity. And as I was mentioning, the total buyback or the entire buyback process will take at least 3 to 4 months to complete based on the historical data that we have seen. Now, before going into the fact that what should a retail investor do, firstly let's understand what is the acceptance ratio. Now, acceptance ratio is how many shares will the company actually buy back as compared to what you're applying for. Now, for every 100 shares that a shareholder will apply for buyback, minimum 5% or minimum 5 shares will be bought back by the company. That is the entitlement ratio or the minimum acceptance ratio, which means that for every 100 shares, the company has to buy back 5 shares for retail shares. Now, what's in it for retail shareholders? Now, for retail shareholder, the reserved category is 15% as per the SEBI rule, which means that around 2,700 crore rupees of the 18,000 crore is reserved only for retail shareholders. And who are retail shareholders? Those who hold shares worth less than 2 lakh rupees, which means at a price of 1,510 rupees, anyone who's holding close to 132 shares will be a retail shareholder. Now, in the past buybacks, we have always seen that the retail participation has been quite high in Infosys, and if that remains the case even in this buyback, then the acceptance ratio will be at its minimum, that is 5%, which means that for every 100 shares, 5 shares minimum is something that the company will buy back, which means that if someone goes ahead and tries to do an arbitrage opportunity here, that is what if a retail investor try to looking out for an arbitrage opportunity at 1,510 rupees, that will give you very limited gains. So here's the table that we have brought out here, that if the acceptance ratio is 5%, then the actual gain for any retail shareholders who are looking to do a arbitrage opportunity at this moment will be just 1%. At 10% acceptance ratio, the gain will increase to 2%, and if the retail acceptance ratio is 50%, then also the gains will be quite limited at 9.5% over the entire buyback process, which will take at least 3 to 4 months. Obviously, this buyback is huge and it will be great opportunity for the old shareholders who have been holding shares for Infosys for a very long time to apply for this buyback. But any new investor who's looking for an arbitrage opportunity at this moment, it would result into very limited gains for them.
That's very, very well put, Somi. Thank you. It's great perspective, of course, for viewers, but also for some of us. So thank you for that. Let me go across to Nirav Ashar. Nirav, just from a perspective, one Infosys in particular, what's the view like? Of course, buyback itself not exactly lucrative enough, but do you believe that the stock in any case is pricing in too much pessimism to a certain extent? Also with rate cuts in the US, is it ripe to buy IT at this point?
Well, definitely one can enter IT at this point of time, but one has to be very selective, and it's worth taking a chance considering the fact that things can hopefully get better from the current levels. And as far as the buyback is concerned, it may not be very lucrative on the face of it, but I think we have to see whether their promoters are going to participate in the buyback. And here we are assuming that the minimum acceptance ratio, I mean the retail portion is just going to be around 15%. So the acceptance ratio is going to be on the lower side. More than that, I think sentimentally it could be a very big positive as far as the stock is concerned. And I think definitely valuations are set to improve from here, hopefully with the change in the business conditions also. And I think as far as from a balance sheet perspective also, it really makes little sense to keep around 42,000 crores in cash and cash equivalents, which the company has got. So I think it will help to improve the ratios also eventually. So I think it could be a win-win situation.
Okay. And Kunal, do you have a view with regard to an Infosys? Of course, we've seen a cool off on the stock price intraday, but for a trade?
I think for a trade, we have seen good buying interest from the lower levels, but this has been the resistance zone for the stock around the mark of 1540, 1550, where it has faced rejection. We have again faced rejection at the same levels in today's trading session. So I think wait for Monday's trade. If we are able to sustain this mark of 1540, 1550 on the higher levels for the first half an hour, probably there's a trade which comes up, which can take Infosys higher towards 1575, 1580.
Stay on, lots more to talk about. We need to slip into a very quick break. But with the way stocks are moving, the last half an hour before the weekend and the Fed meeting next week promises to be an exciting one. Stay tuned, we'll be right back.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
Thanks for staying with us here on India Market Close. It's time to put the spotlight on some of the top newsmakers today, and Jasmeet joins us with that list. Jasmeet, what do you have for us?
Well, right, yes, thank you for that. I have a couple of news and I have 6 to 7 stocks buzzing on that news. The first one would be silver. Silver records the record high pricing today. It's nearly trading at 1,27,000 per kg. Well, this in turn is positive for few stocks like Hindustan Zinc, Vedanta and MCX. While Hindustan Zinc, because it's the largest producer of silver, that's buzzing in trade. While we have Vedanta, who have again stakes in Hindustan Zinc, and that's also buzzing in trade. And lastly, the MCX, that's the trading platform where generally they earn the fees from the transaction as silver prices go up because of more transactions, and the stock is buzzing in trade. While the next one is HFCL, the Andhra Pradesh government approves 1,000 acres of land for defense development. While they say with this particular development, they would boost the Indian defense sector. And this land will be used for development of various artilleries and TNT fillings and so on. While the next one is GMDC. While the stock is nearly up 12% in trade today. Well, this comes in after the new rule of the government where they have exempted the long process for mining of few specific elements. The elements like REE, that's a rare earth element. Well, as GMDC performs trades in the mining development, and that's the reason why GMDC is also buzzing in trade today. What the new rule says is they want to extract the rare earth element in a quicker phase, given that it's used for the defense sector and will be used for magnets, which will again be used for different equipments. And that's the reason why the change in the rule. While this change in rule will impact GMDC, given that they're mainly into mining, and that's the reason why stock is nearly up 12% in trade today.
Thank you so much for that, Jasmeet, for bringing out those stocks. Nirav, Ashar, I wonder if you have a view with regard to some of the commodities, gold, silver. We've seen a very, very sharp run up, and there are people on both sides of the fence, especially when it comes to a gold. What's your sense, if you have a view?
Well, I think we particularly like the industrial metals, and I think there we are quite positive, especially I think silver. So Hindustan Zinc, of course, looks quite good. And apart from that, we also like stocks like GMDC or Hindustan Copper and National Energy.
All right. Kunal, I wonder if you have a view with regard to some of the auto names, and we've seen quite a decent run up on the Nifty Auto Index. Do you have a view on that one?
I think definitely. If you look at the long-term charts for the Nifty Auto Index, the correction what we had seen in the Auto Index from September 2024, we had topped out at 27,000, 28,000 on the higher end, and then we made a low of 19,000. And then we had a pullback where we were facing resistance somewhere around the mark of 24,000, 24,300 zone. Post that, the rally has been sharp post the GST rationalization, and our view on the auto index as a long-term bet when we look at technicals, currently the index is trading at 26,900 mark. We have a positional target of 28,000 on the upside for the auto index. So auto still has some steam left. It's a bound dip opportunity. Whatever dips you are getting, that utilize as a buying opportunity here. From a short-term trade perspective, I think Hyundai looks attractive for a long side trade, and one can see further upside towards the mark of 2630, 2650 on the higher end. So Hyundai could be a good buy from the current levels.
Okay, so those are some views coming in with regard to the auto index. Neeraj, there was obviously a view coming in from Citi, where they've upped the target price on some of these names as well. Some of the auto counters, Maruti, M&M, Hyundai. So some of those names also seeing some zing in trade today. In fact, Maruti is up 1.5%. M&M not so much, but Hyundai also is up. So wonder if Nirav has a view. Do you?
Yes, actually, I think we like those stocks where there is some valuation comfort at this point of time. Most of the stocks are looking a tad bit expensive. So I think our preferred picks would be Tata Motors and Hero MotoCorp.
And all right, so we'll leave it at that. Let's move on. The political unrest in Nepal is sending ripples across the border as well, impacting not just the Himalayan nation but also Indian companies with significant operations there. With protests escalating and supply chains facing disruptions, businesses are feeling the heat. Among those most affected are the likes of some of the FMCG names, Dabur, ITC, which have closer ties to Nepal through both manufacturing as well as consumer markets. How exactly is this turmoil hitting their operations and what does it mean for their bottom line? Mahima is here with an in-depth analysis to break it all down. Over to you, Mahima.
As you rightly mentioned, Dabur, Britannia as well as ITC do have their manufacturing facilities in Bangladesh, and Britannia has, as per a PTI report, Britannia has currently temporarily halted also production in Nepal right now. In terms of the companies that possibly have market share in Nepal includes Dabur, Britannia, Marico, Patanjali, ITC, HUL, etc. Dabur, ITC, of course, through its Surya Nepal subsidiary has manufacturing facility. Even Bikaji Foods recently entered into a JV with Chaudhary Group for their snacking business. Reliance Consumer also has partnership with Chaudhary Group in Nepal. Campa Cola also has recently entered into the Nepal markets. Varun Beverages, around 3% of their consolidated revenue comes from Nepal. For Dabur, it's almost 8% of their FY25 sales that comes from Nepal. For ITC, around 3% in FY25 came from Nepal. For Berger Paints, around 2% came from Nepal in FY25. Asian Paints, Kansai Nerolac, HUL, around 1% of FY25 sales, and Britannia and Nestle sub that 1% mark. So all of these companies, though less in terms of percentage, most affected should be probably Dabur out of all of these names, but might see a temporary halting of manufacturing facilities for these companies and probably some disturbance of where the revenues also stand.
Thank you for breaking that down for us, Mahima. But there's also a word coming in. We spoke with Abneesh Roy, Executive Director Research at Nuvama Institutional. Here's what he had to say on the subject.
For summer categories, Nepal is an additional worry. In Bangladesh, if I see, Marico did not see much of a problem, medium, long term. But yeah, Imami did see. So I will say, yes, some companies will manage it better. But overall, this is more of a temporary blip. We continue to remain positive on Britannia, Bikaji, Hindustan Unilever, Nestle, and to some extent, Tata Consumer also.
Okay. So, the other thing is, of course, that when which of these names might actually have the best chances for a sustained uptake, because some of these stocks have inched high. So keep that in mind, that if you're buying into any of these names, there is some bit of rally that has happened into these stocks already. Now let's change tracks. I want to because somehow these FMCG names, the trading activity, I would reckon, is not as strong as the ones that Vansh has picked out as his key price volume buzzers. So let's get details on that and then ask Kunal Shah about those stocks. So Vansh, first come in and thank you so much. Okay, we'll get in Vansh in a moment from now. Let's just, maybe I can highlight these stocks. Can I? Let's just take the graphics up on the screen. So if you look at BEML, the volumes are at 10.4 times 30-day average. There are 3 buy calls, 1 hold call, 0 sell. The potential is only 8% though. But remember, it's in line with some of the others defense stocks which are doing well. Similarly, MTAR Tech, right? Volumes at about 24.37 times 30-day average. 6 buys, 0 calls, but the return potential is slightly higher at 17%. Tega is not exactly buzzing on price action, but the volume action out there is certainly strong. Now, you got to keep in mind that in Tega's case, not a very widely covered stock, but maybe some of the updates will happen after the con call that happened today. So let the con call details get out, and then maybe we'll get in the brokerage calls. For now, the return potential isn't quite the strongest for this one. Similarly, Gujarat Pipavav, good volume action, return potential not that strong, but stock is doing okay. Similarly, GMR Airports was a big buy call today from Jefferies, if I'm not wrong, with the target price higher, I think 108, but the volumes today are much higher with a return potential of about 12%. So Kunal, I have listed out 5 names which have got at least volume action. If you think the price action on any of this is interesting and you might want to recommend a trade.
See, my interest over here would be on BML. We had recommended to our clients in today's trading session as well. So we had initiated a buy and we had a potential target which just got achieved here. But I think still there is upside left into the stock. So what happened in BML? The stock had formed a triple bottom formation on the technical charts, and there was accumulation seen on the lower end. And once the stock surpassed the mark of 4160, the technical breakout was confirmed here. So still there is more upside left over here in BEML. I think the stock has the potential to go towards 4,800, 4,900 mark in the very short term. So I think any dips into the stock would be a good buying opportunity since the stock is already up by 8 to 9%. But if you get any decline towards 4,300, 4,200, I think a best buy at the current levels where one can go long and look for a target of 4,800 on the higher end for BEML.
To our special segment, Profit Intelligence, where we put the spotlight today on Nifty 50 laggards, which have seen a fall of 1 to 5% in the same period, while the Nifty has risen about 13%, which is from April 17 to today. Just to highlight, April 7th, by the way, is also the year's lowest level for the Nifty. Somit joins in with this interesting juxtaposition of two different trends. Somit.
Well, yes, if you look at the year-to-date low for Nifty 50, it was on April 7th, and since then we have seen a steady rise when it comes to the benchmark. It has risen nearly 13%, but there are only 5 stocks in the index which have actually underperformed massively when it comes to the benchmark. Now, if you look at those 5 stocks that have underperformed, it's NTPC firstly, which has fallen the most, around down 5%, TCS down 4% since April 7 till now, Sun Pharma, it's down 3%, Kotak Mahindra Bank again down 3%, and Power Grid, which is down 1%. So at this point of time, what we are trying to do is we are trying to see whether is there an upside or can these underperformers actually turn into outperformers for the rest of the financial year and going forward. So firstly, highlighting NTPC. Now, if you look at the buy call, nearly 89% of the analysts tracking this company have a buy call, while the return potential based on the consensus target price is nearly 26%. So what are the key bullish points for NTPC? Firstly, they're expecting a power demand growth to come in. There's a low base for October, which will also help. Then there is a significant part of the planned capex till 2032 is under regulated tariff mechanism. Now, this highlights the kind of revenue growth visibility that will come in for NTPC going forward. Apart from that, the company is also expanding into new avenues such as green hydrogen and its derivatives, green energy storage, and nuclear energy as well. Now, when it comes to Sun Pharma, if you look at the percentage of buy call, the 80% of the analysts tracking the company have a buy call. The return potential is 19%. And what are the key trigger points for the company here? Firstly, they are seeing a double-digit growth in the domestic formulation business. Now, this segment contributes nearly 1/3 to the top line and nearly 55% of the company's EBITDA. Apart from that, they're expecting a sustained focus on the innovation products, and they're also saying that the concerns on the specialty ramp-up is now overdone, so that will not be a concern going forward for Sun Pharma. The third stock on the list is TCS. Now, if you look at the buy call, it's 65% of the analysts tracking the company have a buy rating, 17% is the return potential. Now, what analysts are saying at this moment for TCS is the fact that the growth expectations have bottomed out, and going forward, they're expecting some boost in the second half of this calendar year. Apart from that, they're also saying that margin recovery will remain in focus. In fact, the 24 to 26% aspirational band that TCS had given for themselves, that is very much achievable as per analysts. And also, the free cash flow that the company generates. Now, this can come back to shareholders either in form of a buyback that we saw recently from Infosys, or either in form of special dividends that the company could give. But the key risk for TCS is AI. And today, Jefferies reports clearly mentioned that 20% revenue deflation is what they're seeing in the IT services over CY25 to CY30, with higher impact on high margin revenue businesses. So that is the key concern coming in for TCS currently. Now, if you look at Kotak Mahindra Bank, nearly 61% of the analysts have a buy rating. The return potential in 70 is 17%. And what are the key trigger points here? They're expecting a healthy growth coming in, the healthy growth outlook coming in for Kotak Mahindra Bank going forward. They're also saying that the margin and credit pressures are expected to ease going forward. Then there is the MFI trend, which is also suggesting some improvement from the current levels. But the key risk here is that growth recovery could take time for Kotak Mahindra Bank on the flip side. And lastly, when it comes to Power Grid, now here 67% of the analysts have a buy rating, while the return potential is just 12%. The key bullish points coming in for Power Grid at this moment is that the project wins have been quite healthy. The company's dividend yield are healthy, but there could be a weak earnings growth going forward. Not much, a single-digit earnings growth is what analysts are expecting from Power Grid, and execution challenge is the biggest risk when it comes to Power Grid.
Okay, so those are some names, and thank you, Somi, very, very valuable for bringing out some of those. Good upside, but actually it's 321, and before we discuss those names further, let me go across to Kunal Shah for the BTST call of the day. Kunal, the week's coming to a close. It's been a muted sort of week, but we've still inched higher on the Nifty. What's the BTST call?
Yeah, I think it will be from the metal space, and the stock we discussed on the show as well, and that's Hindalco. Nearing to its 52-week high, a clean breakout on the technical charts from a consolidation phase. So Monday could be the day where Hindalco could be in the flavor, and that's a buy for me at the current level. 745 should be a stop loss. I'm expecting target of 768 to 774 on the higher end.
Sorry, didn't get the target prices from where it is right now, Kunal.
So for Hindalco, the target price would be 768 to 774 on the higher end.
Okay, and what is the stop that you're putting versus the current of 757?
No, the stop is 745 on the downside.
Oh, but Kunal, isn't the risk reward not that because if you're giving a 13 rupee stop and a 10 rupee upside, then the risk reward is not favorable.
So because I'm expecting for the second target, that is 774, 775 to be achieved on the higher end. So from that perspective, I'm expecting that even the first target, not even the second target, could be done on the higher end.
Okay. Fair call. Well, metals doing okay. Going into the Fed week, Nirav, Ashar, some of the metal names may actually have a good one. So could it be a safe tactical play to play metals?
Yes, I think we already beginning to see some positive news flows in the metal space, as we've already seen that China wants to curb the excess capacity over a period of time, and that should work well for the domestic majors. So I think we've seen some good meaningful movement in the steel related stocks. So hopefully I think metals should do well, led by steel, aluminium related stocks.
Okay, and Nirav, with regard to the insights, the profit insights piece which Somi did today, some of those names standing out, right? So just trying to get your view, and NTPC, Sun Pharma, TCS, Kotak Mahindra and Power Grid are those names which have a decentish return potential in terms of percentage of analysts wanting to buy this counter. It's 65% plus. And there's a decent upside, like an NTPC has a 26% upside. Any of these names looking attractive to you because they've underperformed?
I think the preferred pick would be TCS.
Okay.
And that would be followed by Kotak Mahindra Bank and to a certain extent Sun Pharma. But I think I would stay away from NTPC and Power Grid Corporation.
Okay, stay away from NTPC and Power Grid. Kunal, do you have a view on any of these, on charts, any of these looking good for a quick breakout?
See, I think for me, from the power space specifically, I think JSW Energy looks quite attractive on the chart perspective. Already there has been a double bottom formation around the mark of 490 zone, and I think the upside will start to continue. So for the stock, the immediate resistance is placed at 548, 550. Once that is taken out, then you expect the stock to go towards 580 as well. So I think here the upside is quite high. The risk to reward is favorable. If you are taking a positional bet, 490 should be a stop loss on the downside, and the upside target could be close to 580.
Okay. Well, that's with regards to some of the energy names. But like I said, we can't not end the day without talking about defense, simply because of the way that those businesses have done in the session today. MTAR Tech, Premier Explosives, some of the smaller names also coming to the fore. Nirav, Ashar, I asked you about the large cap names, smaller names, the second tier names. Maybe the safety might be a bit lower, but is there something that the house is constructive on? Not the top tier defense names, the second tier names.
Yeah, so as I pointed out, Apollo Microsystems is something which is looking quite attractive. I think the quarterly results have been quite good. The margin trajectory has been very, very attractive, 31% operating profit margins, and a lot of their concepts on which they were working, they are now ready to hit commercial production. And yesterday, the MOU which has been done for propulsion technologies also should work positively for the company. So I think expect more upside if they are able to scale up their order book, if they are able to scale up their execution. So I think the next couple of quarters are going to be very critical as far as this company is concerned.
Okay, thank you so much, gentlemen, Kunal as well as Neerav, for joining us and giving us those views. We're around 2 odd minutes for close for the day as well as for the week. And let's pull up where the Nifty is. 25,100 held. That's the one key positive. Let's look at it intraday as well. 0.25% higher on the Nifty Bank. So that outperformance yesterday not really reflecting today. It's mild outperformance, but nonetheless, it's obviously continuing to be a fairly range-bound market, around 140 odd points or 135 odd points in terms of the range there. And if I exclude that initial bit of choppiness, is probably lesser than that. So that's how the Nifty is shaped up. Let's look at the heat map as well. And on the heat map, what you're seeing on your screen is, of course, defense is dominated. So BEL for a second day this week is the top gainer on the Nifty 50. But you have the Bajaj twins. Great traction that you're seeing on those. 3% and 2% each. You have a couple of metal names. Hindalco sits there. There's a couple of auto names which have come back to the fore after a couple of days off. So those names have started to do well as well. Quite a few auto names, a Tata Motors, a Maruti, and Eicher, all of those are doing fairly well for themselves. Reliance sits 1% higher, so maybe that's one of those which is aiding the index. What's not done well? Well, there's consumption, HUL trend sitting there. There's also Asian Paints in that pack and Titan in the bottom 10. Also, a Nestle sits 0.25% lower. Eternal is down. Bajaj Auto, while the other two Bajaj twins have done well, Bajaj Auto is down 1%. So that's something to keep in mind. Despite all of the auto stocks doing well, Bajaj Auto is one which is standing out. Wipro also down around 0.7, where the IT index hasn't exactly done as bad, I believe. Let's pull out the sectoral heat map and we'll probably try and see what the IT index has done. Well, Nifty IT, 0.25% higher, so not bad. A decent outing today, but 4%. The sector of the day is surely the Nifty India Defense Index. Metals have done well as well. We spoke about that. Auto is the other one, 0.5% higher. Some of those auto names coming back. We spoke about that. Banking up about 0.25% thereabouts. Let's look at both the Nifty mid-cap and small-cap indices. A mild bit of underperformance, if I can call it. But given that, I would believe that for the week gone by, we've outperformed both on the Nifty mid-cap as well as on the Nifty small-cap indices. But a mild underperformance today. Let's pull up the weekly charts. On the Nifty, thereafter the mid-cap, thereafter the small-cap index. So for the week, the Nifty small-cap is up 1%. The Nifty mid-cap is up 1.5%. So we've seen some outperformance there versus the small-cap. And the Nifty 50 index is up 1.2%, smack in the middle of both of those. So a fairly good week for the Nifty 50 as well as for markets. 1.2 is not a bad week to take home. Let's also, and 25,100 held. That's the other key positive. Now, last off, I want to look at what has happened on the Nifty IT and the Nifty India Defense Index, because the move today was solid. 3.5% on the Nifty IT Index, so clear outperformer there. And let's pull up the Nifty India Defense Index as well. 6.5% after that move today. So this is where all of the outperformance has actually come from. Of course, most names in the broader markets. I want to quickly pull up the BSE 500 top gainers, top losers to cap this off. Those are some names for you. Quickly on to what to watch tomorrow, and or rather for Monday. Post the weekend, do we have? Yeah, there you go. So you have all of that. Of course, the unemployment rate data coming through, but the WPI index, no concerns per se from an Indian perspective. The PV sales data will come out. The balance of trade data will come out, and we will have those adjustments on stock prices come Monday with regard to the Nifty, to markets and specific stocks. But joining me as always at the end of the week, we have Shreyansi, who's going to take us through what to watch over the weekend, because markets will obviously be off. Shreyansi, I must say, I watched Inspector Jende after you pulled that last week, and I'm looking forward to what to watch this weekend.
Well, absolutely, and I've got a list of 3 OTTs to add to something to your binge list as well, Harsh. But let me first start with the first movie that in fact I'm looking at on Popcorn Pulse. The first one in fact is Demon Slayer. Managed to slay any and all doubts with those strong pre-booking numbers. In fact, September 12th is the one when this Japanese anime is releasing. It's very interesting. Haruo Satozaki is the director for this one. Early reviews, in fact, are quite spectacular. And in terms of what it's going to be doing, it's going to be an imagining of the Taisho era. So keep an eye on this one. Halls are pretty packed. So if you don't get a booking for this weekend, do keep in mind that this is the one that you should be watching out for. The next one that we have, in fact, is in terms of OTTs. Let's quickly also take a look at the last week's top release before we move on to that as well. And global collections for The Conjuring's latest one in its series is $187 million. It's the second fastest horror movie, in fact, to climb above that $100 million mark. And in India itself, 67 crore is the kind of collection that this one has managed to have. Scared away any and all doubts when it comes to the series. In fact, the best opening for this particular franchise as well. But let's also quickly take a look at some of the OTT binge list counters that we have. The first one, in fact, is Do You Want a Partner? This is the one where you do have the 2 leading ladies, in fact, navigating through a male-dominated world of startups. So keep an eye on this one. The other one, in fact, that we have on this list is The Girlfriend. And this is the one that is releasing on Amazon Prime. The early reviews seem to be a little mixed at this point in time, but there are some positive reviews, so you can even keep this one on your list. And the last one, in fact, that we have on our list is the season 5 of the Only Murders in This Building. This is one series that managed to catch a lot of eyeballs in its previous season, so keep an eye on this one, already released on September 9th. And the early reviews, in fact, are gearing up to be quite strong, so keep an eye on this one that is releasing on Jio Hotstar. But with that, completely out of time. Thank you so much for tuning in.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, द बेस्ट ऐप टू यूज इज द एनडीटीवी ऐप।
You're watching Market Express and I'm Sanjana. Let's get straight into the show. We saw another week of strong gains for Nifty as the benchmark ends above 25,100. ICICI Bank and Bajaj Finance power Nifty gains. Meanwhile, the Sensex ends flat. Massive buying seen in defense and metal. On the other hand, we saw Nepal unrest worrying FMCG, making it a top laggard of the day. Analysts from Jefferies held 50 investor meetings over the past 2 weeks on India's CRDMO sector. CRDMO in the pharma sector is a firm that does research, development and manufacturing of drugs or ingredients on contract to larger pharma firms. Investors generally agree on a positive outlook for the next 3 to 5 years. Company updates and capex expansions boost confidence in growth prospects. Divi's Labs emerged as the top favorite stock, though it's already widely held. Concerns linger over high volatility, steep valuations and poor transparency. Jefferies warns AI could drive 20% revenue deflation in IT services over calendar years 25 to 30, hitting high margin streams the hardest. This cap sector growth at 3.8% CAGR keeps margins tight. Higher uncertainty will limit valuations, and among large caps, Infosys and HCL Tech face lower deflation risk. Jefferies prefers Coforge and Hexaware and expects Tech Mahindra and Wipro to underperform. Citi highlights a trifecta of macro tailwinds for India's auto sector: income tax restructuring, interest rate cuts and GST rate revisions. Maruti Suzuki expects an uptick in small car sales with 2 new models in the pipeline. Mahindra & Mahindra benefits from GST cuts on its utility vehicle portfolio, with tractors also seeing strong gains. Hyundai's new plant is underway with key updates on new models due to 15th October. Citi maintains buy ratings and hikes target prices of Maruti to 17,500, M&M to 4,170 and Hyundai to 2,900. CLSA maintains an outperform rating on Shriram Finance with a target price of 735. Now, the company expects a stronger second half of the fiscal year. Investments are underway to support future growth. Margins are set to recover as cost of funds benefits kick in. Asset quality is expected to stay in line with projections. Jefferies maintains a buy rating on GMR Airports with a target price of 108. The company is evolving from airport hubs to commercial and retail platforms. Regulated EBITDA makes up less than 10% of SOTP valuation. Consumer-linked business accounts for about 80% of value. GMR's airport platform unlocks value beyond concessions. Leverage is speaking with credit rating upgrades on the horizon. DAM Capital upgrades Indus Towers to buy from neutral, hiking the target price to 402 from 395. Capital allocation concerns ease as Africa investments are unlikely to destroy value. Dividends and buybacks are set to resume. Geo-tenancies will continue, though at a reduced rate. Vodafone Idea's sustainability raises questions, but not in the near term. Investec upgrades Lupin to buy from hold, hiking the target price to 2,265 from 2,100. Lupin is well placed to ride the upcoming GLP-1 opportunity in India, with the company boasting a well-developed ecosystem around diabetes, cardiac, diagnostics, consumer and digital. Strong execution and consistent delivery in complex generics drive its US momentum. Now, Lupin remains a beneficiary of US generic macro, tariff or no tariff. Post-correction, valuations look reasonable. Morgan Stanley downgrades Gujarat State Petronet to underweight from equal weight, cutting the target price to 295 from 452. The firm prefers GAIL and Petronet and LNG to play India's gas adoption theme over GSPL. Limited growth capex and pipeline capacity expansion are seen for GSPL. Upcoming restructuring from the Gujarat State Petroleum Corporation Group could gain more investor attention for it. Defense stocks were buzzing in trade today. Garden Reach, Cochin Shipyard and Mazgaon Docks saw high volumes, around 1x their 30-day average. Mazgaon Docks kicks off talks for the 70,000 crore P-75 submarine order with the Indian Navy. The government unveiled a 15-year mega boost plan for Indian defense covering nuclear-powered warships to AI warfare. to plan ICE future fighters, mountain tanks, hypersonic and laser weapons. Other key stocks in the defense pack that were buzzing today were Bharat Dynamics, BEML, Cochin Shipyard, Mazgaon Dock and Garden Reach. Sejal Glass shares surged 5% in trade today, up 24% over the last 5 days and 71% in 6 months. The company's market cap is at 670 crore. The company processes glass and value-added activities like tempering, designing, insulating and lamination. Long term, the company is looking at 25% growth year-on-year from acquisitions, expansion in UAE and robust demand. NBCC has inked a pact with Rajasthan for development of Rajasthan Mandapam. The project is valued at 3,700 crore and NBCC will initially get a 50 crore interest-free loan to develop 95 acres land. The company also plans to mobilize additional funds through sale and lease of built-up space. This is a project that is targeted for completion in 30 months, so do keep an eye on NBCC. Lodha Developers co-signs a memorandum of understanding with the government of Maharashtra for the development of a 30,000 crore green integrated data center park. The project is being designed with a total capacity of 2 gigawatts and aims to host multiple international and domestic data center operators. This initiative positions Maharashtra as a strategic hub for sustainable digital infrastructure and supports India's growing demand for green data solutions. India's largest gas utility, GAIL, is exploring the listing of its city gas distribution arm. GAIL Gas provides natural gas to roughly 6% of India's population and areas serving industries, mobility and households. The CGD unit operates in 16 areas. Last month, India's largest gas utility floated a tender for hiring a consultant to study the listing of GAIL Gas on Indian stock exchanges. Travel Food Services secures a license to operate 12 units at Cochin International Airport. The license, granted for a period of 5 years, covers Terminal 1 of the airport. Under this agreement, the company operates 11 restaurants and 1 passenger lounge, further strengthening its presence in India's airport hospitality sector. HFCL receives approval from the Andhra Pradesh government for the allotment of 1,000 acres of land to set up a defense manufacturing facility. The proposed unit includes the production of artillery ammunition shells and TNT filling operations. This development aligns with HFCL's strategic expansion into the defense sector and supports the government's push for indigenous defense manufacturing. Shipbuilding stocks are sailing strong, up 3 to 4% on fresh order wins. Mazgaon Docks is in talk for a 70,000 crore submarine deal with a German company. India may finalize 2 mega submarine projects by mid-2026 worth over 1 lakh crore. Revenue visibility remains solid, with Cochin Shipyard leading on book-to-bill ratio. JBM Auto surges after its e-bus arm, JBM Eco-Life Mobility, secures a $100 million investment from the International Financial Corporation. The funds will be used to procure 1,455 electric buses, boosting India's green mobility push. Hindustan Copper is in focus with a 2,000 crore capex plan over the next 5 to 6 years. The company aims to acquire new copper deposits in India and overseas and is exploring partnerships with Indian, PS and US and Chile's Codelco. A major capacity expansion of 12 million tons is targeted by FY 30 to 31. Infosys announces its biggest ever share buyback worth 18,000 crore at 1,800 per share and 19% premium to current market price. While 15% is reserved for retail investors, high participation may limit gains. The buyback covers 2.4% of equity and is expected to wrap up in 3 to 4 months. RailTel is on a roll, winning fresh orders worth 713 crore. Big wins include Safe City projects in Panvel and Nashik. The Bihar Education Council has signed major contracts for smart classrooms and ICT labs in government schools. All projects are set to finish by March 2026. RailTel's total order book now stands at 7,197 crores. Blackstone-backed PAG is reportedly scouting for new international buyers for its 54% stake in Nuvama, aiming for a valuation of over 4,000 crore. Talks with previous bidders like Permira and CVC Capital fell through over pricing mismatch. Now, the Jane Street tie-up is also unlikely to impact the deal. Prices consumers pay for a variety of goods and services moved higher than expected in August, while jobless claims accelerated, providing challenging economic signals for the Federal Reserve before its meeting next week. The consumer price index was up from 2.7% in July, while core inflation, excluding volatile food and energy costs, held steady at 3.1%. Both readings remain above the Fed's 2% target. The consumer price index posted a seasonally adjusted 0.4% increase for the month, the biggest gain since January, putting the annual inflation rate at 2.9%, up 0.2 percentage point from the prior month. The number of Americans filing new applications for jobless benefits increased sharply last week, consistent with the material softening in labor market conditions. Initial claims for state unemployment benefits jumped 27,000 to a seasonally adjusted 2,63,000 for the week ended September the 6th. The UK economy failed to grow in July following the biggest contraction in manufacturing output for a year. The Office for National Statistics said the economy saw zero growth in the month following a 0.4% expansion in June. However, monthly figures are volatile, and the ONS has said it will now focus on growth over a rolling 3-month period. In the 3 months to July, the economy expanded by 0.2%. Giorgio Armani's will is instructing heirs to gradually sell stakes in his fashion brand. The plan calls for selling a 15% stake within 18 months, followed by another 30 to 54.9% over the next 3 to 5 years. Priority buyers include luxury giants like LVMH, L'Oreal and EssilorLuxottica, and if the sale does not proceed, an IPO will be considered. Armani is leaving no children, so his heirs and close collaborators will manage the transition. The brand generated $2.7 billion of revenue in 2024, but faces profit pressures amid a market slowdown. This phased approach aims to preserve the legacy while adapting to current market conditions. Hyundai's battery plant in Georgia is facing a 2 to 3 month startup delay after a recent US immigration raid. The raid, involving 475 detained workers, mainly hired through LG Energy Solutions contractors, disrupts specialized labor needed for plant construction. Hyundai's CEO Jose Munoz says sourcing such skilled workers is common and necessary, and many detained workers are returning to South Korea. The plant is part of a $7.6 billion complex aimed at producing electric vehicle batteries and was scheduled to start operations this year. Meanwhile, Hyundai plans to source batteries from other facilities during the delay. The raid impacts US-South Korea industrial relations. C.P. Radhakrishnan took oath as the 15th Vice President of India at the Rashtrapati Bhavan today, with President Draupadi Murmu administering the oath in a formal ceremony. Now, he secured 452 votes in the vice presidential election held on September the 9th, defeating opposition candidate B. Sudarshan Reddy. The election was called after the resignation of former Vice President Jagdeep Dhankar. Now, Radhakrishnan is a veteran BJP leader with deep RSS ties and previously served as Governor of Maharashtra. The Supreme Court today questioned the fairness of air pollution policies. The court said it is unfair to only create policies for Delhi. Chief Justice of India D.Y. Chandrachud made the remarks, and the bench was hearing a case on the use of firecrackers. The Chief Justice says a policy just for the elite in Delhi is not right. He asked for a pan-India approach and also noted that pollution is a problem across India, not just in the capital. The Chief Justice mentioned that other cities also have poor air quality and said that the livelihood of firecracker manufacturers should be considered. The court will continue to monitor the case. Prime Minister Modi is all set to visit Manipur for the first time since ethnic violence erupted in May 23. The Prime Minister will also likely lay the foundation stones of and inaugurate development projects worth 8,500 crore in the state when he is scheduled to visit. Among the projects to be launched or inaugurated might include a working women hostel and a super speciality healthcare facility in 5 hill districts. Minutes after the Delhi High Court, the Bombay High Court too received a bomb threat email with the Bombay Bar Association requesting all members and staff to vacate the court premises. According to the Mumbai Police, bomb detection squads are conducting searches inside the court. However, preliminary reports suggest that this could be a hoax threat. More than 300 South Koreans who were detained in a massive immigration raid at a Hyundai plant in the US state of Georgia have arrived back home. Their return comes as the country's president and Hyundai's chief executive have warned about the impact of a raid. A chartered Korean air jet carrying the workers and 14 non-Koreans who were also detained in the raid took off from Atlanta at midday local time on Thursday. One South Korean national has reportedly chosen to stay in the US to seek permanent residency. Newly released CCTV footage showed a person suspected of shooting and killing conservative influencer Charlie Kirk climbing down a roof and running into the street. The shooter accused of killing Kirk remains at large. Charlie Kirk, a leading conservative activist and close ally of US President Donald Trump, was fatally shot during an event at Utah Valley University. He was 31 years old, and a person was taken into custody was later released. US President Trump called Kirk great and legendary and vowed justice. The former president of Brazil, Jair Bolsonaro, has been sentenced to 27 years and 3 months in prison after being found guilty of plotting a military coup. A panel of 5 Supreme Court justices handed down the sentence just hours after they had convicted the former leader. They ruled he was guilty of leading a conspiracy aimed at keeping him in power after he lost the 2022 election to his left-wing rival, Lula da Silva. Nepal's campaigners are unanimously backing former Chief Justice Sushila Karki as the interim Prime Minister. The formation of the interim administration is delayed amid disagreements over parliament dissolution. President Ramchandra Paudel is holding late-night discussions with legal experts facilitated by Army Chief General Ashok Sigdel. All sides are agreeing on a 73-year-old Karki to lead, but confusion is emerging over constitutional provisions for her appointment. Political parties are calling for constitutional resolution, while protesters are demanding parliament dissolution. FIFA is receiving over 1.5 million ticket applications within 24 hours of launching the pre-sale draw for the 2026 World Cup. Fans from 210 countries, mainly the US, Mexico and Canada are entering the Visa Presal draw. The tournament will feature 48 teams playing 104 matches across 16 cities in the US, Canada and Mexico. Now, the pre-sale entry period runs until September 19th. Successful applicants will be notified from September 29th and get time slots to buy tickets starting October the 1st. Ticket prices begin at $60 with dynamic pricing based on demand. Additional ticket sales phases will follow in October. And that's a wrap on Market Express. Stay tuned to NDTV Profit for Profit 360 up next.
In a bold move to democratize financial insights, your channel, NDTV Profit, is turning a new chapter with its fresh tagline, For Your Profit.
The agenda is to sort of step up and really bridge the knowledge gaps, highlight the opportunities a lot more, and make profit a shared possibility. So not just for a few, but also for the new.
Our revamped platform is all about breaking down barriers, delivering sharp market analysis, the latest trends, and essential business updates to people from every corner of life. Whether you're a seasoned investor or just starting out, no jargon-heavy reports. NDTV Profit makes profit accessible to all, empowering everyday folks with the tools and knowledge to navigate the financial world confidently.
We are speaking to everyone, whether you understand what EBITDA is or not. You don't have to. You don't have to know what ARPO is, but we'll still tell you what a telecom stock will do. You don't need to know what is RBOP. We will tell you what a hospital stock will do.
What we are trying to effectively do out here is responsible journalism. We're thinking of the audience and what every minute of the audience spending on a television channel or across our social media handles, what do they get out of it? Are we doing work enough for that? That is the question in the newsroom every single day.
From stock market swings to economic forecasts, it's your go-to source for clear, reliable info. Stay tuned as NDTV Profit redefines how you engage with business news.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी सब विदेश जाते हैं। The best app to use is the NDTV app.
We see the problems, but you as a social entrepreneur see the solutions. You are not just creating solution, you are creating a future where everyone has a chance to thrive. For the change makers, the innovators, the ones building a better world, one solution at a time. The Adani Green Talk Social Impact Awards are created for you, inviting social entrepreneurs to apply. Green Talk Social Impact Awards 2025, where innovation meets impact.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
Sensex surges over 350 points while the Nifty ends above 25,100, marking its longest winning streak in more than a year. Most sectoral indices close higher, led by strong gains in Nifty defense. Trump's pick for India envoy Sergio Gore calls India a strategic partner whose trajectory will shape the region and beyond. He signals that a trade deal is imminent and hinted at a possible Trump visit to India later this year. The SEBI board meets as sources indicate the market regulator may revise minimum public shareholding rules and consider easing compliance requirements for entry into AIF schemes. FMCG companies including Britannia and Nestle are set to face significant production disruptions in Nepal as ongoing protests and civil unrest force factories to halt operations. CP Radhakrishnan sworn in as the 15th Vice President of India at Rashtrapati Bhavan, with President Draupadi Murmu administering the oath in the presence of senior government officials and dignitaries including Prime Minister Modi, former Vice Presidents and Cabinet Ministers. The Bombay and Delhi High Courts received bomb threats via emails. Bomb detection squads conducted searches at both the courts as officials found nothing suspicious at the Delhi High Court, while search at Bombay High Court is still underway. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Let's take you through how the markets fared today. The Nifty is above the 25,100 mark and the Sensex jumped over 350 points as auto stocks rallied. The markets witnessed broad-based gains with pharma, IT and financial stocks leading the uptrend. FMCG and PSU banks, though, dragged slightly on sentiment. My colleague Harsh now coming here with a wrap of the market action today. Harsh, over to you.
Well, a decent outing for the Nifty today, frankly, just about nearly 0.5% higher, and we gained around 100 points odd, 25,100 being held in trade. That's the crucial level. We've not just held 25k, but held it comfortably, and that's probably the one piece which stands out. In terms of names, the defense pack was on fire today. 4% higher on the Nifty India Defense Index. BEL was the top gainer for a second day this week, and we saw some of the stocks really move. We saw solid volumes on some of those counters, something like an MTAR Tech and some of the other names too, really impressed in the way in which they moved in trade. Now, let me talk a little bit about some of the losers on the Nifty. So while we had some of the consumption names sitting in that pack of the top 10 losers, and Eternal was one of them, Trent, Titan, Asian Paints, so all of those sat at the bottom. So consumption was one theme which clearly didn't work today, at least on the Nifty 50. In terms of IT, and we'll switch to sectoral, 0.25% higher on the IT index. It's had a fairly good outing for the day. Even for the week, in fact, we're up 3.5% on the Nifty IT index. But essentially, it was all about defense. If you're looking at that sectoral heat map, That 4% move has led it higher by 6.5% for this week alone. The Nifty clocked a gain of 1.2% this week, so that's some real outperformance we saw on the Nifty India Defence Index. Let's talk about the broader markets as well. So on that end, we saw a slightly or rather largely in line with the Nifty 50, the mid-cap and small-cap indices up around 1/3% thereabouts. That's how it played out. But for the week gone by, we saw a bit of divergence. The Nifty mid-cap index was up 1.5%. The Nifty small-cap index up just about 1% for the week gone by. In terms of some of the gainers and losers, you'll have it on your screen, but what a move from Jupiter Wagons. That one was up 14%. And of course, on the positive side, you'll see plenty of defense names peppered all over the top 8 to 10 gainers. So that was one pack which obviously really stood out in trade today.
And some breaking news coming in. CPI inflation for August is out and it is at 2.07%. Let me quickly go across to my colleague Pallavi for more. Pallavi, CPI inflation for August reported at 2.07%, showing a rise from July's 1.61%. Take us through all of the details and what this means.
Right. So, again, a number which is not entirely on unexpected lines. Let's remember that the print we had seen in July was actually the lowest in nearly 8 years. So this print is a little bit of an uptick because of a sequential increase and a modest annual increase in prices of food items, as well as likely the contribution coming in from higher gold prices. But what we must remember is that this print continues to provide comfort despite the uptick. It is considerably well below the RBI's 4% target. But to for us to hear her expert insights, let's actually quickly go to Rajni Sinha, Chief Economist at Care Ratings, for a little bit more on these numbers. Hi Rajni, thank you so much for taking time out to speak to us today.
Hi Pallavi, one small correction. Rajni Thakur from L&T Finance.
Apologies. So tell us what you're making of today's print.
Sure. So as you mentioned, quite unexpected line, and broad message is that inflationary backdrop remains very comforting at this point of time. Given that there are so many other headwinds to the economy, I think it's very comforting both to the central bank and to us economists that the inflationary conditions remain benign. The food inflation I'm reading on your screen seems to be very, very soft. The other commodity prices have generally been softer as well through the month of August, and they do seem to be continuing on softer trend in September so far as well. So benign, overall benign inflationary backdrop. We expect it to continue for much of the remaining of the fiscal year as well.
Okay, I do want to understand from you, when do we expect to see the benefits seeping in from the GST rationalization, and what is the expected sort of decline from these changes that you expect to see in the CPI headline print?
So for some of the sectors like automotive, for example, we've already seen some price cuts being starting to come in, and it will likely follow in other sectors as well. The base simulation tells you that anything between 50 to 75 basis point impact on inflation is potentially possible. We'll of course get to know as we see it kind of working through the numbers, particularly consumption numbers, but potentially any base case 0.5% of inflationary benefit from GST cut as well, overall for the economy.
Okay, and how do these figures change the trajectory of monetary policy, if at all? In the last MPC resolution as well, the RBI did say that the inflation trajectory has been a little more benign than was expected up until a few months back, and that's a confluence of factors, right? The southwest monsoons, the trajectory of the southwest monsoons, and of course post that in recent days we've also seen the GST rate rationalization coming up. Do you think that does open space for another rate cut?
No, I mean, onto the drivers first, you're right. The biggest driving force has been the fact that monsoons have been very supportive. I mean, 91% of the country has seen normal or above normal monsoons, and that helps a lot in terms of keeping food prices within range. And, they do tend to get very volatile. Does that open up space for central bank to cut more? That's a slightly more complicated story because we will also need to worry on an overall economy front in terms of capital flows. So there is incremental space now with lower inflationary print. But having said that, we don't expect more than 125 basis point cut in the current cycle to play out.
Okay, all right. Rajni, one last question before we can let you go. While we do continue to see some comfort on the inflation print, I do want to ask you what you're making of other high-frequency indicators. Now, we are at a critical juncture in the economy, just, given the benefits, of course, that we are likely to see unfold over the next few months from the GST rate rationalization. But on the other hand, of course, the volatility from the US tariffs continues. How are other high-frequency indicators panning out, and what do you think is the trajectory going forward?
No, high-frequency indicator is a mixed picture. The rural consumption indicators are running very, very robust, much above their long-term trend levels. The urban consumption indicators have started picking up as well in last couple of months. On the production side, we see a very mixed trend at this point of time. We've not past the point where we can say that we've seen pickup in production side, but hopefully the GST rationalization should help pick production indicators as well. So overall, I think the economy is showing resilience. Broadly, the 6.5% kind of an base outlook for the economic growth for year stays intact, and we might potentially have some upside as well as GST impact starts to show in the consumption indicators.
All right, Rajni, thank you so much for taking time out. Always a pleasure to speak to you.
Thanks, by the way.
So, Sanjana, again, while we are seeing a little bit of an uptick on the inflation front compared to some of the figures we've been used to seeing the past few months, let's remember in perspective that this one too continues to remain well below the RBI's target of 4%.
Right. Pallavi, thank you so much for that very comprehensive update. Like you rightly said, the August CPI inflation reading indicating a modest rise in general price level of consumer goods and services compared to previous months, but not off the estimates. Let's move on now to another crucial event taking place, which is the SEBI's board meeting. Currently underway with several key reforms on the table. What's on the agenda? What are the market's expectations? Charu now joining us with the latest updates and insights. Charu, over to you.
So, first of all, on June 10th, NDTV Profit reported that SEBI had conducted pump and dump related raids on several entities in several locations. Sprite Agro was the Ahmedabad-based entity that was under the SEBI scanner because of a lot of suspicious stock related activities. Also in pump and dump related cases, but also in relation to rights issue, bonus issue, stock splits and much more. Now, the regulator was on its way to release an interim order and had prepared directions. However, they sort of got stuck in the regulatory hurdles. But before the orders or the directions could come out, the company announced on the exchanges that it is going to go forward with a bonus issue of 10:1. We must keep in mind that it is a penny stock that is valued at less than ₹2 currently, and it is also talking about considering dividend payout of 100%. This is when NDTV Profit again reported on September 10th that despite SEBI scrutiny, the company is considering going ahead with a bonus issue and a dividend payout. Now, after this, for the first time, we are seeing a regulatory action of sorts where, the Bombay Stock Exchange in its capacity as the frontline regulator has come out with something that informs the investors about the risks associated with this listed entity and that the investors should be cautioned against trading in this script, especially based on the online recommendations from Telegram, WhatsApp and other channels.
Thanks for that, Charu. And let's move on to what's happening in Nepal and the kind of impact that it's having in India and its businesses. The political turmoil in Nepal is increasingly impacting India's business environment. Rising protests and supply chain challenges are affecting companies that are connected to Nepal, looking at FMCG giants like Dabur and ITC, which operate factories and serve markets there. How significant is the fallout? What does it mean for their earnings? Let me quickly go across to my colleague Mahima, who has a detailed report on this. Mahima, over to you.
As you rightly mentioned, Dabur, Britannia as well as ITC do have their manufacturing facilities in Bangladesh, and Britannia has, as per a PTI report, Britannia has currently temporarily halted also production in Nepal right now. In terms of the companies that possibly have market share in Nepal, includes Dabur, Britannia, Marico, Patanjali, ITC, HUL, etc. Dabur, ITC, of course, through its Surya Nepal subsidiary has manufacturing facility. Even Bikaji Foods recently entered into a JV with Chaudhary Group for their snacking business. Reliance Consumer also has partnership with Chaudhary Group in Nepal. Campa Cola also has recently entered into the Nepal markets. Varun Beverages, around 3% of their consolidated revenue comes from Nepal. For Dabur, it's almost 8% of their FY25 sales that comes from Nepal. For ITC, around 3% in FY25 came from Nepal. For Berger Paints, around 2% came from Nepal in FY25. Asian Paints, Kansai Nerolac, HUL, around 1% of FY25 sales, and Britannia and Nestle sub that 1% mark. So all of these companies, though less in terms of percentage, most affected should be probably Dabur out of all of these names, but might see a temporary halting of manufacturing facilities for these companies, and probably some disruption in terms of where the revenues also stand.
Thanks for that, Mahima. One can hope that this turmoil ends soon so that things can go back to normal with regards to the supply chain. Let's move on now. In an exclusive update, sources are revealing that Blackstone-backed PAG is back in the market to sell its 54% stake in Nuvama Wealth Management. Previous conversations with bidders faltered due to valuation gaps, but PAG is now targeting over 4,000 crore and is focusing solely on international buyers. My colleague Agni now joining in with more details. Agni, give us a sense of what your sources are saying about the latest developments.
So Nuvama's stake, which is held by PAG, which is around 54%, now it's likely to be going on to a fresh round of bids, because the bidders who were in the previous round are apparently not offering enough, are not putting enough on the table, which is likely to convince PAG. Now remember, PAG had bought the stake in 2021 for around 2,400 crore, and the stake at market price right now stands at roughly over 12,000 crore rupees, but PAG is offering its stake at a deep discount. What's being told to us is that the stake is being offered for over 4,000 crore, and despite this deep discount, there are no buyers who want to accept it. Now there were some speculations about the deal slowing down because of the presence of the Jane Street overhang on Nuvama. Analysts expect an 8% hit on Nuvama's earnings because of the dry down of the Jane Street revenue. But remember that sources tell us that because the deal is being placed at such a deep discount, the Jane Street factor is unlikely to affect anything going forward. However, no binding agreements have been signed, and standard disclosures, anything can change going forward. The deal size, of course, is likely to change, and PAG is looking at international buyers primarily so that it can call for a better, higher valuation. But this is a developing story. We have reached out to all the stakeholders mentioned in the copy, so do stay tuned for more updates.
Thanks for that, Agni. We'll continue tracking this extremely crucial deal. Meanwhile, let's take a look at what's happening between India and the United States. Sergio Gore was confirmed as the US ambassador designate to India in a Senate hearing that underscored the high importance that the US actually places on India, not only as a key trade partner, but also as a trusted geopolitical ally. Several senators, along with US Secretary of State Marco Rubio and Gore himself, highlighted India's vital role in shaping the future of the Indo-Pacific region and beyond. Now, Rubio emphasized that India ranks among America's top global relationships, crucial for regional stability and strategic cooperation. Gore stressed the strong personal relationship between Presidents Trump and Modi and expressed optimism that a trade deal between the two countries is imminent, signaling renewed warmth in bilateral ties despite recent tensions.
We're actively negotiating with the Indians right now. In fact, the president has invited their commerce and their trade ministers to come visit us next week, and they'll be meeting with Ambassador Greer here in Washington. Part of that will include a hopeful deal. We're not that far apart right now on a deal. In fact, they're negotiating the nitty-gritty of a deal. Secondly, look, we hold our friends to a different standard. Frankly, we expect more from India than we do sometimes from other nations. I do think it will get resolved over the next few weeks. And finally, we commend you and the chairman. You're both co-sponsors of Senator Lindsey Graham's bill, which seeks to impose 500% tariffs. So the president has imposed 25% tariffs. The bill that almost every single member of this committee is a co-sponsor of goes much higher. So I think we're all in agreement on that.
The 21st century, the story is going to be written in the Indo-Pacific. In fact, it's so important we've actually changed the name of the combatant command to the Indo-Pacific. India is at the core of that. And we are in a period of extraordinary transition in that relationship with India. We've got some really important issues coming up that we need to work with them on and work through on that implicate what's happening from Ukraine, but also implicate what's happening in the region. It is my view, I hope it'll be your view, that it is important that the United States be represented at that post with someone who has the direct ear and confidence of the President of the United States.
How do you balance, should you be confirmed, how do you balance, being tough on India where we need to be tough, whether it's tariffs or markets not open to U.S. products, but also being mindful of the notion that the U.S.-India relationship has been a very important one, the world's oldest democracy, the world's largest democracy. And it's not only been important for the two nations, but it's also been important in the Indo-Pacific region as a little bit of a check against China sort of writing the rules for everybody. So how do we be tough when we need to be, but balance that with a real understanding that we want to be close to India and we don't want to push them in the wrong direction.
Meanwhile, panic gripped the Delhi and Bombay High Courts today after both received bomb threats via email, prompting immediate evacuations and thorough security sweeps. In Delhi, judges of the High Court arose abruptly from their benches after a threat email was reported by Registrar General Arun Bharadwaj at 10:45 a.m. this morning. This prompted immediate suspension of all court proceedings. Soon after, a bomb disposal squad arrived at the High Court premises to carry out checks. Now, just a few hours later, similar panic hit the Bombay High Court. An anonymous email warned of a bomb inside the premises. Security teams evacuated the entire building, and now bomb squads and police teams are continuing intensive search operations while a heavy security cordon remains in place. This is also the second such scare just this month in Mumbai, with threats of human bombs being received during the Ganpati festival earlier. Meanwhile, CP Radhakrishnan was sworn in today as the 15th Vice President of India at the Rashtrapati Bhavan in New Delhi. President Draupadi Murmu administered the oath in the presence of senior leaders and dignitaries. Prime Minister Modi, former Vice Presidents Jagdeep Dhankar and Venkaiah Naidu, former President Ramnath Kovind attended the event. Also present were key union ministers and chief ministers like Amit Shah, Rajnath Singh, Eknath Shinde and Chandrababu Naidu that attended. Radhakrishnan, the NDA nominee, was elected on 9th of September with 452 votes, defeating opposition candidate and former Supreme Court Judge B. Sudarshan Reddy, who polled 300. This comes after his predecessor, Jagdeep Dhankar, had stepped down in July, more than 2 years before the end of his term. And initially in 2015 and then again in 2022, the co-location scandal hit NSE hard. Top management had gone to jail and people were beginning to lose faith in the exchange. However, Ashish Kumar Chauhan stepped in despite his family strongly urging him not to. Alone at IIT, barely able to speak English, and listen in now to find out how Ashish Chauhan, almost on his way to monkhood, at some point became NSE's current MD and CEO. And don't forget to catch the full conversation at 9 p.m. only on NDTV's Disruptors.
Tell me about that time when you came back and how you had to rebuild the reputation after the co-location scam. That must have been a tough phase.
No, it was. In fact, when I was working for BSC for 13 years, first 3 years as deputy CEO, then 10 years as a CEO, and I was retiring because there was a new regulation taken to ensure that nobody can work as CEO in any exchange for more than 10 years. And so I was retiring there, and then one more leg of the scandal broke, although the scandal broke in 2015. But I think 22, there was another sort of a situation which came about, invisible yogi and other things. And two of my predecessors, who were also founders with me in NSE, they went to jail. And so it was a tough time for the organization. It was also losing credibility in terms of the technology not working out, and also many other things. And even government was feeling that this can create an issue, because it's a fulcrum on which any modern nation works. The stock exchange is a very important organization. And to maintain that trust of people, it's very ephemeral, you know.
So you got the call.
And so I got the opportunity, I would say, to come back. And then my wife was against it. My child was against it. Even he's now adult. He was becoming adult that time. And my sister called up from US saying, why are you going for working in that place where people are going to jail and you have enough money? Why are you trying to even work? And in that I said, no, I've started this exchange. It has done India so good. And if India has to grow well over next 30, 50, 100 years, it'll grow on the back of NSEs.
Tell me about the aspiration to live a spiritual life, and then if you become a monk, then you are actually giving up on a lot of things in the world. Tell me about that thought and that phase in your life. Was it as a young child?
Yeah, I was very young, probably 7, 8 years old, and up to, I think, around 15, 16-year-old. I mean, I was a bright student. Without studies, I could get good marks. But broadly, I was also into playing cricket, reading up things, but also into religion. And my family was broadly of the opinion that I'm going to become a monk. I was also of the opinion that I will become a monk. But then by quirk of fate, I got into IIT. And so that changed life. I came to IIT, and then I was like lonely, did not know English. And so I was going to go back, and I got admissions there as a medical student also. I did one day for medicine studies also, one day in the local engineering college in Ahmedabad, and then came back saying, okay, might as well, if I have to study in English everywhere, might as well go back to IIT.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
We see the problems, but you as a social entrepreneur see the solutions. You are not just creating solution, you are creating a future where everyone has a chance to thrive. For the change makers, the innovators, the ones building a better world, one solution at a time. The Adani Green Talk Social Impact Awards are created for you, inviting social entrepreneurs to apply. Green Talk Social Impact Awards 2025, where innovation meets impact.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Mahima Vajrajani, and today we're going to again continue to look more domestic. And when you look domestic, hotels is one sector which seems to be on an uptrend. We had one of the managements come through a couple of days back when we spoke, and they said that H2, and this is Chalet actually, now that I remember, they said H2 is going to be extremely strong. H1 was slightly subdued due to various factors, including the India-Pakistan conflict of sorts that played out, and the monsoons in certain geographies have been tough. If I recall, those were the reasons he gave, and therefore, one is of course the GST benefit, and we're going to be speaking with the Royal Orchid Hotel group today. One is of course the GST benefit and how that impacts both occupancy in their opinion, and other income, because you will have more people coming into restaurants and more people utilizing hotel spaces. So hopefully we'll get a sense of what this does in terms of numbers exactly and demand. The second piece, and I did mention this, occupancy trends for Q1 FY26, of course we'll analyze that, but what about H2 and what is Q2 looking like? We'll just get a sense of that as well. And with this GST rate cut, likely there will be a push with regard to that as well. Let me talk about the third piece. They are planning to triple their hotel count. 350 hotels is what they plan to set up. Currently they are at maybe 118 odd hotels, and therefore there's a very, very strong growth pipeline in terms of the hotels that they are going to be putting up. How are they going to be funding this? And is it just going to be management contracts, or is it going to be how many are going to be owned and how many are going to be managed? So that's the number 4 point actually. Let's pull that one up as well. Owned versus managed, what's that ratio going to be like at 350 when they get there? And this is a target they've given by FY30. The fifth piece is with regard to margins. Now margins have fallen, and that's because the fixed cost has gone up. And typically when the fixed cost goes up, you'll hit a certain scale with that same level of fixed cost, and therefore I want to understand what the margin upside is. The guidance is FY27 will start to see margin accretion, but how much scope is there for that margin improvement is what I want to know. And the last piece is with regard to FY26 cash PAT guidance. They've said that cash profitability is going to be at 70 crore in FY26. Now, while that is very healthy, my sense is that they've already done that trailing 12 months at the end of Q1. And if Q2 is strong with GST and with H2 is strong, I beg your pardon, and plus you have that GST lever which will give it additional tailwind, can there be an upside to that guidance? And therefore, where do they invest that capital? So all of that is what we'll try to dissect, and of course, we'll first start with about the company. Mahima, you want to start with that?
Sure. So basically, as Harsh mentioned, it operates and manages hotels, resort as well as hospitality services, focuses mainly India, small presence in Nepal as well as Sri Lanka. The company follows asset-light model, plans to triple its size when it comes to 2030. The target right now market is business, leisure, weddings and special interest guests. In terms of where the brands are concerned for this particular counter, it includes Regenta, which is mid-scale value hotel, largest in terms of network. Then we have Royal Orchid, of course, which is focused more towards luxury properties, flagship of 5-star luxury properties. Iconica, now this is new upscale lifestyle hotel that they have in their portfolio, the first one in Mumbai, of course. And then Regenta Palace, Regenta Z and Crestoria. These are the three ones. Each caters to different segments, that is youth, boutique as well as budget hotel. So this is the entire brand portfolio that Royal Orchid has under its name. In terms of the product mix, well, roughly 55% plus of their overall breakup is the room stays, that is the room rent comes into this part. Then around 33% is F&B and others is around 12%. In terms of the operating models, owned is a very small number for them. In terms of the other services, of course, that includes your banquets, event, weddings, loyalty programs, etc. With regards to where the operating models are concerned, owned hotels, like I said, is a small number. Flagship hotels, example Bangalore, that basically means that's a very small number. But in terms of the leased and revenue share, that pays fixed rising lease, enjoys higher share in profit. So that's the managed and leased part that Harsh is talking about, leased part that Harsh is talking about. And then managed and franchisee. Now this earns management fees or franchisee fees. So this helps hotels grow because it's low in capital and low in risk as well. But the growth coming in as a part of management fees helps a lot in terms of, and plus not capex heavy, right? So that helps company earn in a better way. So that's with regards to where the operating models are concerned with regards to where Royal Orchid stands. So this is the overall view.
So I just want to understand this slightly better. So one is you own the hotel itself.
Yes.
So you own the land, you build the hotel. So that's high capex. The second way of doing this is someone else owns the land, someone else owns the hotel, and you run it for them, which is managed. And then the third way of doing this is someone else owns the land, someone else owns the hotel, you pay them a lease and you take over the hotel. Correct. Is that the right way to think of it? And in terms of the managed hotel side of things, it is their brand.
Correct.
And they earn a franchisee fee on it.
Management fee, correct.
And they determine the quality of the service and the manner in which the service is provided
so
to the
that the
customers.
brand name is maintained, yes.
And they provide a platform for customers to come in and book rooms as well.
Correct.
Okay, anything else with regard to
I think
understanding
this sums it up, right? This sums up the entire model. And I think a lot of hotels right now, just to give viewer a perspective, moving towards that asset-light model because that helps them not to invest much because that requires funding as well, debt, equity, whatever. And at the same time, doing capex right now for a lot of companies may not be the right way to expand as well. So asset-light is the way a lot of people are going. Hotels are going.
Well, yes, that is the new terminology in the hotels business, asset light. And they don't own it, but they do ensure that it is being run far more efficiently than a typical hotel does. But just the tailwind of growth, right? Let's talk about all of the metrics that we'll be discussing today with regard to our Royal Orchid. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding, the street cred. We don't have any street coverage. But so therefore we'll do outlook and thereafter we'll look at the valuations and how that stacks up. Mahima, income statement.
Right. So, healthy financials when it comes to the income statement as well. If we take a look at the 3-year CAGR of how the revenue has grown, it's been a CAGR of 32% in the past 3 years. EBITDA has grown at the CAGR of 34%. Even in terms of margins though, have come off a tad bit versus where they were in FY23 at 35%, FY24 at 30% to 28% in FY25. We'll have to, ask the management as to what the margin trajectory from here on looks like. In terms of net profit, the CAGR has been around 17%. Not matching the way EBITDA has grown, of course, but has grown at a steady state. With regards to where Q1 numbers stand and how YY numbers have stacked up in terms of Q1 FY26, overall revenue has seen a growth of around 8%, EBITDA a growth of 18%, and net profit a growth of around 22%. Now, in terms of how the revenue breakup stands, room rent is around 50%. This is as per the Q1 numbers. 50%, F&B around 34%, and others is around 16%. In terms of the overall operational metrics, average occupancy for JLO hotels was around 69%. The average room rate stood around 5488. So the GST that we've been talking about, right? The GST on hotels is an interesting one because the hotel industry was not expecting a 5% rate without ITC on room rate below that 7,500 mark.
But that's optional.
That's optional. And if you want to go for ITC, you'll have to pay GST at 12% and get ITC below that 7,500 rate hotels. And probably, their portfolio, we'll have to ask them as to how much of their portfolio falls in that range and what option they would want to go for. So that's with regards to the GST.
That's something else we want to know.
That's something else we want to know. So that's with regards to where GST peg stands. And overall, I think in terms of where the income statement performance stand, it's been a good growth for the company. We've just given it a neutral rating, considering first thing the GST into consideration, and secondly margins picture. Where we'll have to get an idea as to how the trajectory from here on looks like for the company.
The profit growth hasn't been commensurate to the top line growth. 30%
with regards to the EBITDA growth
is very good.
Correct.
But the profit growth hasn't really translated in that sense. I'm not okay. So that's the way we look at it. Let's look at the balance sheet now, and in the balance sheet, let's look at first off the total equity capital. It's around 230 odd crore. Mind you, it's a 1400 crore market cap company. So that's your price to book. Therefore, the borrowing number stands at around 100 crore, and this includes short-term plus long-term borrowings. Excludes lease liabilities. This is not a number we've picked up from the presentation. This is a number we've picked up straight from the financial statements. So this might be different versus the number in the presentation that you'll see. The cash bank balances look fairly healthy and allows for a bit of expansion. And at the same time, it's also a cash generating company, because typically if you're in the hotel business, you will first generate cash and thereafter you'll see occupancy. So broadly, it's there's no concern with regard to that cash balance also sitting in, versus the total book value also looks fairly healthy. So we've given this a thumbs up. Cash flow, Mahima.
Right. So in terms of cash flow from operations, overall, if we take a look at how past 3 years have panned, and earlier also we were discussing as to how this should be ideally analyzed, and Harsh and I were talking about it as to the ratio of cash flow from operation to PAT, and that has been kind of decreasing, but still at a healthy rate of around 53%. So it's not at all concerning as to where this particular ratio is concerned. So the overall revenue, the cash from operations is getting translated. The PAT number has remained.
That is the way in which the business works, Mahima, because it's a hotel business. Typically, you will first have bookings coming through, and thereafter you will have your guests coming through.
Correct.
And therefore, no surprise that the CFO to PAT is positive. I believe they've been making certain investments from the revenue expense.
Correct.
To a certain extent, which for the hotels that they've been taking over as well, because they need to refurbish those. For example, they've recently taken over a hotel and they've done a 15 crore rupee OPEX on that hotel to try and refurbish it. And those expenses also kind of get built into this. But for the moment, the overall cash flow from operations to PAT looks fairly healthy, and therefore we've given this a thumbs up. Let's look at return ratios. Okay, so let's pull those up, and what you'll see is they've been fairly healthy. See, FY21 was a tough year, understandably, it was COVID. FY22 also was a fairly tough year because we were just bouncing back from COVID. The second wave of COVID was in Q1, if you remember. But FY23 onwards, they've been fairly good in terms of where the ROCE is concerned. You'd want to see whether this can sustain, and if margins will go up, you'll inevitably see ROCE go up, but you want to keep your eye out on the C part of ROCE, which is the capex that they do, and therefore, can they continue to maintain this ROCE? Well, currently at 17%, looks fairly healthy, does not seem to be much of a concern. But the shareholding pattern, Mahima.
Right, so it's a well-held company, Harsh, for sure. I mean, the promoter holding has remained stable, 63.6, 63.7, 63.8%. Even FIs has slightly increased their stake, in the past 3 odd years. It's gone to around 7.72% as of June 2025. DIs, well, they don't hold much in this particular counter, but public holding has also, fairly remained in that 27 to 29% range, currently at 27.6% range. But it's a well-held company, and that's why we've given it a thumbs up.
Okay, let's talk about the street cred. And within street cred, if you look at the near-term numbers, fairly solid in terms of returns. It's been a 7-bagger plus over the last 5 years. So even those returns fairly healthy from the COVID lows. Of course, that's something to be factored. But again, fairly healthy. No complaints there from a short-term or a long-term perspective. We've given that a thumbs up. Mahima, I'll request you to cover both valuations as well as outlook.
Right, so valuations, as compared to peers is looking attractive right now, because if you consider something like a Lemon Tree, EIH or Indian Hotels, they're trading at what, 58 times, 70 times, EIH at 33 times. But something like a Taj GVK is slightly cheaper than Royal Orchid at 23.7 times, but Royal Orchid trading at 31.8 times versus its peers. So we've taken a conservative approach here, giving it a neutral rating, because as compared to peers, it's it looks cheaper, but overall 31.8 times, it's not cheap when it comes to valuation, and that's why we've given a neutral rating when it comes to valuations. Lastly, in terms of the Vision 2030 and the growth strategy that the company has outlined, they plan to triple their hotels by 2030, growing keys to almost 22,000. The FY26 cash profit that Harsh talked about at the start of the show will grow to around 70 odd crores is what they've aimed at in FY26 and 75 crores in FY27. Overall outlook seems very positive when it comes to this particular counter, and that's why we've given it a thumbs up when it comes to the overall outlook and guidance given by the management.
Okay, all right. So that if I stack up all the valuations, that gives it a very healthy 6.5 on 8 in terms of the KYC rating. If I stack up all of the metrics. Now let me go across. We have Mr. Amit Jaiswal, the CFO of Royal Orchid Hotels, joining us live at this point. Mr. Jaiswal, hi, good morning. This is Harsh here. I want to first start off by understanding from you what component of your top line is 7,500 and below, because that's where a large part of the benefit lies, as Mahima was pointing out to viewers. What part of it is in that category? And also give us a perspective on what you're expecting in terms of a demand push as a result of purely this GST piece playing out. What's the likelihood?
See, if you look at our ARRs, we are averaging around 6,000. So that you can make out that almost 85% of our company's rooms are being sold at less than 7,500. It's only in some of the high-end hotel, wherein the suite rooms and all are sold at above 7,500, and maybe in some seasons, like in Goa, November, December, we sell at a higher ADR, the rooms and all. So fairly largely, if you look at it, 85% of our revenue is below 7,500 ARR. So we will have to change the GST accordingly. Okay, and as far as the effect of GST, definitely it is a booster. The foreign traffic, we have become competitive to all our neighboring countries with this GST rate, that is Thailand, Sri Lanka, Vietnam, Dubai, and other Sri Lanka and all like that, all these companies where the GST rates are little lesser. Earlier we were at 12% and 18%, whereas they all were between 7 to 10%. So we have become competitive. So there will be a growth in the revenues as well as the occupancies overall basis. Yeah.
Okay, Mr. Jaiswal, hi, Mahima also joining in. Just want to get a sense, because now we have two slabs, right? 5% without ITC and 12% with ITC below that 7,500 mark. Just want to understand what is more beneficial for a company like you, because if you have ITC at a higher rate, then giving output GST at 5% without ITC will not be beneficial. So just want to understand that part of business.
You're right, Mahima. See, if you really look at the financials, then definitely without ITC will not work very favorable as far as the financials are concerned. But as I said, if this drives traffic, if my occupancy, suppose I'm at 70%, it goes to, another 5-6% growth I'll get in the occupancy, then definitely it will overall, in the scheme of affairs, it will affect. But directly, if you really look at it, as most of our hotels are under revenue share model, wherein we pay the lease rent on which 18% GST is there. So we will have a issue if we don't get the ITC. But I think overall perspective, if you really look at it, it will boost the overall revenue and the occupancies. That's where we have to encash.
Right. Sir, talk to us about how Q1 and broadly tell us how trends in Q2 have been. So we'll talk near term first, and thereafter we'll zoom out a little bit, talk about FY30 and how you get there. But just in the near term, in FY26, you've guided for a 70 crore cash profit. You've done that on a trailing 12-month basis at the end of Q1. Just wanting to understand, does this give you comfort to up your guidance, if at all? And how is Q2 going to likely be? Or even if you can't talk about Q2, talk to us about H2. Is it going to be extremely strong given GST? And therefore, would you be tempted to up your guidance?
See, as far as the Q1 numbers are there already, we have posted a good profit. We have been able to work on our cost. See, we invested in last year, our costs were a little high. Now that we have controlled it with all our investment over. So I see the numbers, if you really look at the revenue numbers, it may grow in a, 8%, 9%, but our profit numbers will definitely grow. And as far as H1 is concerned, H1 till now it is good. Okay. And H2 looks very good. We have a lot of bookings on the card and the hotels are doing well. However, the Goa market is little sluggish. The Goa market has been sluggish because of several other outside issues which are prevalent in Goa right now. However, overall, the company is bound to go do well in this financial year, and definitely the cash profit is helping us in growing more leased models.
So you spoke about Goa. Can I also push you to talk about Nepal? What's happening there?
See, Nepal is in a turmoil right now. All the travels are, I think, it's standstill with so many local issues there, and also Nepal is having a very, very bad. In fact, all our neighboring countries in the last couple of years, if you see, had a lot of issues. Whether it is Pakistan, Bangladesh, Sri Lanka, everywhere, and Nepal also now has touched the same thing, and so the travel to Nepal right now is ruled out from India.
Okay, Mr. Jaiswal, you planned to triple your keys by FY2030. Just want to understand as to how the funding will be done for these expansions, and what will be the ratio between these hotels between owned and managed?
Yeah. So if you really look at our presentation, which we have, it's there in the public domain, we are not going to own any hotel from here till next 5 years. The route to develop our group is only through two patterns. One is the flexi lease, which we call revenue share model, and another is management. Now in management, we don't need to invest a single rupee. There's no investment as far as the management business is concerned, and 80% of our growth will come from that route only. Now 20% we are targeting, the growth is to come from the flexi lease revenue share model, wherein there will be investment, but the investment is very, very minimal. Like hypothetically, if you really look at it, 80-room hotel, if we take it on lease, we give some 6 months deposit, which is around 1.5-2 crore rupees, and some working capital 3-4 crores we need for doing that hotel. So for that, I don't think we need a lot of money. Funding is not required because we are generating cash. Our financials are quite very strong, and we are generating internal cash. With that, we will do, and maybe a little bit if something is required, then we'll look at that particular opportunity. That we have just now opened our hotel in Mumbai, that is the Iconica, where we have invested some 20 crore rupees. and we had to borrow from the bank to do that. But that hotel is going to give a big boost to our overall scheme of affairs and the revenues as well as the profit.
So you're sitting on 60 crore of cash. You will generate around 70 crore of cash profit this year. And thereafter, my assumption is it will only go higher. In fact, the sense is that you'll likely beat that number already in FY26. What do you do then with the cash, sir? Where is it that you're...
No, that's what I told you, that when we do a leased model, we need to invest some money there.
Okay. Yeah, I understand that, sir. But that's a smaller component.
Depends on the size of the hotel. Like if it's 80-room property, around 7-8 crores we need to do that hotel.
Okay.
And our payback period is 2 years.
Got it. And therefore, how does the debt picture evolve, in your opinion?
Debt will revolve around this much. Right now, we are at around 90 crores debt overall of the company. So the debt will remain the same because, if we get some good opportunity of long leases, wherein we need to put some 10-20 crores, we would like to put it with the repayment. Whatever we repay, we will again involve that and, put that money in the... See, because Iconica is it's an upscale brand which we have just launched, and we are planning to do 8 Iconicas in next 5 years. So every Iconica will need some 10-20 crores, but we are not going to borrow too much from anybody.
Mr. Jaiswal, quick question on margins. What is the trajectory looking like, especially from here on, because you'll not be doing a lot of capex, but you'll be adding a lot of keys. So that should flow into margins as well. What do you think? 2 or 3 years down the line, you'll be able to come back to where you were, around 30-32% in that range?
No, please understand, Mahima, please try to understand. Our model of business is management and as well as leases. So the margins the percentage of the margin in leases is lesser than owned hotel. See, owned hotel typically earns around 40%, 45%. But whereas this leased and the revenue share model, which we are doing, wherein we are not putting a lot of capex. So there the margins are much lesser because we need to pay out from our margin the lease rent to the owners. Okay. So after that, the left out percentage margin is less, but overall, our absolute number is going to grow in a big way in next 5 years. Our ROC, the most important factor of raw locket is the ROC. We are having a very strong ROC, which is hovering around 20%, which we want to take it to 25%. That's the model we have built.
How quickly do you get there, sir? Timing. Sorry, I just have 30 seconds.
Yeah. Come again?
How quickly do you get there? 25% ROC.
No, that's what I'm telling you. With lesser capex, I'm doing more hotels.
Fair.
So, and the margins which will come, it will improve my overall ROC.
Understood. How quickly do you get to 25%?
Come again?
How quickly do you get to 25% ROC?
5 years. That's the time we are putting. 3.5 years, we should be able to touch and maintain it for 5 years.
Understood. Okay.
We have made for 5 years.
Wonderful. Thank you so much, Mr. Jaiswal, for coming in and speaking to us. Well, that's all the time we have on KYC today. KYC only on NDTV Profit. Thanks so much for watching. From Mahima, myself, and the entire team that puts this show together. NDTV Profit. Continue to watch us. It's for your profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
isn't a good investment. It doesn't yield anything. And if you're buying jewelry, it's just meant to make you look good. Meanwhile, gold in 2025 has beaten all other asset classes hollow. In dollar terms, gold prices are up nearly 38% last I checked. And if you thought that was crazy, just take a look at silver prices. After lagging behind gold for some time, it has now notched a 40+% return so far in 2025. Why is this happening? What's leading to the rise of gold prices and silver at that? Is it a good idea to invest at these levels? These are important questions to ask ahead of the festive season, but at any other point of time in the year as well. Because if gold and silver are too costly, how should you diversify your portfolio? I'm joined on Moneywise today by Kirtan Shah, the founder and chief executive officer of Truvanta Wealth. Thanks so much, Kirtan, for taking the time.
Alex, thank you so much for having me.
So I was reading a few data points, very interestingly, right? Where you're talking about the central banks of India, Russia, and China having bought so much gold over the course of the last several years in the process of de-dollarization. You talk about foreign banks that are buying gold consistently. In fact, foreign banks owning more gold than they own treasuries for the first time since 1996. And all of this points to the fact that gold is a hot commodity. It's unlikely to go away. Is that what's causing the rise?
I think, Alex, if the genesis of this, in my opinion, at least in this part of the economic started, in my opinion, when the Russia and the Ukraine war set off. So what happened is US, for all known reasons, did not actually want Russia to continue with the war. And Russia, for whatever reason, did not agree to what US wanted. And which is why US did something that has actually led to what you see happen today. US actually sanctioned some $430 billion worth of Russian investment in the US treasuries, right? That actually got most other central banks to start thinking that tomorrow, if you don't ally with what US has to say, they will kind of freeze the asset in which you've invested, which is the US dollar, right? And which is why I think most central banks globally, since that point on, started deciding that they will want to reduce US treasuries and add more gold to the treasury portfolio, right? You actually also saw our finance minister say this a couple of days back, saying that it's a very prudent judgment that the RBI is taking to reduce US treasuries and add more gold to the portfolio. In fact, if you look, last year, first half, some 483 tons of gold was accumulated by central banks globally, which was a record. In fact, till the time of recording, the first half of this particular year, 2025, we have 420 odd tons of gold already bought by central banks in this first half of 2025 at $3,000 plus levels, which is huge, crazy, right? Another data, if I can share, in the first quarter, right, you've seen, like you rightly pointed out, in the last 3 decades, the first time that US treasuries are down 2% as forex reserves by central banks globally, and gold is now the second largest held treasury at 24% of the total treasury. There is definitely a clear sign post the Russia-Ukraine war and sanction by the US on Russian assets that de-dollarization is pretty serious, and central banks are looking at seriously accumulating gold, which is, in my opinion, a big reason why we've seen what is happening to gold.
So just hypothetically speaking, and I was looking at the quantum of gold, and there are some interesting statistics out there. If you were to try and visualize it, Kirtan, and I always find this fascinating, right? If you imagine a cube of gold, of all the gold in the world, it would be a cube that has, it's basically 70 feet in either direction, right? So you could actually fit it, relatively speaking, in any place, in a large stadium in Mumbai.
Yeah.
And there's only about 3,500, 4,000 tons of gold that is newly mined every year. So we're not really adding to the amount that much. And you've just pointed out, just central banks are buying 400, 500 tons in half a year.
Correct.
Just demand supply should tell you that prices are going to keep going up.
I don't see a reason why central bank in the near future at any point in time will slow down, because de-dollarization, in my opinion, is becoming a very, very, very serious data point. Because the strength of the US is actually that the world trades in the US dollar, and dollar is a reserve currency. The only way you really can challenge US as a superpower, at least the way I look at it, is making the dollar weak, right? And I think everybody globally, and specifically the large BRIC nations like the Russia, China, and India, are probably trying their level best to, kind of make this a more level playing field. Because you would have lately also seen and heard of how our Prime Minister also has written to BRIC nations that, I want to trade with you all in the rupee, and we will transact and settle trade in rupee. China's been doing it. And I think everybody is trying to, kind of reduce the dependency on the US dollar and try and make their country slightly less reliant on dollar, because that's the only way you are going to be able to challenge the US, if I may even use that term. And understanding that I'm not saying it loosely, but the point is that dollar is the reason US drives its strength. And with what Trump has been doing, I think everybody globally is looking at this as a great opportunity to, kind of leverage and de-dollarize.
Yeah. So, and that throws up a lot of conversation points as well. And I'll circle back to the whole concept of gold and silver in your portfolio. But before that, since you spoke about dollar and since you spoke about currency, I'm just wondering whether this phenomenon that we've seen has any bearing on the direction of the depreciation of the Indian rupee, because that's something that we've almost taken for granted over the course of the last 30 years or so. Since the start of the century, you're talking about 3+% of depreciation against the dollar every year. If the dollar is to weaken going forward, then does that change the picture at all for the Indian rupee?
It does, definitely, but it's not going to be as straightforward or as easy as we make it sound here, right? Because like we said, still 42% of the central bank reserves is dollar. More than 60% of the world still trades in dollar. I think the only way this really can start working for rupee is reducing our reliance on importing energy, because that's where we largely end up spending our dollars. Because at the end of the day, this is the current account deficit problem, right? Unless your reliance on being able to hold dollars and import less does not reduce, you are always going to have faced this problem. So the only way we can really support the rupee is to make sure that we are able to export more than we import, which is where we are going to be dollar surplus. Again, reduce our reliance on energy, because that's the largest imported commodity where we give out dollars. And also try and increase as much as we can, invite foreigners to invest, right? That can be the capital markets through the FII route, or
which is not happening right now.
And investments in the company which are slightly more long term. But the core of the problem is always to make sure that your inflation is under check and you're growing at a steady pace. If the real returns are positive, I think largely your currency will be stable. But it's not going away anytime soon.
And not going away, and energy imports as well as gold imports, right? Because China and India are the largest consumers of gold. And ultimately that brings us back to the conversation, which is with prices where they are, and assuming, okay, the trajectory is indicating that it could go higher. Nobody knows what will happen in the next few months, but directionally you think that gold prices will go higher. So how do you place that in your portfolio? If you don't have exposure to gold right now, what should your approach be?
I think I've always believed that you should definitely have 10-15% of your portfolio as an exposure to gold for sure. Because if I can throw some data points where you look at the last 25 years of how gold has really been, only in the year of 2013 or 2015, if I'm not wrong, that was the only time you saw gold actually have a 19.1% drawdown. Except this, gold has hardly had any drawdowns in the last 25 years that you and I are talking about. Which means that gold actually brings in the diversification that you want in the portfolio, because your equity may move up and down, but gold still steadily holds the fort for you, right? And it's the best short-term diversification that your portfolio in general also wants, because in the near term, it's negatively correlated. So you want an asset to invest in when your equity portfolio falls that stays stable or goes up to balance your portfolio, right? And it's been able to do that with much lower volatility. So you look at the last 25 years, gold has generated the same kind of returns that equity has done, close to 13%. Now the argument may be that, we are talking at a point where the last 2 year gold returns are superlative.
Yes.
You remove the last 2 years and the remaining 20 to 23 years gold is still at 11% CAGR with much lower volatility than equity, right? And the same argument can be held true for equities also, right? If you remove the best performing years in equity, you will probably end up doing the same math that you will do in gold. So I think gold is a brilliant proposition. You should have 10-15% because in the short term, it brings in the diversification advantage, and in the long term with low volatility, it generates the same return like an equity does. No reason why you shouldn't have.
And we've spoken in a previous episode about the hedge against the dollar and the depreciation of the rupee, because ultimately you're buying an international asset. So there's that as well. But between gold and silver, do you have a preference? Would you at all buy silver? And the reason I ask is because early on the year, because gold prices went up as much as they did, silver hadn't gone up. And 60% they say, I know that there's no accurate representation of this, but 60% of demand for silver is through industrial use because it goes into so many electronics, etc., etc. And so therefore it could be more volatile than gold. So do you say buy silver?
I think that's a very interesting proposition. I would probably like to highlight 2 points that probably the investor community needs to hear through this conversation of ours. See, silver, like you rightly said, 50-60% of the silver demand is actually industrial. Two themes that have really played out globally very well over the last couple of years is EV and AI, right? And both have led the silver demand to go up significantly, right? Through AI, data centers and various other things have led the silver demand to go up. Through EV, again, solar panels, batteries, and all sort of things have actually led the industrial consumption of CV go up significantly, or silver go up significantly. It is as significant that over the last 4 consecutive years, the supply of silver has been much lower than demand of silver, right? And because of which silver's really gone up. But like you also rightly said, what you have to understand when you invest in silver is that silver, the larger part of silver rally largely depends on how good the industry is doing, right? So if the industry is doing very well, you will have consumption of silver go up, and hence the demand and the consumption, and hence the prices will go up, right? So if you're looking at trying to add a hedge to your portfolio, silver may not be a great hedge, right? Because let's say if
it'll move in tandem with equity.
Absolutely, right? So it doesn't bring in that advantage.
Interesting.
Also, another reason why I think silver's gone up is because technically, if you look at silver, silver is always pegged to dollar as a ratio.
Okay.
Right? You look at the last 25 years, and the average gold-silver ratio is anywhere between 65 to 85.
And it went to over 100.
Right. So what it means is 1 ounce of gold will be equal to either 65 ounces of silver or 85 ounces of silver. That's been the average for 25, 30 years. Today that you and I talk, it's 107.
Right.
Right? Which invariably tells you that silver is cheap.
Yeah.
Right?
Relatively speaking.
Relatively, right? And which is another reason why people who are finding gold to be extremely expensive are kind of buying into silver from a trade perspective. But please understand, all of this is very cyclical. Silver is extremely cyclical. There have been situations where silver has had drawdowns as high as 40-45% in a year, right? So when you are looking at it from a diversification standpoint, I don't really think that it solves the problem that gold really solves in your portfolio, because it's more cyclical, it's more volatile, right? And it in the short term does not hedge you against equity, which is probably the larger part of your portfolio as an aggressive investor. So I am more inclined towards having more gold in the portfolio because of the balance and the short term diversification, yet giving you equity kind of returns versus a silver.
So, okay. So therefore, if you have to take allocation to silver, is it more from a tactical point of view rather than a diversification angle?
Oh, 100%. I think if you are a professional and who understands investing, I think to a larger extent, silver definitely is a more tactical play than a strategic play. So gold is more strategic and silver is more tactical. But having said that, gold can also be a tactical play provided you know how to do it, because in the last 25 years, there have been 3 periods where gold once took 9 years and 2 times took 7 years to break the last high, right? Which means it gives you a lot of opportunity to be able to buy it and then, kind of try and outperform. But having said this, it's only for people who can actually know how to time and play the tactical play, right? But for retail investors who are probably more long-term in the investing thought process, gold is more strategic and silver is more tactical.
So how do you buy gold? Because ultimately I've had conversations with people who say, hey, you know what? Family's got a locker in the bank. It's lying there. I might as well buy physical gold. You get a certification from certain places if you buy a coin or whatever, bullion, and you can buy physical gold because you don't necessarily trust the e-gold or the digital gold, right? But having said that, your ETFs ultimately do have underlying of gold. They are mandated to buy that underlying gold. If you're talking about a bees or you're talking about anything else. So how do you buy gold?
I have typically been asked this question and trolled on the internet a lot of time when I say this. But I think gold in the Indian household, unfortunately, is more is not actually an investment but an emergency planning.
I'm not talking about jewelry.
Right? Because at no point in time I've come across somebody who told me that, gold prices have gone up so much, I sold it and I will buy it back at lower. But if you really want to use gold as an investment, there is no reason why you should not look at gold mutual funds, either through an ETF or the other way around in the mutual fund, because ultimately you are going to save 3% on GST, which is not the case when you buy digital gold, right? And of course, you don't have to be bothered about making sure that the purity is in place and the safety of the gold and all sorts, right? Because you don't have to do that which you do in the physical. So I see absolutely no reason why a gold ETF or a gold mutual fund is a far superior way to accumulate or invest in gold versus probably a digital or a physical gold.
So in the ETFs, is volume an issue? Is price discovery an issue?
Not really, but of course you have to be very cognizant of the fact that it's not trading at a much prices much premium to what the realistic prices are, right? So you can always go on to the AMC's website to check what the actual price should be versus what the ETF is trading at. But not really in gold is that a serious problem.
Okay. So, and also then timing, of course, is difficult to do, as is the case in any asset class. And you can get lucky or you can be brilliant. And it's very difficult to be brilliant, let's face it. And not everyone is lucky. So therefore, what is a way to accumulate gold over a period of time? Do you have an SIP approach?
Oh, 100%. I mean, look, there are two ways of really looking at it, because we are saying that your 10%, 15% of your portfolio should be allocated to gold. All you want to make sure is that at every point in time, you at least have at least that much allocation on gold. So you should typically try and mirror the same approach that you do for equities. Only then this balance can be maintained over a period of time. So if you're accumulating equity using SIP, you should have an accumulation that you do using gold, right? Because that's how you will make sure that largely given outside performance in either of these asset classes, you will largely be able to follow the same asset allocation that you really start with, right? And whenever you try and buy lump sum in equity, try and buy lump sum in gold, because at the end of the day, we are saying that pricing is not the strength or the power that you have as an investor, right? So whenever you are doing whatever in equity, probably try and replicate that in gold over a longer period of time. It'll kind of balance out what you want to do.
Okay. So I want to talk very quickly about, and we've spent quite a bit talking about gold and silver, but particularly about gold, and we've covered a lot of ground. But I do want to talk about the other aspects of your portfolio, right? So equity being predominant, I have a question there. International equity, fixed income, and possibly on REITs as well.
Sure.
So to run through all of these, one, equity. I've met a few people over the course of the last 1.5 years have come to me and said, look, hey, you know what? I've been doing SIPs, but it's been yielding me nothing. And let's face it, 2025 has not been the best year for equity, right? Some people are calling it a year of consolidation. What is the advice that you would give to these people who say, look, I'm getting nothing for my investment?
I think I always keep saying this. If ever you've used the local transport in Mumbai, or you've gone through a train while you are trying to take the ticket, you will generally see that the other line moves much faster than the line you are in.
Or if you're waiting for a toll, right?
Right. So what you do is then you try and move to the other line. As soon as you move to the other line, you see that your line starts doing very well.
Let me just say, I have the worst luck on tolls. the worst luck.
Right? Everybody will relate to what we are trying to say. Right? This is exactly what happens, right?
Yeah.
Look, what you have to understand is equities are not fixed deposits. They don't pay you 10 or 12% consistently, repeatedly over a period of time, year after year, right? It averages out to give you 10-12%, right? That average happens because some years it is down and some years it is up. The last 1 year, the day you and I are talking, the last 1 year return on Nifty is -1.5%.
Yeah.
And this is absolutely normal. In the last 44-45 years, there have been only 4 years where the intra-year fall from the peak of the market has been less than 10%. What I mean by that is out of 44-45 years, 40 years, there has been a case where from the peak, Nifty has fallen 10% intra-year.
In 1 year, within that year.
Within that year. Yeah. It is that normal, right? So it is just too much of expectation or probably unrealistic expectation for your equity to behave like your fixed deposit. You have to understand this. Now, theoretically, you might say I'm in it for a 5-year haul or a 10-year investment, right? But if in the first year you're going to get scared by your portfolio showing you -1.5%, you are never going to make that 10-12%. So please understand this is actually a feature and not a bug.
Okay. So keep those investments going
Absolutely.
as is, right? That's part of your diversification strategy. Second part is international equity. It's getting harder and harder for an Indian investor to take exposure there. Of course, you can say that the liberalized remittance route is available, scheme route, LRS route is available. But then that's one aspect. And the other aspect is India's underperformed relatively all of these international markets. And a lot of them, including the US, has run up like nobody's business, right? So therefore, how do you look at that strategy at this juncture?
See, look, one theoretical answer is you still have ETFs that you can use to invest in global markets, right? But the point is, should you or should you not?
Because there's a gap, right, in the price and the actual NAV.
Absolutely, right? The point that I really want to make is that if India is the fastest growing economy globally, right? Do you really have the need for you to look at global exposure?
Sure.
Because if you're going to invest in gold will actually give you the 3% depreciation that the global investment brings on board. So the diversification advantage that you really bring on board is investing in equity outside of the country.
Sure.
Right?
Yeah.
You look at the S&P 500 and you will know that probably it's only the Magnificent 7 which has generated more than 50% of the returns that the entire S&P 500 has generated. It is that concentrated as a portfolio. Do you really want to bet in such high concentration? That's a call that you will really have to make. And look, we are talking at a time where markets have significantly done well over the last 1 year for the global players. You remove the last 1 year or the last 18 months and you will see that the average performance of global indices outside of the US is not that great at all, right? So I think it is just the near-term bias that is working towards global investing.
And FOMO to a certain extent.
So I am somebody who believes that you probably want to keep your domestic allocation in India to be highest, have some allocation to the US because because let's face it, they are the innovative leaders, right? China, while they are, but there is too much of a geopolitical problem in general to be wanting to invest in China. Everywhere else, I'm not sure if a retail investor really even understands what's happening in Brazil and Canada and Argentina.
Sure. So point well made. Last 2 points, and I'm going to club them because ultimately you're talking about fixed income when at a time when there might still be 50 basis points or half a percentage points of cuts by the Reserve Bank of India, and bond yields have been relatively elevated. They could fall, and so there's a benefit on capital gains. I don't know if that should determine whether or not to invest in fixed income. It shouldn't. But what is your strategy there, and should you also include REITs?
So currently, if I remember one of the shows that we did some time back, I was very positive on doing long duration because we were expecting interest rates to fall, and that actually played out really well for investors. At this point in time that you and I talk, we are more betting on the credit cycle in India versus the duration cycle in India. So if you are a sophisticated investor who understands the risk in fixed income, right, credit may be a great opportunity versus duration at this point in time. And I think REIT definitely is a very interesting diversification that you should really look at. Of course, there are not a lot of examples that I can go back and talk about, but out of the three listed, if I look at two, one is 5-year-old and another is 3-year-old, they've easily given an 8% CAGR of yield, which is great, right? And also there is a capital appreciation opportunity. So the CAGR on Embassy, if I'm not wrong, since the last 5 years is close to 10.5, right? And on the other one is 9.4, 9.5. I think it's a great play because on the capital gains, you are taxed as equity. And on your yield, you are going to pay as much as
So
your
therefore,
debt.
what exposure is appropriate?
Again, another 10% can be great, but this is still evolving. There are not a lot of opportunities in this space. And I'm hoping and assuming that a lot more opportunities will come up. But definitely sophisticated investors can look at diversifying a little in REITs.
Yeah, I've had fantastic fun on this conversation and we've covered a lot of ground. Kirtan, thanks so much for taking the time.
Alex, thank you so much for having me as always.
All right, well, that brings us to the end of this edition of Moneywise. Tell us what you think and let us know what you'd like to hear on this program. Meanwhile, stay tuned. This is NDTV Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
We see the problems, but you as a social entrepreneur see the solutions. You are not just creating solution, you are creating a future where everyone has a chance to thrive. For the change makers, the innovators, the ones building a better world, one solution at a time. The Adani Green Talk Social Impact Awards are created for you, inviting social entrepreneurs to apply. Green Talk Social Impact Awards 2025, where innovation meets impact.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily lives. We aren't talking about time travel yet.
Hello and welcome. We've been covering GST 2.0 in great depth and we continue to do that here on NDTV Profit. I'm Harsh Saita, with me is Neeraj Shah and Mahima Vachajani, and that is exactly what we're going to decode today. Let me start off by introducing our panel of guests that we have today afternoon. We have Harshavardhan Agarwal, who's the President, FICCI and Vice Chairman and Managing Director at Imami, joining us. Pleasure having you, sir. We also have Anand Goyanka, Senior Vice President, FICCI and Vice Chairman at RPG Group. Great having you. And Mr. Vijay Shankar, who's the Vice President, FICCI and Chairman at Sanmar Group, also joining us. So it's more of a FICCI conversation, but of course they're representatives of their own companies as well. Mr. Agarwal, let me come to you first. Do you believe that the GST 2.0 and just looking at it top down will bring out the animal spirits, both from a consumer perspective and also from a capex perspective? What's your sense?
I think, the GST2 is a very, very landmark step by the government. It was a very much needed step, to boost the economy. When we see, the trend seems to be very, very clear from the government perspective that they really want to grow the consumption, and ultimately growth in consumption will result into more investment, and more investment means more employment. And then again, more employment means more money to the people and more consumption. So it's a whole chain. If you see from the first step, the relief in the income tax, then the repo rate reduction by the RBI, then the GST cut, and now, even with the good monsoon and the control in the inflation, I think very clearly we can see that the government is trying to boost the consumption. And yes, with the steps taken, this is something beyond the expectations of the industry, because yes, we have been telling the government, recommending the government to bring in reform in the GST and at the same time reduce and simplify the slabs, etc. But the steps taken by the government is something beyond expectation, and this is certainly going to boost the consumption a lot and ultimately bring in more investment.
Anand, good afternoon, Neeraj here. And just wondering whether the shape and form of the announcement thus far works for the industry and works for FICCI, or would there be some more dissections and some details awaited? Because at the GST conclave in Delhi 3 days ago, when we had member bodies of Indian corporates out there, people wanted some clarifications around ITC, around compensation cess, etc. So are you happy in the current form? Would you wait for some more stuff to be announced?
I think this is a very welcome shift that the government has done. I'd say it's beaten all of our expectations. It's in line with global practices, makes life much easier, not only in terms of just the reduction that has happened, but the overall benefit of conflict resolution at a faster pace, GST registration with auto approval using digital systems, faster refunds. I think all of those benefits are substantial beyond just the rate reduction that has happened. So I'd say that we are overall very happy with it. I think largely this compensation cess, we heard Honorable CIM say that he will take this up and work on the distributor part of it in terms of the challenges that they face. But beyond that, I think we're very happy with the shift that has happened.
Mr. Sankar, hi. Mahima also joining in. Just want to get your view on this entire GST 2.0. Mr. Agarwal did mention that this is going to see a boost in terms of where consumption stands, and that will be seen in a month or two in terms of where the companies stand as well. Your view with regards to how are you seeing GST 2.0?
No, it's certainly as explained by Harsha and Anant. It's a landmark step. It's actually a major milestone in India's economic reform journey. It's much more than a tax reform. It's actually a structural economic reform, and it promises to boost consumption. But I think, as Anant said earlier, I think a key, perhaps overlooked element is how we're not just simplified rates, which has obviously been the key focus, or reduce the slabs, but also reduce classification disputes, cutting compliance costs. I think this reform 2.0 strengthens the foundations of sustainable growth by some of the things it's done as far as non-slab issues go. I think that's where the real benefit comes, not just simplifying slabs, which is obviously huge. It should be celebrated as a big stimulus and a reform combined, which is quite unusual.
Point taken. Mr. Goenka, if I can come back to you, what does this mean from a consumption perspective? Does this likely mean better growth? Do we beat our growth targets? The current target as per the CA is 6.3 to 6.8%. That's the band he's given. How likely is this as a single factor to possibly help us beat that number?
No, I think it will be a big boost to growth. We're talking about 7-8% reduction in prices for the consumer. That itself should spur a lot of demand. We are seeing, if you look at sector by sector, we're talking about essentials getting a huge boost, automotive sector getting a huge boost, and all of that will lead to capacity utilizations, which are maybe today at about 75-80%, going up by maybe 5-6% over time with that new capacity expansion, and the entire virtuous cycle then kind of playing in that as private capex kicks in, jobs get created, we will see benefit. Some of it will happen now, but a lot of it will happen over the longer term, because by the time capacities come in, jobs get created, it is a matter of maybe at least a year's time as well.
That's true. Mr. Agarwal, does this prompt, so Anand just mentioned that very validly that this takes some time, but there was a belief among certain set of economists and market experts that if indeed consumption picks up with a bang around Navratras and post that, and if capacities or inventories get cleaned up, capacity, so on and so forth, then there might be a need felt to have some capex done. Can this usher in some small fashion, private capex, at least in the consumer-facing industries?
No, certainly, I think, because the prices are expected to come down, very, very soon. Some of the companies have already reduced their prices in many of the sectors. And I believe, it will help the consumption, but we need to just wait and see how much. If you see in the daily consumption items in the FMCG sectors, if the consumption goes up, I think the investment will come up. But the question is how soon? I think we need to wait for that and just see how soon will that happen.
We have to wait and see. Okay, let's try and kind of nail it down to specific buckets as well. So Anand, maybe I can ask you about autos, right? Autos, auto components to start off with, tires, etc. You've seen various cycles, right? Experience in various cycles, your company. This is slightly different than what past cycles may be. But is there some guesstimate that if indeed there's an X set of strength seen in the consumption patterns in the next 3-4 months, starting September 22nd, could it prompt capacity expansions?
So one is that there is a very high concentration of positive things happening from to September 22nd. You have month end coming in, of course, the price reductions because of GST, various holiday season, and then you have the marriage season coming in. So I think there will be a lot of positive demand and upswing. And I think if you see a consistency of good demand coming in for 3-4 months, I'm very sure that capacities will go up. I think Indian industry, Indian entrepreneurs do take advantage as soon as the opportunity arises. And I do feel fairly confident that capacity expansion will happen once you cross that about 80-85% capacity utilization.
Well put. Vijay Sankar, one is, of course, the kind of capex that may happen. The second is, when we were talking to the CEA at the conclave, he seemed to be of the opinion that, I mean, when we quizzed about the Q1 growth numbers, right, a big surprise on the upside, and could there be a case for a positive surprise? His view seemed to be that growth is per se trending higher in India than what people normally envisage. And if indeed the festive season goes on very strong, then the upside of the band of 6.8 that he has presented could very well be nudged or eclipsed. He didn't want to give numbers, naturally, so we don't know how this will turn up. No, you don't know how the tariff situation turns up too. But is there a possibility that does corporate India believe that growth numbers of 6.7, 6.8 or higher can be achieved in FY26 after the first quarter surprise and the confluence of positive factors that Anand Goenka spoke about?
Absolutely. I think there is, I think people have underestimated or perhaps overestimated the impact of the negativity around the tariffs in the last few months. And I think the first quarter numbers, like you said, has been a positive surprise to many. I think, as the CA said, there is certainly an upside that would be factored in because of the GST cuts, the good monsoon, as was mentioned earlier. And I think, and if it follows on with the government not cutting down its government expenditure is sustained, I certainly see a positive upside to the 6.9%, which is the upper end of the CA's band. I think if that happens, and if the tariff issues also get resolved in the next few months, as we've been reading in the last couple of days, I certainly see that we could potentially breach that upside, which would be a great thing for India in a globally difficult situation.
Well, with regards to the consumption pack, the FMCG pack, just want to understand that how long will it take to pass on this benefit, first thing, and secondly, for small packs, especially at price points of that 10 and 20, passing on that benefit will be difficult because that's a psychological price point. How are you viewing this, and how will that be strategically done?
I think that's a very, very valid point. First of all, passing on the benefit, to the consumers. I think in some of the sectors, some of the products, the benefit might get passed on immediately. Some SKUs, some might take a bit more time, from the perspective of exactly implementing it, maybe around 3 to 4 weeks more. But the effort from companies like us, and wherever we have been discussing with many FMCG companies, consumer companies, and everybody is working very, very hard to pass on the benefit to the consumers immediately. Now, coming to the smaller packs, what we see, so they are not only 10 rupee pack or 20 rupee pack, they are also consumer pack for 1 rupee, 2 rupee, 5 rupee. So, which are very, very psychological price points from the consumer's perspective. And hence, there, maybe, changing price might not be feasible or viable. And hence, from the industry perspective, increasing the weight or the content is a solution that one needs to look into. But now again, there will be challenges in that as well, because many a times the packaging itself might not be able to have more content into it. But they might be small enough, or they might only be able to contain the kind of ml or the quantity which has been there till now. So those are the things or the challenges we are working on. But yes, I think increasing the quantity is one solution for the smaller packs.
Mr. Goenka, of course, this is going to impact to some level also the fiscal deficit and the possible targets, and the government will likely have to calibrate that, if not this year, maybe next year. So two questions. One piece is the volume growth going to bridge for that, basis your conversations with peers and your own companies? And second, do you believe that just because of lower fiscal room, will the government reduce the spend that they will push, and which will likely impact certain sectors on the capex side of things?
Right. I think the government has been very clear and fixated on its fiscal glide path. They've been very disciplined, and we've seen that even in post-COVID, when many countries were moving away from their deficit targets. We stayed on track, and that has benefited us at this point of time. My belief is that the government will continue on the similar glide path in terms of fiscal discipline, and they have been also focused on the capex. So I hope that the capex does continue because of the multiplier effect that comes in terms of job creation, in terms of growth, infrastructure, cost of doing business, and ease of doing business improving as infrastructure improves. So I think a lot of it will get compensated by volume. However, if there is some impact that can come in, I think the government will really have to think of how to balance that. I don't know if I have enough information and knowledge to say how they would balance it, but we could see some balancing that the government would have to do. But I think volume growth should really be the hope that we have for the next 3-4 months.
So, Anand, but safe assumption, and I don't, safe assumption that it will have to be at the expense of capex, because now you know that the line on sand on fiscal deficit is drawn and the expense on consumption has been done. So if any adjustment has to be done, if volumes don't come back as anticipated, it will have to be the capex, right?
Yes, very much. That could be possible. The government has gone strong on capex in the first half. So hopefully, my hope is that they continue with a very similar focus on capex, and we see growth coming in.
Yes, and that would be the other question, though. Anand mentioned that the government has gone strong on capex and selective pockets, yes, but our opinion was that with the income tax cuts that have come in, plus this GST cuts, there seems to be a full tilt and a full focus on reviving growth through focus on consumption. Would that be a fair assessment? Or am I in the minority? Because both the CE and Anand Goenka seem to be speaking about how capex has not taken a dent.
You're asking me, I certainly think that, this capex, which you focused on rightly, I hope the government does not reduce it. I think the first half has been stronger than the first half in the earlier year, and I hope that trend continues. I'm fairly confident that the volume makeup will compensate for the reduction in GST, and the consumption increase will not reduce the money in the hands of the government, and that the capex trend, which I think is vital to sustain the growth momentum, is not touched. I think if there is a month or two lag, that's fine, but we hope there is no reduction in the government expenditure. I think, especially in the capex front, that is I think key for sustaining the short run stimulus.
Mr. Agrawal, for a lot of sectors and items, the problem right now is that the input tax credit, which they generally pay, is at a higher rate versus the output tax, output GST that they'll be paying, and that is still a problem that needs to be solved. Any views there?
No, I totally agree. That's certainly a problem, and as an industry, we are looking forward from the perspective, key clarity and clarification from the government on that. Not only that, there are some other issues like the budgetary support, a lot of companies which were getting. So how does one compensate on that if everything is passed on to the consumer, because that might not happen now. So yes, those are the areas pending, for clarification from the government side, and we are looking forward for that. And from the perspective of, some of the questions that we're having regarding the growth of consumption, I believe, if you are seeing, like auto sector, they have already announced that they are revising the target for this year. So very clearly, a lot of industries are very clearly seeing growth and the numbers increasing from here on. I think what just needs to be seen is how much.
Anand, I started off by asking you about the same. No move is arguably 100% correct, right? So my question to you would be the same, that what is it that is further needed from the policymakers in terms of clarification, or an amendment to the current GST 2.0 as it has been introduced? Let's say if not for industry-wide, then maybe for the businesses that your group is in.
Right. I would say I would go more beyond GST. I would say that we are awaiting the labor codes that have to come in. We await various issues with respect to power tariffs that are there, ease of doing business. A lot of this the government has taken on, and a lot of our recommendations as FICCI has been on further reform beyond now GST 2.0. I think the government is working at war footing also in light of the US tariffs that has come in terms of these larger reforms. And I think more time and effort should be focused on that. You have the innovation fund of 1 lakh crore. We would like to see more clarity on that. The national manufacturing mission was announced. We would like to see some more clarity on that. So I'd say now these are the big ticket items that we hope to see more reform on. I'd say a large part of the GST job is done, and it would be only the micro shifts that are needed, and I wouldn't have all of those details at this time.
This is interesting, guys, simply because even Sanjeev Sanyal at the GST conclave spoke about how further moves coming in, right, including deregulation in a few sectors. And I think Industry Inc. is now asking for the same thing. The GST is done, great move. Now, ye dil mange more, right? And I wonder, Vijay Sankar, I mean, do you echo Anand Goenka's sentiments? I'm sure you do. But the question is, beyond what he's highlighted, is there something else that you believe should be anticipated? Deregulation in certain sectors, something else, what have you?
So it's I would say the focus should not be on any one big bang item, but on multiple smaller items. I think, as Anand said earlier, the government's focus on ease of doing business or the cost of doing business is really, I would say, key. They formed, as you probably have heard of, this committee under the former Cabinet Secretary, Mr. Gauba, to go into deregulation, not just at the central level, but also at the central and state levels. I think that's a huge move. They're willing to relook at all impediments to business, all regulations de novo, not just on any particular aspect like, say, decriminalization, but across the board, what are the impediments to doing, making business faster and easier? I think so. Now we have to get into micro details on each sector, on say environment, on power. I think the government is focused on that. I think the recent tariff issues has been a spur in this direction. I think everybody is I think using this as an opportunity, this problem as an opportunity, a moment in India to, I think, focus on reform and ease of doing business.
You kind of preempted a last question on the for the panel, which is around the other relationships. Now, internal is done. Maybe more measures coming, and either of you can answer. I'll start with Anand, and either of you, all of you can come in as well. But just one key thing: there is some thawing of relationships with China. There seems to be at the anvil some nice, warm, reciprocal words from both ends, which is US and India, including Sergio Gore's comments yesterday. How critical would if I can, for lack of a better word, resolution of these be in a time-bound fashion for business to have strong growth? Anand, I'll start with you, and any of you can come in onto this, please.
See, US is our long-term natural partner. Yes, there has been some stress in the last few months, but I think with this thawing of relationship, the biggest benefit will come to those few focus sectors such as textiles, gems and jewelry, apparel, etc., which have really got hit as a result of this 50% tariff that has come in. Where the benefit will come will be on employment, MSME focus. I think also providing certainty to the entire industry, because there's been so much of up and down, 25% tariff, 50% tariff. So once and for all, if we are able to solve this problem, it will be a big benefit to industry in terms of clarity, and just that psychological benefit itself will have an overall positive impact. But the bigger issue being job creation and MSMEs who potentially are suffering in this at this point of time, that relief will be a big benefit.
Mr. Agarwal, if you want to just very quickly come in on this as well, as also Vijay Sankar, but yeah.
Yeah, I totally agree with what Anant has said. But just to add to that, I think, see, government is taking all these steps if the tariff issue is not improving, from the perspective of the reforms, the GST reforms, etc. But if the tariff issue is solved, then it can become a double bonus for the economy. The importance of US export, I can just say, it's around 20% of the overall country's export. And if you see in contrast to the top 10 countries export from India, cumulatively it's 53%. And out of this 53%, 20% comes from India. So we can see, what is the importance of US in the overall from the overall export perspective. And hence, I just hope, it gets sorted out and it will be a double bonanza for the industry.
Yeah. Sorry, Mr. Sankar, you're on mute. Yes, please.
Sorry, adding to what Harsha said, I think I think we're also very confident that the government will solve the US relationship issue. You alluded to Mr. Gore's comments, also Marco Rubio's comments at his confirmation hearing, where he said this is a most important relationship, and Mr. Gore's access to the president is key in ensuring that the relationship goes to the higher level. I think is an important comment. I think both the finance minister and the commerce minister have also been gone on record saying that they will not allow these sectors that Anant referred to, which is gems and jewelry and the fisheries sector and the textile sector, to suffer in the short run. So hopefully it's a matter of few months with the government support in the short run. And these issues and the relationship getting resolved in the medium term. Hopefully, it's not going to be something that affects us in the long term. The long term, I think the partnership with the US is very important for the country, and I think it's had a few small blips, but nothing that's not going to get overcome in the medium term.
Gentlemen, thank you so much for joining in today and giving us your thoughts. Really appreciate your time. And viewers, that's the distilled thoughts of three prominent businessmen and FICCI. Thank you so much for tuning in.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
We see the problems, but you as a social entrepreneur see the solutions. You are not just creating solution, you are creating a future where everyone has a chance to thrive. For the change makers, the innovators, the ones building a better world, one solution at a time. The Adani Green Talk Social Impact Awards are created for you, inviting social entrepreneurs to apply. Green Talk Social Impact Awards 2025, where innovation meets impact.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
In the markets today, the Sensex has surged over 350 points, while the Nifty has ended above 25,100, marking its longest winning streak in more than a year. More sectoral indices have closed higher, led by strong gains in Nifty Defense. The SEBI board meet has concluded, the regulator easing minimum public shareholding rules for large IPO-bound companies. Following the GST rate cuts effective 22nd September, the government steps up efforts to ensure consumers actually benefit from lower taxes, with the CBIC directing tax officials nationwide to submit monthly reports on prices of more than 50 fast-moving consumer goods, comparing prices before and after the GST rate cuts. CPI, Consumer Price Index inflation, rises to 2.07% in August, which is up from 1.61% in July. It signals a modest uptick in retail prices. Despite that increase, inflation remains within the Reserve Bank of India's comfortable target range. India and Europe intensify efforts to finalize an FTA by the end of 2025. The EU Trade Commissioner, Maros Sefcovic, has acknowledged that while India and the EU may not see eye to eye on every issue, he remains optimistic that a strong, mutually beneficial deal will be reached. Trump's pick for India envoy, Sergio Gore, has called India a strategic partner whose trajectory will shape the region and beyond. He signals that a trade deal is imminent and hinted at a possible Trump visit to India later this year. SpiceJet aircraft's outer wheel has detached during a takeoff on a flight from Kandla to Mumbai. Despite this, the pilot's safety has ensured that the flight has continued and completed its landing at Mumbai without incident. The much-anticipated Navi Mumbai International Airport is set for its inauguration on the 30th of September, with operations expected to begin by the month of November. Hello and a very warm welcome to NDTV Profit. I'm Vikram Oza and you're joining us this evening on Profit 360 with all the big news that we're tracking at this hour. So over the next half hour or so, we are going to get you the latest on the markets. And yes, the SEBI regulator, the markets regulator SEBI, has really put in place some of those norms which we will discuss ad nauseum. Also, we've got all the national and international news. Well, let's tell you what SEBI has done. Now, SEBI, the markets regulator, has approved major reforms to expand investment opportunities in real estate and infrastructure. Now, SEBI is going to classify REITs and InvITs, those funds when it comes to real estate and infrastructure. Now, those are going to be classified as equity investments. They are going to be seen as equity instruments, which makes it easier for mutual funds to invest in these sectors and open the door wider to retail investors. So that's a big shift as far as SEBI is concerned. It's a big development, and we are going to get more perspective on this from the experts and get perspective from my colleague who's been tracking the SEBI board meeting that has just concluded. So from the big takeaways right now, as we see it, SEBI has approved these major reforms to expand investment opportunities in real estate and infrastructure, classifying REITs and InvITs as equity instruments. And that, like I mentioned, makes it much easier for mutual funds to invest in these sectors and opening the door wider for retail investors. So a lot of potential as far as the kind of decisions that has been taken by SEBI in trying to, of course, revise the minimum public shareholding rules as well. What it really means for listed companies and for promoters, that's going to be closely watched. This relaxation that we are seeing in the minimum public shareholding norms, it will have to be seen whether it boosts IPO activity and ease pressure on promoters, or is this going to reduce transparency in the market, is something else that we are putting on our radar. Also, this move could benefit some of the new age tech companies in particular, because sometimes these are the kind of companies that struggle with meeting MPS norms, and that happens soon after listing. So we'll have to see exactly how that works out. But also investors are perceiving this as a dilution of governance standards. Perhaps at some level, it could be seen as an ease to get that much more domestic action in the markets. So investments flowing in to the equity markets because of these decisions, you cannot quite rule them out. In fact, the market experts are going to be able to tell us exactly what difference we are likely to see once these bits are coming through. And of course, we are waiting and standing by for the board meeting, the SEBI board, to address the media. They've gathered over there. It's going to be an important piece. Let's just listen into what they're saying.
SEBI board meeting. It is now my privilege to invite SEBI Chairman Sri Tuhinkant Pandeyji to address you. Following his address, we'll open the floor for questions. Each of one of you are requested to limit yourselves to 1 or 2 questions. And please mention your name and name of the media organization before putting on the questions. Thank you. Over to you, sir.
So good evening, friends. The SEBI board met today, and I will just explain to you some of the decisions. The first one is relating to the minimum public offer and the timelines to comply with minimum public shareholding for issuers in terms of SCRR rules. Now, these are SCRR rules are notified by the government. So the board has only a recommendatory power here. The actual decisions will be taken by the government, and then as per the decisions, then due notification will take place in due course. As you know, the public consultation papers have been circulated and comments have been received. It has also been discussed in the committee, which is relevant to the primary market. So one of the main issues being faced in the large issuers, they face challenges in undertaking substantial dilution of equity shares through IPO, as large offerings may be difficult for the market to absorb. These constraints can act as a deterrent for large issuers from considering listing in India, thereby limiting the investment opportunities for the Indian investors. So now we are recommending, the board has recommended that there are 2 share thresholds. Post-issue market cap, one is 4,000 crore to 1 lakh crore. So there's no change before that. The post-issue market caps, less than 4,000 crore remain as it is. But we are creating 4 more thresholds after the 4,000 crore. 4,000 crore to 50,000 crore, 50,000 crore to 1 lakh crore, 1 lakh crore to 5 lakh crore, and more than 5 lakh crore. Then for 50,000 crore but less than or equal to 1 lakh crore, in this category, it is proposed to revise the minimum public offer from the current requirement of 10% of the post-issue market cap to 1,000 crore plus 8%, at least 8% of post-issue market cap. So this is a scale-based thresholds we are bringing. Now for 1 lakh crore and above, so it will be, 6,250 crore and at least 2.75% of post-issue market cap. So this is plus, and which is market cap above 5 lakh crore, it will be 15,000 crore plus 1% of post-issue market cap. There is another proposal regarding the timelines. Now, where we have the post-issue market cap above 50,000 crore but less than or equal to 1 lakh crore, is proposed that the timeline for compliance with the MPS requirement of 25% may be extended from the existing 3 years to 5 years from the date of listing. The next proposal in this chain is that wherever the post-issue market cap above 1 lakh crore, it is proposed that the timelines to comply the MPS will be bifurcated into 2 buckets. If it is the public shareholding is less than 15% as on the date of listing, then MPS of 15% is to be achieved within 5 years and 25% within 10 years. In case public shareholding is 15% or above as on the date of listing, then the MPS of 25% is to be achieved within 5 years from the date of listing. Under the current rule, MPS of 10% is to be achieved within 2 years and 25% within 5 years, which is now being changed, in terms of recommendation. Now, the proposed extended timeline, of course, may also be grandfathered, may be made applicable to the listed entities who haven't achieved MPS still, but whatever shortfalls, whatever fines are happening, that will continue due to the non-compliance till, of course, the new rules take into effect. Another important proposal in this regard is, if you recall, that there were initially a proposal to reduce the retail reservation for retail individual investors from 35% to 25% in order to address the same problem. Now that this problem is being addressed through change in structure of the MPO, so therefore a reservation for retail investors is being retained at 35% of the net offer. Now I move to the next proposal. The next proposal relates to the amendment to SEBI ICDR Regulations 2018. The purpose is again ease of doing business and also ensuring that the existing limits on anchor investors, they are constraining fund level participation by large FPIs in terms of numbers of anchor investors. Also, there is lack of reservation for long-term institutions like insurance companies and pension funds limits, and this limits diversity in anchor books. So therefore, the amendments, number one, we are proposing that the anchor investor allottees, there are 2 categories, there will be only 2 categories now. So there is another category, anchor allocation up to 10 crore. That category 1 and category 2 is being merged. So it is less than 250 crores, up to 250 crores allocation, and more than 250 crore allocation. So one is the category change. Secondly, reserve 40% of anchor book for mutual funds, life insurance companies and pension funds, in which 1/3 of the reservation will be for mutual funds solely, and the balance 6.7% will be for life insurance companies registered with ADI and pension funds registered with PFRDA. Again, this has been due to during the long deliberations in PMSE deliberations, and consultation paper was also released and comments had been received as well. The next proposal is relating to amendment to SEBI list LODR regulations and the circulars thereunder for the objective of facilitating ease of doing business related to related party transactions. Now, in this category, we are addressing the following issues. The current provision at Regulation 23 subsection 1, sub-regulation 1 of LODR requires shareholder approval for RPTs exceeding 1,000 crore or 10% of consolidated turnover of the listed entity, whichever is lower. This has become onerous for listed entities with high turnover. Okay, before I come to the proposal, let me make it clear that the related party transactions, so far as the disclosures are concerned, so far as the audit committee approval is concerned, nothing is being changed. So therefore, disclosure will remain as it is. The audit committee, you know that they are chaired by independent director, and it has to go through RPTs, have to go through the audit committee. That will remain the same as well. Only the shareholders approval. If some of the material RPTs go for shareholders approval, and what I'm saying is a change is only for the shareholder approval, where it is becoming onerous for listed entities with high turnover. This limits of 1,000 crore, the 10% or 1,000 crore turnover was fixed some time back. And if you have a very large turnover company, so obviously 1,000 crore becomes a very small proportion of their turnover, and there will be much larger number of transactions which will require shareholders approval. So the attention of shareholders is required on the material transactions where the more attention will have to be needed rather than larger number of RPTs. So therefore, this problem we are addressing. I'll come to that, how we are addressing. This problem we are addressing through changing we are bringing the scale-based threshold has been introduced to annual consolidated turnover as per last financial statements for determining material RPT. Then the second problem was relating to, in some cases, there was a mismatch. While the subsidiary having audited financial statement where 10% of the annual standalone turnover of the subsidiary or the scale-based threshold for material RPT, we are bringing whichever is lower. In many cases that the subsidiary, there was an RPT which was as per the subsidiary turnover was relevant, but it was not going to the audit committee of the listed entity. That particular loophole has been plugged through these changes. The third change is that if an RPT does not exceed 1% of annual consolidated turnover or rupees 10 crore, whichever is lower, then the listed entity shall provide less information in simpler form than compared to the RPT industry standard. You may recall that we have recently made changes where industry standards have been brought in, where there is information has been standardized in order to, for the audit committee as well as for the board as well as for the shareholders, there has to be information in a proper format. Industry standards have come. But there, if it is less than, if the RPT is less than 1% of annual consolidated turnover or rupees 10 crore, whichever is lower. So effectively saying either 10 crore or below, in that case, the simpler form of information may be necessary rather than the full RPT standard. So this has been based on certain difficulties that being faced on very small RPTs in terms of the amount. Then the fourth change is again more in terms of clarification, because there is a circular which provides for validity of omnibus approval for RPTs granted by shareholders. Now these are today in the master circular. We are bringing that in the regulations for greater clarity, so that they're all RPTs, regulations around RPTs are in one place rather than split into regulations and circular. And the fifth item in this is retail purchases from any listed entity or its subsidiary by its directors or key managerial persons or their relatives. Now this is already there, but there have been some problem areas in that. In terms of related party definition, some of the other relatives of directors are also come in, and relative of key managerial persons. So they also need to be excluded. Like we have excluded the directors and the key management personnel, but since there are other relatives of these parties are also related parties in terms of the LODR, so they have not been exempted. So that loophole has been plugged. Also the fact that employees were inappropriately included earlier. They are not in related party, but they were in the earlier version they were included. So they need to be excluded, because employees are actually not the related party in terms of definition of LODR. Another technical point here has been the holding company in terms of Regulation 23(5), where some element of doubt has been there whether the term holding company refers to the listed holding company, and that through an explanation is made clear. So this is again for the purpose of removing ambiguity and bringing clarity. And the next proposal relates to give a regulatory fillip to accredited investors in AIF. I think before that, let me first take up the IFSC issues. So as you know that if GIFT IFSCA, there have been many changes and enablement. Now we already have in terms of AIFs a provision that now the IFSCA has made a request to enable retail scheme with resident Indian non-individual sponsor manager to register as FPIs. Now, this may be, this is already for AIFs, this is already permitted, now being permitted also for the retail schemes. Then the second one is the condition of resident Indian non-individual to be sponsor or manager of the FPI may be substituted with fund management entity or its associate for IFSC based FPIs. This is to bring it in consistence with the IFSCA regulation. Then the maximum limit in contribution by resident Indian non-individual as FME or its associate in AIFs and retail schemes set up in IFSC may be specified at 10% of the corpus of the fund or of the AUM in case of retail schemes. This is actually varying in the FPI regulations, varying from the regulations of IFSCA. So this has been brought in alignment with that. Then overseas mutual funds and the trust, unit trust registering as FPI may be permitted to have Indian mutual funds as a constituent subject to the conditions as mentioned in the circular dated November 4, 2024. So we have already permitted, SEBI has already permitted the mutual funds to be constituent of the FPIs who are registered as overseas MFs who are registered as FPIs in IFSCA. But FPI regulations had not been amended, so this has been now amended to this will be amended to ensure that that particular dispensation will now will be made operational. Now the next scheme is to give a regulatory fillip to accredited investors in AIFs. If you please recall that in the last meeting we had press meet also, we had mentioned this, that accredited investors need to be, because they are investors who are, having three kinds of investors are there, as you know. AI, accredited investors can, the eligibility conditions are 7.5 crore net worth, or out of which 50% is financial net worth, or 2 crore income, or 5 crore net worth plus 1 crore income. Either of the criteria, they can be called as accredited investors. They have to be registered. Now, we are now proposing a definition of, we are actually making amendments for the AIF regulations to provide for AI-only funds. That means the specific schemes for AI-only under the AIF. This will provide relaxations, because AI we consider as who know the risks better, and AIF schemes, as you also know, that AIF window is more like for those who understand risk, they can come to the AIF. So therefore, we can provide for more relaxed dispensation regulation for AI-only funds, which includes exemption from pari passu requirement, extension of tenure to be permitted up to 5 years from 2 years, exemption from NISM certification requirement for key investment team of AIF manager, exemption from restriction on number of investors in a scheme. So then the second part of the proposal is that we have a large value funds where additional flexibilities are being extended, reduction of minimum investment amount in large value funds by investors from 70 crore Indian rupees to 25 crore Indian rupees, and exempting large value funds from responsibility on members if investment committee set up by manager of AIF to approve decisions of AIF. So another point is that we can provide option to existing AIF schemes to convert themselves to AI-only schemes or LVF schemes to avail the benefit subject to meeting conditions specified by SEBI. Now it's proposed to specify also through circular a certain benefits to the LVF. Now, these initiatives align with SEBI's long-term vision of ensuring that sophisticated investors with necessary risk appetite and understanding efficiently fund good quality capital raising by entrepreneurs and risk takers. Another important issue is that we are taking a staggered approach or glide path for transition of AI-only regime. And AI framework, we feel that, so it's proposed to have a gradual transition from minimum commitment threshold to only accreditation status as a metric of risk sophistication of investor. The next item is we have a proposal to introduce single window automatic and generalized access for trusted foreign investors. We call it Swagat FI framework for FPIs and FPCIs. The purpose is to have a much more relaxed onboarding and compliance regime for certain set of FPIs who have been objectively identified through and they are really trust and verify principle. The identification criteria are government and government-related investors such as central banks, sovereign wealth funds, international or multilateral organizations, agencies including entities controlled or at least 75% directly or indirectly owned by such government and government-related investors. Second, appropriately regulated public retail funds with demonstrably diversified investor and investment base with independent fund managers as mandated by their home regulator. This could be appropriately regulated mutual funds and unit trust, and they could also be appropriately regulated insurance companies or appropriately regulated pension funds. Pursuant to this approval today, SEBI in consultation with industry shall come out with a jurisdiction-wise list for above fund structures on the basis of trust but verify principles in line with the approach adopted earlier. Now, what do the relaxations that we'll have for Swagat FI framework? One, they'll be granted option to also register as FPCI without any further documentation. Second, FCI requirement that at least 66% of their investment should be in FCI eligible unlisted investment would not apply to Swagat FI entities, which means they can have a flexibility of how much they want to put in as unlisted investments in FCI eligible unlisted investments. Third, periodicity for continuance of registration and review of KYC of Swagat FI to be 10 years as opposed to 1 or 3 years for other FPIs currently. Fee of $2,500 shall be applicable for such 10-year period as opposed to 3-year period for other FPIs. Then the cap of 50% on aggregate NRI, OCI and RI contribution will be removed for Swagat FIs. Swagat FIs will be provided option to use a single demat account for holding securities acquired as FPI or FPCI or as foreign investors investing in units of investment vehicles, and depositories will provide for adequate tagging to identify the investment as FPI or FPCI or as a foreign investor investing in units of investment vehicles. Now this is only actually a beginning, but eventually Swagat FI framework could pave the way to a broader remit covering other investment schedules of FEMA, which will of course which will require approval of the Government of India and the RBI separately. But what was possible within the SEBI's remit is being attempted here. Once more than 70% of total FPI AUC will then be accounted for by proposed FIs according to our estimate. This has also gone through FPI advisory committee and a public consultation process. I would also like to inform you, I think we can do it later or right now. So I think just for a break, because we move into other agenda, I would like to inform you that for the ease of doing business and to facilitate the availability of all the relevant information that may be useful for current and prospective FPIs across RBI, CBDT, SEBI regulations to access and transact. What has been really missing, and this has come out that information is not in one place, and we are not able to, there's no single website where information is available. So we are launching today the phase 1 of information website for foreign portfolio investors called www.indiamarketaccess.in. So I will invite Aparna to give you a little bit of a demonstration here of the website.
Thank you, sir. Good evening, everyone. So before I really go onward to the demonstration of what the website is about, I'll just give you a quick context on why we really ideated on a concept like this. So when we spoke to foreign portfolio investors, a clear feedback that really came through was that information that was relevant for them was available at multiple diverse locations, because the regulators, like in this case, if SEBI really takes care of the capital market side, Reserve Bank's requirements with respect to FEMA applies to them from a banking and when they're transacting in the country. They have requirements with respect to CBDT, the taxation regime, the laws which apply for repatriation, tax filing, returns. All of them are again available in the DOR and CBDT regime. So we really thought it will be a good idea to put out, you have the stock exchanges and clearing corporations which come out with directions on trading and clearing and settlement aspects. So the idea is to really put out information that is relevant from a user perspective. From an FPI, what is the information that you would really be looking at, both for prospective applicants who are looking at India as a market and for existing FPIs? What is the information that they should really be looking at? If we can provide that as one central portal, that would be really the larger idea of what we thought we could go and achieve with this. Let me just quickly take you through the broad menus that we have over here. First question that would come, at least to a prospective investment application, if you're looking at India as a market, is why India? So we thought we'll start off with some macroeconomic statistics in terms of the broad GDP numbers. We have the capital markets, the statistics with respect to Indian securities market that again put out here. Who are the regulatory authorities whom they should be really knowing about? Few statistics on the fund flows on the for the FPIs. The SEBI bulletin that talks about capital market updates more as a topical, region wise. What are the announcements that are put out from the capital market regulator? All that is covered here. Under market access, this is going to be a one-stop shop. So if you are looking at registering as an FPI, it has 3 sub-tabs which really take you through what all are the pre-investment readiness that you should really be looking at. For instance, if I go to the DDP tab, there are 17 DDP custodians who are registered with SEBI, and it will take you through the websites of each and every one of them. So depending on, it is more to really provide information at one place from where they can really navigate further. Likewise, you have a tab which is under guidance and tools. We have one, the document advisory tab will really take you through on a step-by-step process in terms of if you're looking at registering, what all are the processes that you really need to go through. The first stage is, of course, to approach your DDP or custodian that you will be appointing, and then move on to filling the common application form, which is again a one central form which will give the applicant his or her FPI registration, and move on to use for the PAN application, and then move on to use the same for their bank and demat accounts. The whole process is really explained in a visual manner. It is more to really demystify the rules of the game and put it in very simple non-legalese language for investors to understand and really orient themselves with terms that we often use in our country. Likewise, within market access, we also have a glossary. So there is one, maybe I can take you through the tracker tab. So in terms of registration applications, again, there are people who would want to know what is the status of their application. It will take you to the tracker portal, which has been put in place for really tracking the registration. And the multiple places. We thought we'll provide everything over here. Likewise, this will again be useful. So if you look at policy making at large, like for example, if you look at the terms that we use in terms of the regulations, the circulars, the master circulars we have, which really consolidate the annual directions for each category of participant, and then you have the SOPs and implementation standards which are put out in this context for FPIs. It is the CDSSF. But really the terms like CDSSF or implementation standards, these are terms and concepts which are very unique to India. So we thought we'll really put it out here to explain to them. So the SOPs, if you look at all the implementation standards that have been created by SEBI in collaboration with CDSSF, these are things that apply to them at a ground level. So these are like nuts and bolts of every policy which really matter to them at a ground operating level. So we thought we will put out all the applicable SOPs at one place which should be useful to them. Likewise, you have one tab on taking them to the rules under FEMA, which really again apply. So there are different frameworks under FEMA. If you're looking at an equity investment or if you're looking at a debt investment, there are again different frameworks. There is a separate framework for mode of payment that RBI has really come out with. So all of it is really getting aggregated at one place. Maybe the last tab I'll just take you to could be Connect with Us, where we have a very active FPI outreach cell at SEBI, where we engage directly with foreign portfolio investors and we take them through in terms of understanding what the requirements are if they're looking at operating in India. So we have for instance, if this reach out to SEBI, if you just click here, it will take you to a free text form where applicants can reach out to us directly. We have a designated email ID which is again displayed in the screen, and it is an ongoing dialogue that we even today have. So idea is again put this also as a forum where they can reach out to SEBI for any ongoing assistance that they might need. So that's largely about it.
Thank you.
Thank you. Thank you so much.
Continuing, the next decision was to review the classification of REIT. So it has been decided that the REITs may be reclassified as equity for in purpose of investments by specified mutual funds and specialized investment funds. As regards the InvITs, the same may continue to be classified as hybrid instruments for the purpose of investment by mutual funds as well as SIFs. The current investment limits of eligible schemes of mutual funds and SIFs for investment in InvITs would get freed up as a consequence of equity classification of REITs. Accordingly, there would be no further need to increase the current limit as it was earlier proposed in the consultation paper. Now, there would also be appropriate glide path to ensure that there is no disruption through this change. So SEBI will work with industry to have an appropriate glide path. The next is amendment to SEBI Mutual Fund Regulations 1996 to facilitate enhanced investor protection and financial inclusion. The extent provisions presently permit a maximum exit load of 5%, and reducing the maximum exit load would align the regulatory requirement with the prevailing industry practice. So therefore, it is proposed that the exit load of the open-ended scheme may be lowered to a maximum permissible limit of 3%. Now, the issue is that here it is a maximum limit, not that, that will be charged as it is. Because prevailing exit loads are typically range between 1% to 2%. But this is a cap, so as to align with the prevailing industry practice. The second part of the proposal is that expenses towards incentive for new inflows from B30 cities are not charged by AMC to all schemes uniformly. The existing structure where incentives are based on a percentage of daily assets was prone to misuse and churning of investments by distributors. So therefore now, to clarify, the distributors now will be additionally incentivized only for investment inflows from new individual investors from B30 cities, that means new PAN. At the industry level, capping of such additional incentive at 1% of the first application amount if the investor remains invested for 1 year in case of lump sum, and total investment made during the period of first year in case of SIP, and the maximum amount of incentive is 2,000 rupees. Now, additional distribution commission may be paid from the Investor Education and Awareness Fund aggregated at the level of AMC, and once the AMC level fund is exhausted, would be paid out of the Investor Education Awareness Fund pooled at the level of MP. So therefore, it has to be, there will be no extra charge onto the schemes. It will be from the existing funds. The important thing is that the incentive for distributors for bringing in new women investors shall be paid for everyone. It's not only for the B30 incentive, it will be for all over India, which means that it will be even for top 30 cities also, this will be applicable. So for women, for any new PAN, this incentive will be payable for the distributors. So it will actually provide more financial inclusion of women in mutual fund space. The next item is that ease of doing business for entities having listed non-convertible securities. This is basically an issue of some relaxation where hard copy of statement used to be provided, where the soft copy can be provided, and if someone doesn't have an email ID, then a letter can go and a link can be provided, so that business will be facilitated. And also wherever it's also linked to the other companies also now. So there are certain other companies where timelines. Yes. In terms of timelines also, there are some statutory organizations which are not companies. They have a different timelines. For example, NABARD or NHAI. They don't have that kind of timeline as the company's timelines are in terms of AGMs, etc. There, we are saying that the timelines will be as per the timelines in their respective statute. So this is basically an ease of doing business for them in terms of sending the annual reports. The next is the expanding the scope of strategic investor in the InvIT regulations and REIT regulations. Now, you're aware that the strategic investor is it's more akin to, it's similar to anchor investor in the IPO. The strategic investor has been there which have got certain lock-in requirements, and they can come in and give confidence to the retail investors prior to the issue. The list is now going to be expanded. So now the strategic investor will mean an institutional investor or foreign portfolio investors not covered under subclause A, or a middle layer, upper layer and top layer non-banking finance company. And basically we are expanding the list of in possible investors, of strategic investors, so as to provide greater opportunity for support to the InvIT and REIT. Then the next question, the next item is regarding some of the improving our response, regulatory response and outreach in India by establishing adequate physical local presence at various state capitals or cities. As you know that there is a multiple responsibilities that SEBI has on not only investor awareness, also regulation of market as well as promotion of markets. And it's not possible always to do it from Mumbai or 4 regional offices and 1 local office at Indore. We have got outside of Mumbai, we have got only physical presence of our offices only at 5 places. Rest of the places, there are investor service centers maintained by the exchanges, but those are more in the nature of doing investor queries and so on. I think we have received actually a number of representations that greater presence of SEBI on the ground will be helpful from various angles, which we are there. Investor awareness is also a very important issue, as well also the investor protection. So therefore, there is a decision to start establishing local offices at state capital, other cities in a graded manner. So in phase 1, there will be we will be setting up offices in Chandigarh, Jaipur, Lucknow, Guwahati, Bhubaneswar, Vijayawada, Hyderabad, and Bengaluru. And then phase 2 will be Jammu, Himachal Pradesh, Uttarakhand, Bihar, Chhattisgarh, Jharkhand, Tripura, and Kerala. And phase 3 will be the remaining states and union territories and large states and so on. There will be headed by a DGM or a GM level officer, on an average at least 3 officers at different levels, and the staffing to be based on needs of location. And we'll try to see that most of the officials, at least half of them, should be conversant with local language. It's very important to us to get in touch with the regional languages in terms of communication as well as physical presence, where the people will be able to service the investors in a better manner. The next item is the review of regulatory framework for registrar to an issue and share transfer agents. Now, this is, as you know, that the role of RTA as share transfer agent was critical in the past when the shares were held in physical forms. Over a period of time, the role of RTAs has changed considerably. SEBI has, from April 1, 2019, SEBI has discontinued transfer of securities of listed companies in physical form. And thus, as a share transfer agent, role of RTAs has been limited to issuance of letter of confirmation in respect of requests received and so on. But they have also been doing a lot of work for relating to unlisted companies as their agents, and also in terms of certain tasks which the companies are required to do under the company's law. They also use the RTAs for that. However, it is important to have the clarification, proper clarification in terms of what SEBI regulates and what SEBI doesn't regulate, as also to change the name, because now we are going to have only a RTA. Instead of RTA and share transfer agent, instead of 2 different things, we would have the name as RTA. So we are bringing in RTA regulations 2025, where we will introduce the activity-based regulations for RTAs, and which will do away with the categorization of RTAs. There will be common definition of RTAs in place of existing separate definition for registrar to an issue as well as share transfer agent, net worth requirement for RTAs, and revision in fee structure for RTAs, and also for changing the the net worth definition of RTA, which was old, to make it align with the company's law definition. Also provide for institutional mechanism for RTAs. The next proposal is in terms of ease of doing business for investment advisors and research analysts. As you're aware that this subject has been engaging the attention of SEBI for some time. There have been some changes earlier in the past, but further facilitation was necessary in terms of expanding the number of IAs and RAs so that registered advisors are available instead of the investors looking for unsolicited and sometimes incorrect advice from some of the influencers who are not registered. And this ecosystem needs to be developed. So it has been now decided to bring in a few changes to facilitate. One is permitting IAs and RAs to provide past performance certified by chartered accountant and CMAs to clients, including prospective clients, in one-on-one communication with appropriate disclaimer. And this will be for a transitory period. As you know, that Parva system is going to be implemented, and but this will take time. First, you have to start volunteering for it, and then the performance will be built up through a third-party certification. Then obviously, then it will be available based on third-party certification going forward. But in the meanwhile, and as a transitory phase, for a period of only for a period of 2 years, this relaxation is being provided that they may do it, but this should not be advertised. This performance will not be advertised, but it can be given to clients on one-on-one basis. The second part is that allowing IAs to charge fees under asset under advice, base fee up to 2.5% of assets value per annum from clients for providing second opinion to clients, which has been on demand, on pre-distributed assets, subject to annual consent of clients and disclosure to clients regarding incidence of dual charges, that is advisory fee as well as cost towards distributors' commission. Easing the compulsory corporatization process for individual IAs by enabling them acquire new business during transitioning period and by providing extended timeline for transition. Relaxation in education criteria for IAs and RAs to allow graduate in any field to register as IA/RA and to allow accreditation of any courses by NISM as alternative to NISM certification examination, which means that NISM itself, apart from its own certification examination, can also allow accreditation of some of the courses, which if they do, they will be meeting the criteria. Relaxing the requirement of submission of proof of address, CIBIL support, details of infrastructure, etc. for seeking registration. I think some of the requirements are considered onerous, and also due to which I think they are not accessing and applying for registration.
The SEBI chair, Tuhin Kanta Pandey, addressing the media, talking about all the decisions that have been taken at that board meeting. And yes, everything from AIFs to looking at easier compliance measures when it comes to minimum public shareholding as well. All of that has been put in on the table, and indeed those proposals are out there, and we are going to decode them as soon as we return from a short break here on Profit 360. Keep it with us on NDTV Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, द बेस्ट ऐप टू यूज इज द एनडीटीवी ऐप।
We see the problems, but you as a social entrepreneur see the solutions. You are not just creating solution, you are creating a future where everyone has a chance to thrive. For the change makers, the innovators, the ones building a better world, one solution at a time. The Adani Green Talk.
The SEBI announces several key reforms aimed at easing fundraising, improving market transparency and protecting investors. Notable changes include relaxed minimum public shareholding norms with longer timelines for large companies to comply and expanded anchor investor participation in IPOs. Meanwhile, the Sensex surges over 350 points while the Nifty ends above 25,100, marking its longest winning streak in more than a year. Most sectoral indices close higher, led by strong gains in Nifty defense. Following the GST rate cuts effective September the 22nd, the government steps up efforts to ensure consumers actually benefit from lower taxes, with the CBIC directing tax officials nationwide to submit monthly reports on prices of over 50 FMCGs, comparing prices before and after the cuts. Consumer Price Index inflation rises to 2.07% in August, up from 1.61% in July, signaling a modest uptick in retail prices. Despite this increase, inflation remains within the Reserve Bank of India's comfortable target range. India and Europe intensify efforts to finalize an FTA by the end of 2025. EU Trade Commissioner Maros Sefcovic acknowledges that while India and the EU may not see eye to eye on every issue, he remains optimistic that a strong, mutually beneficial deal will be reached. Trump's pick for India's envoy, Sergio Gore, calls India a strategic partner whose trajectory will shape the region and beyond. He signals that a trade deal is imminent and hinted at a possible Trump visit to India later this year. SpiceJet's aircraft outer wheel detaches during takeoff on a flight from Kandla to Mumbai. Despite this, the pilots safely continued the flight and completed the landing at Mumbai without incident. Good evening, you're watching Profit 360 on NDTV Profit. I'm Sanjana. Let's take you right through the top focus this evening. The SEBI board meeting has concluded and the regulator has announced several key reforms aimed at easing fundraising, improving market transparency and protecting investors. Notable changes include relaxed minimum public shareholding norms with longer timelines for large companies to comply and expanded anchor investment participation in IPOs, now including insurance and pension funds alongside mutual funds. Additionally, new incentives were introduced for mutual fund distributors to attract first-time women investors, promoting greater financial inclusion.
So, one of the main issues being faced in the large issuers, they face challenges in undertaking substantial dilution of equity shares through IPO, as large offerings may be difficult for the market to absorb. These constraints can act as a deterrent for large issuers from considering listing in India, thereby limiting the investment opportunities for the Indian investors. So now we are recommending, the board has recommended that there are two share thresholds, post-issue market cap. One is 4,000 crore to 1 lakh crore. So there's no change before that. The post-issue market caps, less than 4,000 crore remain as it is. But we are creating 4 more thresholds after the 4,000 crore. 4,000 crore to 50,000 crore, 50,000 crore to 1 lakh crore, 1 lakh crore to 5 lakh crore, and more than 5 lakh crore. Then for 50,000 crore but less than or equal to 1 lakh crore. In this category, it is proposed to revise the minimum public offer from the current requirement of 10% of the post-issue market cap to 1,000 crore plus 8%, at least 8% of post-issue market cap. So this is a scale-based thresholds we are bringing. Now for 1 lakh crore and above, so it will be 6,250 crore and at least 2.75% of post-issue market cap. So this is plus, and which is market cap above 5 lakh crore, it will be 15,000 crore plus 1% of post-issue market cap. The important thing is that the incentive for distributors for bringing in new women investors shall be paid for everyone. It's not only for the B30 incentive, it will be for all over India, which means that it will be even for top 30 cities also, this will be applicable. So for women, for any new PAN, this incentive will be payable for the distributors. So it will actually provide more financial inclusion of women in mutual fund space.
Okay, a lot of big announcements there, and I'm joined by JN Gupta, former ED, SEBI, Pranav Haldia, MD, Prime Database Group on the phone line, and also Sandeep Parekh, partner, FinSec Law Advisors. Thank you so much to all of you. Welcome to NDTV Profit. This is an exciting time. Big announcements coming in. JN Gupta, sir, from your experience at SEBI, how are you viewing the recent proposal to relax the minimum public shareholding norms? What impact do you think this is going to have on market liquidity and investor confidence?
Thank you for having me here, and good evening, my fellow panelists. See, the issue that SEBI has addressed, that lot of time, very big companies, say for example, we had an issue of LIC, and LIC, the size of the issue was such that it was very difficult to absorb the entire, if suppose 25% or 10% were to come to the market, it would be very difficult to absorb such a large capital into the market in one issue. So SEBI has addressed this. So this will help big companies. If in future a company like Tata Sons want to list, probably it will be incentive for the Tata company to list. And liquidity issue, I have always been maintaining liquidity does not come by percentage. Liquidity come by number of shares that are there in the market and number of shareholders. So since the retail quota is not being disturbed, so the retail will be there in the market and people will be there. So when you say LIC with such a large market cap and such a large number of equity versus another company which has a low market cap. So you can't compare the liquidity by percentage because LIC would be having millions and crores of shares where other company may be having lakhs of shares. So that way it's a one welcome step. It may add to more listing of big companies who till now were afraid that probably the issue will not sail through because of the large amount of issue were to be made at the one go.
Right.
So that is there, but we have to see it, how it pans out.
Okay. So I'm going to bring in Pranav Haldia on this. Pranav, we're looking at many new age companies backed by private equity, venture capital, already having significant public shareholding at IPO. But this move, do you think that the minimum public shareholding requirement now is going to then become less relevant for certain sectors, or how are you viewing this?
Well, absolutely. I think one of the points which is also mentioned in the discussion paper is that for a lot of these companies, MPS is actually quite irrelevant because even at the time of the IPO itself, they have a lot of public shareholding already. So MPS then becomes immaterial. MPS is essentially meant for your traditional Indian promoter-run companies, where even post-IPO, you would find that, promoters continue to hold 90 or 85% of the company.
All right. I also have a quick question for Sandeep. Sandeep, from a legal standpoint and the legal implications, what mutual fund distributors, what should be they be aware of with the introduction of these additional incentives for attracting first-time women investors? Because that is also a notable announcement that has been made.
Yeah, I think the idea is that distributors get more money out of it. So I'm not sure how it works, because ultimately the women are going to pay the extra money. It's not going to come from SEBI's pocket. So I'm not very sure how it helps financial inclusion. But yeah, I guess it incentivizes the distributors to kind of take, charge a higher commission, and if they get either women investors or women or any investor from smaller cities.
All right. Okay. So, Pranav, I'm just going to come to you really quickly now. How are you foreseeing this impacting liquidity and investor confidence? Because let's remember, this announcement also coming in right after market hours. We're also seeing that announcement of the CPI inflation coming in. So, what are you expecting to see Monday morning?
Well, first of all, with regards to the dilution announcement which has been made, we need to put this in context. So this will actually have a very limited impact. Even just to put this in context, even as of today, there are just 10 companies which have a market cap of more than 5 lakh crores. Just 5 companies which have a market cap of more than 10 lakh crores. Even going forward, the impact of this will only be on 2-3 large IPOs which are happened. So it is not really a market-wide impact per se. Secondly, I also want to make a very quick point that, it has been said that the market is not able to absorb large issues. However, the data shows otherwise. Even if you recall the Reliance Power issue, which happened back in 2007, it attracted subscription worth 7 lakh crores. Just a single issue. More recently, the Bajaj Housing Finance issue also comes to mind. So, my view is that if the issue is attractively priced, there would be enough money and enough takers for it. So that's as far as the dilution is concerned, and also as far as the liquidity in the secondary market is concerned. A lot have said that if a large issue comes, then it sucks out the liquidity from the secondary market. But if you look at again the last 5 years post-COVID, you've seen not only a huge number of primary market issuances, but also the secondary market scaling newer and newer highs. So it again shows that both markets can run parallelly, and it's not at the cost of the other.
Haldia, J.N. Gupta and Sandeep Parekh, thank you so much for giving us a pretty great insight. This is right after the SEBI made these notable announcements. Let me quickly go over to my colleague Jasmeet now, who's standing by in the newsroom. Jasmeet, give us a sense of what these new announcements now mean on the minimum shareholding for companies, especially with upcoming IPOs.
Well, right. Yes, thank you for that. Now, earlier, what rule did we have? We had like an IPO size over 1 lakh had an MPS of 5%. MPS is minimum shareholding required for the IPO is 5%. Now the SEBI has changed it and made it to 6,250 odd crores. That's nearly 2.75%. Now what they say is, initially when the IPO came up in the market, it used to give a huge rush to the consumers to absorb the level of IPO. So now they are making the level increase to 6,250. Well, with that they're also saying that in the previous time the MPS to be observed was 10% over 2 years, but now they have changed that to 15% over 5 years. Now they're giving more time for the companies to increase the shareholdings in a company for public from the initial offering of 5% to 25% over the span of 5 years. While the new rule also says if at the initial IPO, the public holding is already at 15%, then you'll get additional 5 years to make it go 25%. Now if you look at the few IPOs that are coming and this might get impacted by this particular, the first one would be Tata Capital, which is planning to have an IPO over 1 lakh crore, and this can be seen in the month of August. While the other IPOs are Reliance Consumer Product, Reliance Retail Ventures, then we have Reliance Jio, which is planning an IPO for over 5 lakh crore, where the minimum public offering is 15,000 crores, which will be subscribed by the public for them to specify the SEBI rule. While the last one is Tata Sons, which is expected to have an IPO size of rupees over 5 lakh crore again.
Thanks so much for that update. We'll of course continue tracking what this essentially means and bring you all of the details. Moving on, following the GST rate cuts effective September the 22nd, the government is now stepping up efforts to ensure consumers actually benefit from lower taxes. The Central Board of Indirect Taxes and Customs has directed tax officials nationwide to submit monthly reports on the prices of over 50 fast-moving consumer goods, comparing prices before and after the GST cuts. Now, this monitoring is going to go on for 6 months, and this 6-month monitoring aims to prevent companies from keeping prices high despite paying lower taxes, protecting consumer interests and containing inflation. The data will help the government take timely action if unfair pricing practices emerge, ensuring that the tax relief translates into real savings for households across India. Meanwhile, India's retail inflation rose to 2.07% in August from 1.55% in July, ending a long easing streak. The uptick was driven by higher food and core prices, but inflation remains well below the central bank's 4% target. Let's go across to my colleague Pallavi for the breakdown of the data and what this means.
Right, India's retail inflation did see a little bit of an uptick in the month of August compared to an 8-year low that we had seen in the previous month. India's retail inflation came in at 2.07%, which was broadly in line with expectations. This was for the month of August, and this was compared to a print of 1.5% that we had seen in the preceding month. Now, in the food basket, vegetables continue to disinflate, coming in at minus 15.9%. This was compared to a print of minus 20.7% we'd seen in July. And within that basket, notably, the tomato prices rose by about 16% compared to minus 34% we had seen in the month of July. Despite heavy rainfall in several parts of the country, we didn't actually see too much of fluctuation in prices of other key vegetables. Core inflation that excludes the volatile food and fuel components also broadly stayed constant, coming in at about 4.1% for the month of August, in line with the print we had seen in the previous month. Now, going ahead, economists do expect substantial relief on the headline inflation print from the GST rate rationalization, and this impact is likely to show up fairly soon over the course of the next few months. What does all of this put together mean for monetary policy? Well, most economists we spoke to say that while they do expect the central bank to stay on pause for the next MPC, there is increasingly chance of further rate cuts over the next few quarters.
Thanks, Pallavi, for that. Meanwhile, Trade Commissioner for the European Commission, Maroš Šefčovič, said intensive negotiations for a groundbreaking free trade agreement are underway and said that the FTA, once completed, will bring EU and India closer in more ways than one. He said that the auto sector would be a clear winner in this agreement and was speaking at the annual event of ACMA, the Automotive Component Manufacturers Association of India. Let's listen in.
We will not agree on everything, but as a major democracies in an increasingly uncertain world where there are a lot of areas where we can work together, I'm sure that we will achieve very good agreement.
And in the aftermath of the co-location scandal, people were beginning to lose faith in the exchange. However, Ashish Kumar Chauhan stepped in despite his family strongly urging him not to. Alone at IIT, barely able to speak English, let's listen in to find out how Ashish Chauhan went from almost becoming a monk to becoming NSE's MD and CEO. And don't forget to catch the full conversation at 9 p.m. this evening, only on NDTV's The Disruptor.
Tell me about that time when you came back and how you had to rebuild the reputation after the co-location scam. That must have been a tough phase.
No, it was. In fact, when I was working for BSE for 13 years, first 3 years as deputy CEO, then 10 years as a CEO, and I was retiring because there was a new regulation taken to ensure that nobody can work as CEO in any exchange for more than 10 years. And so I was retiring there, and then one more leg of the scandal broke, although the scandal broke in 2015, but I think 22 there was another sort of a situation which came about, invisible yogi and other things. And two of my predecessors, who were also founders with me in NSE, they went to jail. And so it was a tough time for the organization. It was also losing credibility in terms of the technology not working out, and also many other things. And even government was feeling that this can create an issue, because it's a fulcrum on which any modern nation works. The stock exchange is a very important organization. And to maintain that trust of people, it's very ephemeral, you know.
So you got the call.
And so I got the opportunity, I would say, to come back. And then my wife was against it. My child was against it. Even he's now adult. He was becoming adult that time. And my sister called up from US saying, why are you going for working in that place where people are going to jail and you have enough money? Why are you trying to even work? And in that I said, no, I've started this exchange. It has done India so good. And if India has to grow well over next 30, 50, 100 years, it'll grow on the back of NSEs.
Tell me about the aspiration to live a spiritual life, and then if you become a monk, then you are actually giving up on a lot of things in the world. Tell me about that thought and that phase in your life. Was it as a young child?
Yeah, I was very young, probably 7, 8 years old, and up to, I think, around 15, 16-year-old. I mean, I was a bright student. Without studies, I could get good marks. But broadly, I was also into playing cricket, reading up things, but also into religion. And my family was broadly of the opinion that I'm going to become a monk. I was also of the opinion that I will become a monk. But then by quirk of fate, I got into IIT. And so that changed life. I came to IIT, and then I was like lonely, did not know English. And so I was going to go back, and I got admissions there as a medical student also. I did one day for medicine studies also, one day in the local engineering college in Ahmedabad, and then came back saying, okay, might as well. If I have to study in English everywhere, might as well go back to IIT.
That's right. Don't forget to catch the whole discussion at 9 p.m. this evening, only on NDTV Profit, The Disruptors. Moving on to some other news coming in right now. A SpiceJet aircraft flying from Kandla to Mumbai experienced a rare mechanical issue when an outer wheel was found detached on the runway shortly after takeoff. Despite this, the pilots safely continued the flight and completed the landing at Mumbai without incident. After touchdown, the plane taxied to the terminal under its own power, and all passengers disembarked normally with no injuries reported. A SpiceJet spokesperson confirmed that safety protocol was followed throughout the incident and assured that a full investigation is underway. And as we inch closer to the weekend, let's get you your binge list for the weekend. Shreyansi now joining in with more details on what you can watch this weekend.
Let's start with the first movie that in fact I'm looking at on Popcorn Pearls. The first one in fact is Demon Slayer. Managed to slay any and all doubts with those strong pre-booking numbers. In fact, September 12th is the one when this Japanese anime is releasing. It's very interesting. Haruo Satozaki is the director for this one. Early reviews, in fact, are quite spectacular. And in terms of what it's going to be doing, it's going to be an imagining of the Taisho era. So keep an eye on this one. Halls are pretty packed. So if you don't get a booking for this weekend, do keep in mind that this is the one that you should be watching out for. The next one that we have, in fact, is in terms of OTTs. Let's quickly also take a look at the last week's top release before we move on to that as well. And global collections for The Conjuring's latest one in its series is $187 million. It's the second fastest horror movie, in fact, to climb above that $100 million mark. And in India itself, 67 crore is the kind of collection that this one has managed to have. scared away any and all doubts when it comes to the series. In fact, the best opening for this particular franchise as well. But let's also quickly take a look at some of the OTT binge list counters that we have. The first one, in fact, is Do You Want a Partner? This is the one where you do have the two leading ladies, in fact, navigating through a male-dominated world of startups. So keep an eye on this one. The other one, in fact, that we have on this list is The Girlfriend. And this is the one that is releasing on Amazon Prime. The early reviews seem to be a little mixed at this point in time, but there are some positive reviews, so you can even keep this one on your list. And the last one, in fact, that we have on our list is the season 5 of the Only Murders in This Building. This is one series that managed to catch a lot of eyeballs in its previous season, so keep an eye on this one, already released on September 9th. And the early reviews, in fact, are gearing up to be quite strong, so keep an eye on this one that is releasing on Jio Hotstar.
Thanks so much for that, Shreyansi, and hope the weekend is off to a good start. With that, it's a wrap on Profit 360. Stay tuned for more news and updates only on NDTV Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
We see the problems, but you as a social entrepreneur see the solutions. You are not just creating solution, you are creating a future where everyone has a chance to thrive. For the change makers, the innovators, the ones building a better world, one solution at a time. The Adani Green Talk Social Impact Awards are created for you, inviting social entrepreneurs to apply. Green Talk Social Impact Awards 2025, where innovation meets impact.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy?
Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is my Vajrajani, and today we're going to again continue to look more domestic. And when you look domestic, hotels is one sector which seems to be on an uptrend. We had one of the managements come through a couple of days back when we spoke, and they said that H2, and this is Chalet actually, now that I remember, they said H2 is going to be extremely strong. H1 was slightly subdued due to various factors, including the India-Pakistan conflict of sorts that played out, and the monsoons in certain geographies have been tough. If I recall, those were the reasons he gave, and therefore, one is of course the GST benefit, and we're going to be speaking with the Royal Orchid Hotel group today. One is of course the GST benefit and how that impacts both occupancy, in their opinion, and other income, because you will have more people coming into restaurants and more people utilizing hotel spaces. So hopefully we'll get a sense of what this does in terms of numbers exactly and demand. The second piece, and I did mention this, occupancy trends for Q1 FY26, of course we'll analyze that. But what about H2 and what is Q2 looking like? We'll just get a sense of that as well. And with this GST rate cut, likely there will be a push with regard to that as well. Let me talk about the third piece. They are planning to triple their hotel count. 350 hotels is what they plan to set up. Currently they are at maybe 118 odd hotels, and therefore there's a very, very strong growth pipeline in terms of the hotels that they are going to be putting up. How are they going to be funding this? And is it just going to be management contracts, or is it going to be how many are going to be owned and how many are going to be managed? So that's the number 4 point actually. Let's pull that one up as well. Owned versus managed, what's that ratio going to be like at 350 when they get there? And this is a target they've given by FY30. The fifth piece is with regard to margins. Now margins have fallen, and that's because the fixed cost has gone up. And typically when the fixed cost goes up, you'll hit a certain scale with that same level of fixed cost, and therefore I want to understand what the margin upside is. The guidance is FY27 will start to see margin accretion, but how much scope is there for that margin improvement is what I want to know. And the last piece is with regard to FY26 cash PAT guidance. They've said that cash profitability is going to be at 70 crore in FY26. Now, while that is very healthy, my sense is that they've already done that trailing 12 months at the end of Q1. And if Q2 is strong with GST and with H2 is strong, I beg your pardon, and plus you have that GST lever which will give it additional tailwind, can there be an upside to that guidance? And therefore, where do they invest that capital? So all of that is what we'll try to dissect, and of course, we'll first start with about the company. Mahima, you want to start with that?
Sure. So basically, as Harsh mentioned, it operates and manages hotels, resort as well as hospitality services, focuses mainly India, small presence in Nepal as well as Sri Lanka. The company follows asset-light model, plans to triple its size when it comes to 2030. The target right now market is business, leisure, weddings and special interest guests. In terms of where the brands are concerned for this particular counter, It includes Regenta, which is mid-scale value hotel, largest in terms of network. Then we have Royal Orchid, of course, which is focused more towards luxury properties, flagship of 5-star luxury properties. Iconica, now this is new upscale lifestyle hotel that they have in their portfolio, the first one in Mumbai, of course. And then Regenta Palace, Regenta Z and Crestoria. These are the three ones. Each caters to different segments, that is youth, boutique as well as budget hotel. So this is the entire brand portfolio that Royal Orchid has under its name. In terms of the product mix, well, roughly 55% plus of their overall breakup is the room stays, that is the room rent comes into this part. Then around 33% is F&B and others is around 12%. In terms of the operating models, owned is a very small number for them. In terms of the other services, of course, that includes your banquets, event, weddings, loyalty programs, etc. With regards to where the operating models are concerned, owned hotels, like I said, is a small number. Flagship hotels, example Bangalore, that basically means that's a very small number, but in terms of the leased and revenue share, that pays fixed rising lease, enjoys higher share in profit. So that's the managed and leased part that Harsh is talking about, leased part that Harsh is talking about, and then managed and franchisee. Now this earns management fees or franchisee fees, so this helps hotels grow because it's low in capital and low in risk as well, but the growth coming in as a part of management fees helps a lot in terms of, and plus not capex heavy, right? So that helps company earn in a better way. So that's with regards to where the operating models are concerned with regards to where Royal Orchid stands. So this is the overall view.
So I just want to understand this slightly better. So one is you own the hotel itself.
Yes.
So you own the land, you build the hotel, so that's high capex. The second way of doing this is someone else owns the land, someone else owns the hotel, and you run it for them, which is managed. And then the third way of doing this is someone else owns the land, someone else owns the hotel, you pay them a lease and you take over the hotel. Correct. Is that the right way to think of it? And in terms of the managed hotel side of things, it is their brand.
Correct.
And they earn a franchisee fee on it.
Management fee, correct.
And they determine the quality of the service and the manner in which the service is provided to the customers.
So that the brand name is maintained, yes.
And they provide a platform for customers to come in and book rooms as well.
Correct.
Okay. Anything else with regard to understanding
No, I think this sums it up, right? This sums up the entire model. And I think a lot of hotels right now, just to give viewer a perspective, moving towards that asset-light model, because that helps them not to invest much, because that requires funding as well, debt, or equity, whatever. And at the same time, doing capex right now for a lot of companies may not be the right way to expand as well. So asset-light is the way a lot of people are going. Hotels are going.
Well, yes, that is the new terminology in the hotels business, asset light. And they don't own it, but they do ensure that it is being run far more efficiently than a typical hotel does. But just the tailwind of growth, right? Let's talk about all of the metrics that we'll be discussing today with regard to our Royal Orchid. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding, the street cred. We don't have any street coverage. But so therefore we'll do outlook, and thereafter we'll look at the valuations and how that stacks up. Mahima, income statement.
Right. So, healthy financials when it comes to the income statement as well. If we take a look at the 3-year CAGR of how the revenue has grown, it's been a CAGR of 32% in the past 3 years. The EBITDA has grown at the CAGR of 34%. Even in terms of margins though, have come off a tad bit versus where they were in FY23 at 35%, FY24 at 30% to 28% in FY25. We'll have to, ask the management as to what the margin trajectory from here on looks like. In terms of net profit, the CAGR has been around 17%. Not matching the way EBITDA has grown, of course, but has grown at a steady state. With regards to where Q1 numbers stand and how YY numbers have stacked up in terms of Q1 FY26, overall revenue has seen a growth of around 8%, EBITDA a growth of 18%, and net profit a growth of around 22%. Now, in terms of how the revenue breakup stands, Room rent is around 50%. This is as per the Q1 numbers. 50%, F&B around 34%, and others is around 16%. In terms of the overall operational metrics, average occupancy for JLO hotels was around 69%. The average room rate stood at around 5488. So the GST that we've been talking about, right? The GST on hotels is an interesting one because the hotel industry was not expecting a 5% rate without ITC on room rate below that 7,500 mark.
But that's optional.
That's optional. And if you want to go for ITC, you'll have to pay GST at 12% and get ITC below that 7,500 rate hotels. And probably, you know, their portfolio, we'll have to ask them as to how much of their portfolio falls in that range and what option they would want to go for. So that's with regards to the GST.
That's something else we want to know.
That's something else we want to know. So that's with regards to where GST peg stands. And overall, I think in terms of where the income statement performance stand, it's been a good growth for the company. We've just given it a neutral rating, considering first thing the GST into consideration, and secondly margins picture. Where we'll have to get an idea as to how the trajectory from here on looks like for the company.
The profit growth hasn't been commensurate to the top line growth. 30%
with regards to the EBITDA growth
is very good.
Correct.
But the profit growth hasn't really translated in that sense. I'm not okay. So that's the way we look at it. Let's look at the balance sheet now, and in the balance sheet, let's look at first off the total equity capital. It's around 230 odd crore. Mind you, it's a 1400 crore market cap company, so that's your price to book. Therefore, the borrowing number stands at around 100 crore, and this includes short-term plus long-term borrowings. Excludes lease liabilities. This is not a number we've picked up from the presentation. This is a number we've picked up straight from the financial statements. So this might be different versus the number in the presentation that you'll see. The cash bank balances look fairly healthy and allows for a bit of expansion. And at the same time, it's also a cash generating company, because typically if you're in the hotel business, you will first generate cash and thereafter you'll see occupancy. So broadly, it's there's no concern with regard to that cash balance also sitting in, versus the total book value also looks fairly healthy. So we've given this a thumbs up. Cash flow, Mahima.
Right. So in terms of cash flow from operations, you know, overall, if we take a look at how past 3 years have panned, and you know, earlier also we were discussing as to you know, how this should be ideally analyzed, and Harsh and I were talking about it as to the ratio of cash flow from operation to PAT, and that has been kind of decreasing, but still at a healthy rate of around 53%. So it's not at all concerning as to where this particular ratio is concerned. So the overall revenue, the cash from operations is getting translated. The PAT number has
that is
remained.
The way in which the business works, Mahima, because it's a hotel business. Typically, you will first have bookings coming through, and thereafter you will have your guests coming through.
Correct.
And therefore, no surprise that the CFO to PAT is positive. I believe they've been making certain investments from the revenue expense.
Correct.
To a certain extent, which for the hotels that they've been taking over as well, because they need to refurbish those. For example, they've recently taken over a hotel and they've done a 15 crore rupee OPEX on that hotel to try and refurbish it. And those expenses also kind of get built into this. But for the moment, the overall cash flow from operations to PAT looks fairly healthy, and therefore we've given this a thumbs up. Let's look at return ratios. Okay, so let's pull those up, and what you'll see is they've been fairly healthy. See, FY21 was a tough year, understandably, it was COVID. FY22 also was a fairly tough year because we were just bouncing back from COVID. The second wave of COVID was in Q1, if you remember. But FY23 onwards, they've been fairly good in terms of where the ROCE is concerned. You'd want to see whether this can sustain, and if margins will go up, you'll inevitably see ROCE go up. But you want to keep your eye out on the C part of ROCE, which is the capex that they do, and therefore, can they continue to maintain this ROCE? Well, currently at 17%, looks fairly healthy. Does not seem to be much of a concern. But the shareholding pattern, Mahima.
Right, so it's a well-held company, Harsh, for sure. I mean, the promoter holding has remained stable, 63.6, 63.7, 60.8%. Even FIs has slightly increased their stake, in the past 3 odd years. It's gone to around 7.72% as of June 2025. DIs, well, they don't hold much in this particular counter, but public holding has also, fairly remained in that 27 to 29% range, currently at 27.6% range. But it's a well-held company, and that's why we've given it a thumbs up.
Okay, let's talk about the street cred. And within street cred, if you look at the near-term numbers, fairly solid in terms of returns. It's been a 7-bagger plus over the last 5 years. So even those returns fairly healthy from the COVID lows. Of course, that's something to be factored. But again, fairly healthy. No complaints there from a short-term or a long-term perspective. We've given that a thumbs up. Mahima, I'll request you to cover both valuations as well as outlook.
Right, so valuations, as compared to peers is looking attractive right now, because if you consider something like a Lemon Tree, EIH or Indian Hotels, they're trading at what, 58 times, 70 times, EIH at 33 times. But something like a Taj GVK is slightly cheaper than Royal Orchid at 23.7 times, but Royal Orchid trading at 31.8 times versus its peers. So we've taken a conservative approach here, giving it a neutral rating, because as compared to peers, it's it looks cheaper, but overall 31.8 times, it's not cheap when it comes to valuation, and that's why we've given a neutral rating when it comes to valuations. Lastly, in terms of the vision 2030 and the growth strategy that the company has outlined, they plan to triple their hotels by 2030, growing keys to almost 22,000. The FY26 cash profit that Harsh talked about at the start of the show will grow to around 70 odd crores is what they've aimed at in FY26, and 75 crores in FY27. Overall outlook seems very positive when it comes to this particular counter, and that's why we've given it a thumbs up when it comes to the overall outlook and guidance given by the management.
Okay, all right. So that if I stack up all the valuations, that gives it a very healthy 6.5 on 8 in terms of the KYC rating. If I stack up all of the metrics. Now let me go across. We have Mr. Amit Jaiswal, the CFO of Royal Orchid Hotels, joining us live at this point. Mr. Jaiswal, hi, good morning. This is Harsh here. I want to first start off by understanding from you what component of your top line is 7,500 and below, because that's where a large part of the benefit lies, as Mahima was pointing out to viewers. What part of it is in that category? And also give us a perspective on what you're expecting in terms of a demand push as a result of purely this GST piece playing out. What's the likelihood?
See, if you look at our ARRs, we are averaging around 6,000. So that you can make out that almost 85% of our company's rooms are being sold at less than 7,500. It's only in some of the high-end hotel, wherein the suite rooms and all are sold at above 7,500, and maybe in some seasons, like in Goa, November, December, we sell at a higher ADR, the rooms and all. So fairly largely, if you look at it, 85% of our revenue is below 7,500 ARR. So we will have to change the GST accordingly. Okay, and as far as the effect of GST, definitely it is a booster. The foreign traffic, we have become competitive to all our neighboring countries with this GST rate, that is Thailand, Sri Lanka, Vietnam, Dubai, and other Sri Lanka and all like that, all these companies where the GST rates are little lesser. Earlier we were at 12% and 18%, whereas they all were between 7 to 10%. So we have become competitive. So there will be a growth in the revenues as well as the occupancies overall basis. Yeah.
Okay. Mr. Jaiswal, hi. Mahima also joining in. Just want to get a sense, because now we have two slabs, right? 5% without ITC and 12% with ITC below that 7,500 mark. Just want to understand what is more beneficial for a company like you, because if you have ITC at a higher rate, then giving output GST at 5% without ITC will not be beneficial. So just want to understand that part of business.
You're right, Mahima. See, if you really look at the financials, then definitely without ITC will not work very favorable as far as the financials are concerned. But as I said, if this drives traffic, If my occupancy, suppose I'm at 70%, it goes to, another 5-6% growth I get in the occupancy, then definitely it will overall, in the scheme of affairs, it will affect. But directly, if you really look at it, as most of our hotels are under revenue share model, wherein we pay the lease rent on which 18% GST is there. So we will have a issue if we don't get the ITC. But I think overall perspective, if you really look at it, it will boost the overall revenue and the occupancies. That's where we have to encash.
Right. Sir, talk to us about how Q1 and broadly tell us how trends in Q2 have been. So we'll talk near term first, and thereafter we'll zoom out a little bit, talk about FY30 and how you get there. But just in the near term, in FY26, you've guided for a 70 crore cash profit. You've done that on a trailing 12-month basis at the end of Q1. Just wanting to understand, does this give you comfort to up your guidance, if at all? And how is Q2 going to likely be? Or even if you can't talk about Q2, talk to us about H2. Is it going to be extremely strong given GST? And therefore, would you be tempted to up your guidance?
See, as far as the Q1 numbers are there already, we have posted a good profit. We have been able to work on our cost. See, we invested in last year, our costs were a little high. Now that we have controlled it with all our investment over. So I see the numbers, if you really look at the revenue numbers, it may grow in a, 8%, 9%, but our profit numbers will definitely grow. And as far as H1 is concerned, H1 till now it is good, okay, and H2 looks very good. We have a lot of bookings on the card, and the hotels are doing well. However, the Goa market is little sluggish. The Goa market has been sluggish because of several other outside issues which are prevalent in Goa right now. However, overall, the company is bound to go do well in this financial year, and definitely the cash profit is helping us in growing more leased models.
So you spoke about Goa. Can I also push you to talk about Nepal? What's happening there?
See, Nepal is in a turmoil right now. All the travels are, I think, it's standstill with so many local issues there, and also Nepal is having a very, very bad. In fact, all our neighboring countries in the last couple of years, if you see, had a lot of issues. Whether it is Pakistan, Bangladesh, Sri Lanka, everywhere, and Nepal also now has touched the same thing, and so the travel to Nepal right now is ruled out from India.
Okay, Mr. Jaiswal, you planned to triple your keys by FY2030. Just want to understand as to how the funding will be done for these expansions, and what will be the ratio between these hotels between owned and managed?
Yeah. So if you really look at our presentation, which we have, it's there in the public domain, we are not going to own any hotel from here till next 5 years. The route to develop our group is only through two patterns. One is the flexi lease, which we call revenue share model, and another is management. Now, in management, we don't need to invest a single rupee. There's no investment as far as the management business is concerned, and 80% of our growth will come from that route only. Now, 20% we are targeting, the growth is to come from the flexi lease revenue share model, wherein there will be investment, but the investment is very, very minimal. Like hypothetically, if you really look at it, 80-room hotel, if we take it on lease, we give some 6 months deposit, which is around 1.5-2 crore rupees, and some working capital, 3-4 crores we need for doing that hotel. So for that, I don't think we need a lot of money. Funding is not required because we are generating cash. Our financials are quite very strong, and we are generating internal cash. With that, we will do, and maybe a little bit if something is required, then we'll look at that particular opportunity that we have just now opened our hotel in Mumbai, that is the Iconica, where we have invested some 20 crore rupees. And we had to borrow from the bank to do that. But that hotel is going to give a big boost to our overall scheme of affairs and the revenues as well as the profit.
So you're sitting on 60 crore of cash. You will generate around 70 crore of cash profit this year. And thereafter, my assumption is it will only go higher. In fact, the sense is that you'll likely beat that number already in FY26. What do you do then with the cash, sir? Where is it that you're doing?
No, that's what I told you, that when we do a leased model, no, we need to invest some money there.
Okay. Yeah, I understand that, sir. But that's a smaller component.
Depends on the size of the hotel. Like if it's 80-room property, around 7-8 crores we need to do that hotel.
Okay.
And our payback period is 2 years.
Got it. And therefore, how does the debt picture evolve, in your opinion?
Debt will revolve around this much. Right now, we are at around 90 crores debt overall of the company. So the debt will remain the same because, if we get some good opportunity of long leases, wherein we need to put some 10-20 crores, we'd like to put it with the repayment. Whatever we repay, we will again involve that and, put that money in the... See, because Iconica is it's an upscale brand which we have just launched, and we are planning to do 8 Iconicas in next 5 years. So every Iconica will need some 10-20 crores, but we are not going to borrow too much from anybody.
Mr. Jaiswal, quick question on margins. What is the trajectory looking like, especially from here on, because you'll not be doing a lot of capex, but you'll be adding a lot of keys, so that should flow into margins as well. What do you think? 2 or 3 years down the line, you'll be able to come back to where you were, around 30-32%, in that range?
No, please understand, Mahima, please try to understand. Our model of business is management and as well as leases. So the margins the percentage of the margin in leases is lesser than owned hotel. See, owned hotel typically earns around 40%, 45%. But whereas this leased and the revenue share model, which we are doing, wherein we are not putting a lot of capex. So there the margins are much lesser because we need to pay out from our margin the lease rent to the owners. Okay. So after that, the left out percentage margin is less, but overall, our absolute number is going to grow in a big way in next 5 years. Our ROC, the most important factor of raw locket is the ROC. We are having a very strong ROC, which is hovering around 20%, which we want to take it to 25%. That's the model we have built.
How quickly do you get there, sir? Timing. Sorry, I just have 30 seconds.
Yeah. Come again?
How quickly do you get there? 25% ROC.
No, that's what I'm telling you. With lesser capex, I'm doing more hotels.
Fair.
So, and the margins which will come, it will improve my overall ROC.
Understood. How quickly do you get to 25%?
Come again?
How quickly do you get to 25% ROC?
5 years. That's the time we are putting, 3.5 years, we should be able to touch and maintain it for 5 years.
Understood. Okay.
We have made for 5 years.
Wonderful. Thank you so much, Mr. Jaiswal, for coming in and speaking to us. Well, that's all the time we have on KYC today. KYC only on NDTV Profit. Thanks so much for watching. From Mahima, myself, and the entire team that puts this show together. NDTV Profit. Continue to watch us. It's for your profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं। उल्टे हम भी जब विदेश जाते हैं, द बेस्ट ऐप टू यूज इज द एनडीटीवी ऐप।
We see the problems, but you as a social entrepreneur see the solutions. You are not just creating solution, you are creating a future where everyone has a chance to thrive. For the change makers, the innovators, the ones building a better world, one solution at a time. The Adani Green Talk Social Impact Awards are created.
The SEBI board meeting concludes, the regulator easing minimum public shareholding rules for large IPO-bound companies. SEBI is also going to grant the much-anticipated no objection certificate for the National Stock Exchange's IPO. That approval will come once all the regulatory formalities are completed, including the resolution of the settlement-related proceedings. In the Indian markets today, we've seen the Sensex surge more than 350 points. The Nifty has ended above 25,100, which marks its longest winning streak in more than a year. Most sectoral indices have closed higher, led by strong gains in Nifty defense. Following the GST rate cuts that are going to be effective 22nd September, the government is stepping up efforts to ensure that consumers actually benefit from lower taxes, with the CBIC directing tax officials nationwide to submit monthly reports on prices of more than 50 fast-moving consumer goods, comparing prices before and after the GST rate cuts. Consumer price index inflation has risen to 2.07% in August, which means it's up from 1.61% in July, signaling a modest uptick in retail prices. But despite that increase, inflation is still within the Reserve Bank of India's comfortable target range. India and Europe intensify efforts to finalize an FTA by the end of 2025. The EU Trade Commissioner, Maroš Šefčovič, has acknowledged that while India and the EU may not see eye to eye on every issue, they remain optimistic that a strong, mutually beneficial deal will be reached. The much-anticipated Navi Mumbai International Airport, set for inauguration on the 30th of September, operations are expected to begin by the month of November. The suspense over Nepal's interim government has ended. The former Chief Justice, Sushila Karki, is going to be the interim Prime Minister of Nepal. Nepal's parliament is set to be dissolved. Good evening with Profit 360 here on NDTV Profit. I'm Vikram Oza. Hello and a very warm welcome. So along the next half an hour or so, we are going to bring you the latest on the markets. The regulators, of course, changed those norms, bringing more depth, more participation. That's the idea. And this happened after their board meeting concluded. So we'll talk about that. And besides, of course, we're tracking several national and international developments as well. So markets regulator SEBI first. Now, they've announced several key reforms aimed at easing fundraising, improving market transparency as well, and protecting investors. So the notable changes include relaxed minimum public shareholding norms with longer timelines for large companies to comply, and they've expanded the anchor investment participation as well in IPOs, which now includes insurance and pension funds alongside those mutual funds. So additionally, there are these incentives that have been introduced for mutual fund distributors to attract first-time women investors, promoting greater financial inclusion when it comes to them. The SEBI chairperson, Tuhin Kanta Pandey, announcing the relaxation of minimum public shareholding norms for big companies and those that plan to go in for an IPO. So this was announced at the press conference at the end of the SEBI board meeting. Just listen in to what Tuhin Kanta Pandey said about this.
So one of the main issues being faced in the large issuers, they face challenges in undertaking substantial dilution of equity shares through IPO, as large offerings may be difficult for the market to absorb. These constraints can act as a deterrent for large issuers from considering listing in India, thereby limiting the investment opportunities for the Indian investors. So now we are recommending, the board has recommended that there are two share thresholds. Post-issue market cap, one is 4,000 crore to 1 lakh crore. So there's no change before that. The post-issue market caps, less than 4,000 crore remain as it is. But we are creating 4 more thresholds after the 4,000 crore. 4,000 crore to 50,000 crore, 50,000 crore to 1 lakh crore, 1 lakh crore to 5 lakh crore, and more than 5 lakh crore. Then for 50,000 crore but less than or equal to 1 lakh crore, in this category, it is proposed to revise the minimum public offer from the current requirement of 10% of the post-issue market cap to 1,000 crore plus 8%, at least 8% of post-issue market cap. So this is a scale-based thresholds we are bringing. Now for 1 lakh crore and above, so it will be 6,250 crore and at least 2.75% of post-issue market cap. So this is plus. And which is market cap above 5 lakh crore, it will be 15,000 crore plus 1% of post-issue market cap.
So that press meeting took place after the board meeting concluded, and of course now we are getting an understanding of how the minimum public shareholding norms are being changed. But let's put that in context. In the Mumbai studio, my colleague Jasmeet is joining us about these new rules on minimum public shareholding. Jasmeet, we just heard Tuhin Kanta Pandey about these norms. I know the slabs have now multiplied. Earlier it was just 2, like he pointed out as well. But decode for us, what changes now for the more important slabs that would affect upcoming IPOs, companies that are going in for IPOs, especially the 1 lakh crore IPO, those that are worth 5 lakh crore rupees and more?
Well, right. Yes, thank you for that. Let me quickly put everything into context. Right now, we're looking at the IPO size from 1 lakh crore up until 5 lakh crore. Let's quickly understand what was the old norm and what has changed now. While the old norm said the IPOs of 1 lakh crore had to do an MPS of 5,000 crore or the 5%, whichever is higher. While they also had a rule that the MPS to reach 10% within 2 years, while the MPS of above 25% to be reached in next 5 years. These were the old rules. Now, what the new rule says, the new rule has taken the minimum 5,000 crore of MPS up until 6,250 crore. So they have basically increased the range in the initial public offering. While they also say if the public offering listing is below 15%, they can reach 15% of it by next 5 years, while they'll get additional 5 years to reach the 25% slab. So they've basically eased out on the rules when it comes to getting the raising the funds from the public. While that can be positive for few companies, while most of the companies these days have already gotten their private equity listed. So that's another thing to watch out for. Now, if you look at the next rule for the category above the 5 lakh crore of market capital, now what they say is for securities above 5 lakh crore of market capital, the MPS to be subscribed is at 15,000 crore or that's 15%, whichever is higher. While they also say that if the shareholding is less than 15% from during the initial offering, they'll have additional 5 years to reach that mark. But if it's above 15%, they'll get additional 10 years to reach the 25% mark. Now, let's understand the IPOs that are coming around the corner, which can get impacted by the new changes. While the IPOs are Tata Capital, which is planning to have an IPO size of over 1 lakh crore, while that would come in the new bracket of 1 to 5 lakh crore bracket. While the other is the Reliance Consumer Product, the Reliance Retail Ventures, while the Reliance Jio Payment, which is planning an IPO of over 5 lakh crore. While lastly, we also have Tata Sons, which is again planning an IPO of over 5 lakh crore, which might have to go through the new proposed changes if they get implied before the IPOs get publicly issued.
That really helps put in context with the kind of companies that are coming up with IPOs. Jasmeet, thanks for doing that for us. And indeed, as far as the SEBI chair is concerned, there were several other announcements. There are new incentives for mutual fund distributors who bring in these first-time women investors. All of that aimed at boosting financial inclusion. Also, Tuhin Kanta Pandey has commented on F&O norms when he was asked very pointedly about possible changes to the F&O norms regarding short tenure derivatives. The chairperson has actually urged the media now not to speculate about this prematurely. Listen to what he said.
The important thing is that the incentive for distributors for bringing in new women investors shall be paid for everyone. It's not only for the B30 incentive, it will be for all over India, which means that it will be even for top 30 cities also, this will be applicable. So for women, for any new PAN, this incentive will be payable for the distributors. So it will actually provide more financial inclusion of women in mutual fund space. इस विषय में स्पेकुलेशन बहुत मीडिया की तरफ से भी अननेसेसरी हो रही है। एक हमने स्टेटमेंट दिया था, हम उससे क्या हम करेंगे वो भी हमने बताया था। अब यदि हम उसको डे टू डे की तरह कमेंट्री की तरह ले लें, मतलब 5 डे ले लें, फिर ODI ले लें, फिर T20 की तरह ले लें, यदि कमेंट्री ही चलती रहेगी तो वो ठीक नहीं है।
Indeed. So we've got a slew of measures that SEBI is now taking. The board meeting concluded earlier today. And now we are hearing about the minimum public shareholding norms getting tweaked as well. This, in a way, is trying to kind of ensure that we get that much more participation in the markets. But there are several efforts as well that is being driven towards more of that inclusion, that financial inclusion. So mutual funds are getting those incentives as well to park in money that is coming in through first-time women investors as well. Besides that, we're looking at REITs and InvITs as well. Now, these are being given the classification of equity instruments as well, which also includes that kind of involvement when you talk about the larger market. So classifying REITs and InvITs as equity instruments is further opening up the asset class for retail investors. But more about the SEBI amendments to the governance norms for exchanges and depositories and others. All of these are part of the takeaways that we gleaned from that large press conference that took place after the SEBI board meeting concluded earlier today. Also, we're hearing that there will be the appointment of 2 executive directors to the SEBI board. That is a decision that has been taken by the board as well. The roles of managing directors, executive directors, the key managerials are all going to be specified very clearly soon, is what we've got from that board meeting as well. Also, SEBI is launching the India Market Access website, which is called indiamarketaccess.in for FPIs as well. And we got a glimpse into what that website actually holds at that very press conference. In fact, my colleague Charu Singh has been at that press conference, and there are the key takeaways that we were talking about to our viewers about this, Charu. Why don't you put that all in context for us? Because several announcements being made, right from minimum public shareholding norms to the kind of effort that is kind of going in for investments that would come through from women investors as well. We're talking about FPIs as well. So a slew of measures being announced. Charu, put that all in a nutshell for us.
All right, so a slew of decisions have come out as a result of the Securities and Exchange Board of India's board meeting today. So what we know for now is that minimum public shareholding norms for large companies who wish to go for their IPOs, who wish to go public, have been relaxed. How have they been relaxed? So earlier, they needed to come out with 25% threshold of public shareholders within 3 to 5 years. However, this period has been increased significantly, making it easier for them to go public and raise funds. Apart from this, there have been development of a website for the FPIs to be able to enter the Indian market landscape more easily, called the Swagat website. Apart from that, anchor investor allocation in the IPOs has been increased from 30 to 40%. That also increases the chances of better investment opportunities for the companies which are going public in the Indian markets. Apart from that, several benefits for the investment advisors, research analysts and women investors have been announced. And the comments made by the SEBI chairperson during the question and answer round of the media briefing of the board meeting are also important, as the chairperson has said that the NSE IPO's NOC will be coming out very soon in a smooth process once the settlement related proceedings are completed. In fact, the appointment of the new chairperson to the board of National Stock Exchange also helps its process for getting an approval for the IPO. Apart from that, the SEBI has also clarified that regarding F&O norms and regulations, there is not going to be any hurried step. There is going to be proper consultation and discussion with the stakeholders before anything concrete comes out.
Thanks very much for that, Charu. And I know you were there at that press conference and you posed a question as well to the SEBI chair. And he said this as far as the entire drive towards getting more clarity on the subject that he seemed to be kind of shrugging off. It was about the much anticipated no objection certificate for the National Stock Exchange's IPO. That approval is going to come once all the regulatory formalities are completed, is what we got to hear. And that includes a resolution of the settlement related proceedings on NSE as well. But listen in exactly to what the SEBI chair has said about this in response to a question that Charu posed.
I think it should be coming soon after we fully do it, all the formalities regarding settlement. I won't hazard a guess about the time. I'll have to calculate.
Sir, has the high-powered committee met for this NSE settlement which they have filed for the co-location case? It was supposed to happen this month, right? If you can comment. If the high-powered committee has met. Not for this specific issue.
Not yet.
So now that we're hearing from the SEBI chair that the no objection certificate for the NSE IPO is expected soon, we had a word going with the CEO and Managing Director of NSE, Ashish Chauhan, was getting candid with us on the latest episode of The Disruptors, which is our ongoing series here on NDTV Profit. And he explained to us why the NSE IPO matters, what the holdup really has been. Here's a bit of what he said about this particular aspect. Of course, the full conversation is going to play out at 9 o'clock tonight at NDTV Profit itself. But listen into what he said about this.
Is this why the IPO is so important? Because it firmly puts this whole co-location mess behind NSE.
For me,
it means everything is cleared up and it gives a chance for investors to participate in what NSE is doing.
In a practical sense, today I have like 1,69,000 investors already. It's larger than number of shareholders are larger than most large companies which are already listed. The stock is also traded heavily in private markets and things like that. But as you rightly said, it gives that vote of confidence from the regulators if it lists. It also allows the larger stakeholders. Today also, even now, 31.2% of the stocks are held by PSUs, right? And that gives them also an ability to exit, ability to also claim that they have this. Many of them invested probably 50 lakhs or 1 crore, 2 crores. When it lists, it will have several thousands of crores coming to them. And so for me, it's many things, because listing may be just an event, but it brings the corporate governance framework to the par with the best, and brings the transparency in policy making, in the way you run the organizations. And that's why I think listing is more from, especially for institutions which are public like NSE, it's basically making them more accountable to people.
More of that interview at 9 o'clock tonight. Meanwhile, let's talk about retail inflation in India. It's risen to 2.07% in August from what was about 1.5% in July. It ends a long easing streak. So the uptick driven by higher food and core prices, but inflation remains well below that central bank's 4% target. To decode this, Upasana Bharadwaj is joining us, Chief Economist at Kotak Mahindra Bank. Great to have you with us, Upasana. That headline CPI has gone up to 2.07% in August from what was about 1.6% in July. If you see the trajectory of inflation over the recent months, what's the kind of trend you're spotting, Upasana? I think we haven't been able to make a complete connection with Upasana Bharadwaj. I'll see if our production team can actually do that in a moment. But it's an important piece for us to track retail inflation, considering how the RBI is going to move ahead with interest rates from here. When you see an uptick, the kind that we are seeing in the month of August, which is about 2.07%, from the 1.6% that we've seen in the previous month, in the month of July, it ends that long easing streak for one. But is there a longer trajectory of a higher inflation that we are tracking that we need to be mindful of, because it's definitely going to have a piece. CPI, of course, considers food and fuel, but when you look at the core inflation as well, now that has remained sticky, but at this time, can you expect it to, considering the way that food inflation has moved in recent times? Of course, it's still well below the central bank's target, which is 4%, but will it consistently remain at that level? That's something that we are trying to track very closely. But of course, we'll try and return to that conversation about the inflation numbers. We'll try and do that a little later. But for the moment, let's just move on from our inflation numbers to this interview that has been conducted by Fox News. It's the American President, Donald Trump, saying that he's had a long relationship with Putin, but he's expressed frustration at his failure to end the war in Ukraine. He said he would hit Russia hard and has talked about this 50% tariff levy on India because of the purchase of Russian oil as well. Listen into that bit of the interview that he's done with Fox News.
So has your patience run out with Putin?
Yeah, it's sort of running out and running out fast, but it does take two to tango. It's amazing. When Putin wants to do it, Zelensky didn't. When Zelensky wanted to do it, Putin did. Now Zelensky wants to, and Putin is a question mark. But we're going to have to come down very, very strong. It's the only one. This is the one, because I've always had a great relationship with Putin. This is the only war that I haven't solved. Now, let's get into Gaza, because that's another one. So those are two that are.
Before you move on, can I ask you,
complex.
what is clamping down on Vladimir Putin?
Well, it'll be hitting very hard with sanctions to banks and having to do with oil and tariffs also. But I've already done it. I've done a lot. Look, India was their biggest customer. I put a 50% tariff on India because they're buying oil from Russia. That's not an easy thing to do. That's a big deal.
So that's the word we got from the American president. Meanwhile, the trade commissioner for the European Commission, I should say, Maros Sefcovic, has said that intensive negotiations are underway for a groundbreaking free trade agreement between the EU and India. In fact, Maros has emphasized that once that entire negotiation piece concludes, the FTA is going to strengthen ties between the two, benefiting multiple sectors in the bargain. Speaking at that annual event of the Automotive Component Manufacturers Association of India, he highlighted the automotive sector as a clear winner in that particular agreement. Listen to what he said.
We will not agree on everything, but as a major democracies in an increasingly uncertain world where there are a lot of areas where we can work together, I'm sure that we will achieve very good agreement.
That's the word we got from the EU Trade Commissioner. Now, turning on to this important case that we are tracking, the Delhi High Court has approved a request by Priya Kapoor, the widow of the late Sona BLW chairman Sanjay Kapoor, to modify its earlier order on his will. Priya Sachdev, or Priya Kapoor, now has sought the removal of Sanjay's sister, Mandira Kapoor, from the court's directive. This development comes amidst a legal battle initiated by Bollywood actress Karishma Kapoor's two children, who are contesting the will, laying claim to shares in assets that are valued at around 30,000 crore rupees. Now, senior advocates representing Priya Kapoor have argued in court that Mandira Kapoor is attempting to gain a backdoor entry into this dispute. Now, another aviation disaster has been averted. A SpiceJet aircraft flying from Kandla to Mumbai experienced this rare mechanical issue when an outer wheel was actually found detached on the runway, and that happened shortly after takeoff. But despite that wheel rolling away, the pilots safely continued their flight, completing that landing at Mumbai, and it all happened without incident, thankfully. So after touchdown, the plane taxied to the terminal under its own power, and then all passengers disembarked normally. No injuries have been reported. A SpiceJet spokesperson has confirmed that safety protocols have been followed throughout the incident and has assured that a full investigation is underway. And still on the aviation circuit, great news for Mumbaikars because the Navi Mumbai airport would be inaugurated on the 30th of September. Operations are expected to commence by the month of November. And the Managing Director and Vice Chairman of CIDCO, Vijay Singhal, has announced this at an event earlier today, the Navi Mumbai airport being the biggest airport in the country. And first, of course, it's going to be connected to a water jetty. And this water jetty is going to take passengers to Gateway of India for one, or even other jetties. That's the plan. And that's the news that we could pack on this edition of Profit 360 from all of us who put the entire news piece together. Thank you indeed for joining us. We hope you have a great weekend ahead. From me, Vikram and the entire team, good night.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.